बेटा ये दवाइयाँ ऑनलाइन ऑर्डर कर दो, पैसे दिए थे ना।
भगवान क्या करूं?
अरे मूर्ख, ये ले मोबी क्विक से पाओ 30,000 तक बिना इंटरेस्ट। स्पेंड नाउ पे लेटर। डाउनलोड मोबी क्विक।
बेटा ये दवाइयाँ ऑनलाइन ऑर्डर कर दो, पैसे दिए थे ना।
भगवान क्या करूं?
अरे मूर्ख, ये ले मोबी क्विक से पाओ 30,000 तक बिना इंटरेस्ट। स्पेंड नाउ पे लेटर। डाउनलोड मोबी क्विक।
गुड मॉर्निंग, शुभ प्रभात। अरे जवाब देना होता है। शुभ प्रभात। ट्राई इट। Good morning, ladies and gentlemen. It's me again, Geetika Ganjudhar, and I'm very happy to be here to host the Mint India Investment Summit and Awards 2022, presented by Trilegal and powered by Moby Quick. Thank you for being such a great audience yesterday, and thank you for joining us at day 2 of this summit. Now, day 1 was mintastic, fantastic, and day 2, I promise you, is going to be even more mintastic and fantastic. The theme of this conference is Investing for India. इस तरह की बातें तो हम कई बार करते हैं, but the age that we now live in, and when we have this conversation, when we talk about investing for India, it has a whole new meaning, because staring at our faces is a clean, new, golden opportunity to build a new India of our dreams. तो फिर सोहनलाल द्विवेदी के शब्दों में चलो नई मिसाल हो, जलो नई मशाल हो, बढ़ो नया कमाल हो, रुको नहीं थको नहीं, बढ़े चलो, आशीष रक्त तोल दो, स्वतंत्रता का मोल दो, कड़ी युगों की खोल दो, रुको नहीं थको नहीं, बढ़े चलो. Come, let's all together build a new India of our dreams. Now, when we say this statement, it's a big generic statement, but each one of us has our very own dream of a new India. And this morning, day 2, at the Mint India Investment Summit, I'm going to step down and ask a few of you, what is your dream of a new India? And I'm going to start with the ladies here. Publicly, I cannot admit to a bias, but it's obvious. Good morning. How are you doing? What is your dream of a new India?
I think my dream of a new India is the kind of opportunities that it is opening up for the younger generation, and to, for us to actually be able to take advantage of those opportunities and, just make the world a better place to live in.
So you mean to say empowering the youth of India with opportunities to contribute to the growth of our nation, because we are today the youngest nation in the world, and it is the greatest asset that we have as of today. Thank you very much, ma'am. Yes, sir. On your phone, sir. Can I have your phone, sir? And can I turn it around, sir? Thank you very much. Sir, what is your name? Mani. Mani, hi. What is your dream of a new India?
To be self-sufficient and stand up to the entire goal of being the growth engine for the entire world. So just be truthful to that entire promise, like what India offers to the world, and deliver on that.
So to be self-sufficient when it comes to all the basics that a human being requires to live and function with, and to also drive growth across the globe for a better civilization. Thank you very much for your answer, sir. Yes? What's in the phone? Good morning, sir. What is your dream, sir, of a new India?
Equal opportunity, irrespective of caste, creed, anything else.
How wonderful. Equal opportunity, irrespective of caste or creed. Yeah, I think that is gender, yes. Thank you. I really appreciate that answer. We seem to think we have gotten over those times, but the reality is that we are still battling these problems of equal opportunity not being given to certain people of certain castes, creeds, and of course, genders. Good morning, sir. Would you like to share with us your dream of a new India?
Sure. So for me, I think New India is a lot about infrastructure, both digital as well as the real economy, right? So we've seen a lot of progress on the digital side in the last 2 years, but I think now with post-COVID, we need a lot more infrastructure, whether it's roads, ports, telecoms, and that's my dream for New India.
Yes, sir. Infrastructure, yes, but I also feel that the infrastructure that we need to now focus on is health infrastructure, because that really hit us hard over the last 2 years. And I know that the government of India is focusing very especially on health infrastructure. My dream of a new India probably would be an India that moves ahead with sustainability as its #1 goal, and that we should have a happiness quotient for all our citizens, where wealth, prosperity apart, we should also measure what is the happiness quotient of every human being in our nation. Ladies and gentlemen, welcome to the Mint India Investment Summit and Awards, जहाँ हम बात ज़रूर करते हैं, but बात अलग करते हैं, because this happens only at Mints. So here we are, investing in a new dream for a new India. Let's then open the house with the first panel of the day. India, $100 billion PE VC market. Well, PEVC investors poured in over $70 billion into Indian companies in the year 2021, a number that was unimaginable 5 years ago. The growing size of the PEVC market has meant that more global investors are waking up and waking up to the potential that India offers, and the pace of dollar inflows into India will only keep increasing. India is definitely on the cusp of becoming a 100 billion investment market. I'd like to invite on stage the speakers of this session: Nikhil Srivastava, Partner and Managing Director, Head of India Private Equity, PAG. Good morning, Nikhil. Aye. Sudhir Variyar, Managing Director and Deputy CEO, Multiples Alternate Asset Management Private Limited. Taaliyan ho jaye hamare speakers ke, ladies and gentlemen, please. Neha Grover, South Asia Lead PE Funds, Disruptive Technologies and Private Equity Funds, International Finance Corporation. Good morning, Neha, and welcome. Sajid Fazalboy, Partner Iron Pillar. Please join me on stage, sir. Good morning. Harsh Payas, Partner Tri-Legal. Good morning, sir. Very warm welcome. Amit Jain, Managing Director and Co-Head, Carlyle India Advisors. Good morning and a very warm welcome to you. And of course, I must invite on stage the moderator of this first panel of the day, Dinesh Tiwari, Managing Director, Broad Peak Capital Advisors, LLP. Good morning, sir. And it's over to you.
Thank you very much, and that was a very enlivening beginning to the day. I think to start with, it's great to be here, to be with the exciting panel, and essentially discussing a topic which is of strong relevance here. You can't open the newspaper today without reading something about either a new deal or a new fund that has come up, or even a new unicorn. I mean, earlier unicorns were actually quite rare, but I mean, today we've got over 80 of them, at least in the last count that was in place there. So these are clearly very exciting times there. And to discuss that, we have with us a fairly rich and diverse panel of people who have a very strong and rich experience of investing both in India and overseas. Let me begin by introducing the panel to you, and then maybe we can open up the questions in terms of a question and answer format. We'll try and take questions towards the end if we do have time, but we will sort of try and work towards that. I'd like to introduce Neha. Neha has been the South Asia lead for private equity funds and disruptive technologies at the IFC. She brings with her a very strong and rich experience of investing. Prior to her current role, she was with Baring Private Equity and has invested in a large number of businesses. In her current role, she basically has a global perspective of the Indian private equity industry. She is on the advisory board of several private equity funds there. She essentially is a chartered accountant, a company secretary, and graduate from the Indian Institute of Management, Lucknow. Happy to have you here with us. Thank you.
Thank you. It's a pleasure to be here.
Thank you. Next, we have Sajid. Sajid is a partner at Iron Pillar, which is a growth stage VC fund. Iron Pillar primarily invests in Series B, C, and D businesses there, largely in new age and technology businesses. As we have seen, the technology space has actually been getting significant interest from investors in the recent past and accounts for a significant part of the Indian private equity ecosystem. Prior to this role, he was an entrepreneur. He was basically the founder of a software services business and essentially been an investor for almost a decade with Bloom Ventures and has seen a number of investments. Next to him, we have Amit. Amit is the MD and co-head of Carlyle India. He brings with him a very strong, rich and strong investing experience of over a decade. Prior to his current role, he was with Blackstone as a senior managing director. and has worked with McKinsey and Unilever, and a graduate of the Indian School of Business there. Carlyle, as you all know, is basically one of the largest investors in the country. I may be off in terms of numbers, but clearly we invested about five and a half odd billion dollars in over 40 odd businesses over the years. Next to him is Nikhil Srivastava. Nikhil is a partner and managing director of PAG, which is one of Asia's largest alternative asset managers there. They manage about $45 billion of AUM and are currently investing out of a $6 billion fund. They have essentially done a number of large marquee transactions. I'm not too sure from a privacy perspective whether I'm expected to name them, but clearly they've done a large number of transactions, and some of those are pretty well known to most of us. Yeah. Next to him is Harsh. Harsh is a partner with Trilegal and the co-head of the private equity private practice. He's seen a number of private equity transactions and essentially been a party to a number of transactions that have taken place in the industry. He brings with him a rich experience of advising private equity funds and companies in the industry. Next to him is Sudhir. Sudhir is an ex-colleague, and he is essentially he's the managing director and deputy CEO of Multiples. Multiples is one of India's largest homegrown private equity funds that has come up in the recent past. Prior to this, he was with ICICI Venture, a long stint at ICICI Venture and Fitch and ICICI. And essentially, he's a graduate from IIT Varanasi and IIM Calcutta. Welcome all of you to the panel, and it's great to have you here. Yeah. Let me begin by first asking maybe Neha, if you could give in your perspective at a global, you see India from a global perspective. And when you see the market, I mean, what's relatively, how does India position, what's the relative perspective? Where does it fit into the rankings? How does the external world look at India?
Hi, can you hear me? Great, thank you. Thank you, it's a pleasure to be here. So IFC, just to give a quick background, IFC is a large emerging market focused investor into private companies. We deploy about $20 billion globally, $2 billion into India on an average every year. And private equity funds is a focus area for us. We've been investing in India for the last 50 odd years. So we've seen India evolve. We've seen India sort of going through its ups and downs, as all countries do. If you look at the recent few years, I think given the geopolitical dynamics and where India is in a structural growth cycle, we see that India is an investment destination of choice. Of course, IFC is not like most other commercial investors. We're a developmental financial institution and therefore focus on cycles and markets and segments in markets when many people are not looking at it. We've been, for example, we've seen the microfinance cycle, we've seen a lot more cycles. And we've developed those sort of markets as well. I think if you take a step back and I were to look at India on a relative basis, India is definitely an investment destination of choice today. Within emerging markets, India is one of the more stable, structurally sound countries where there are a lot of positives, like we have the demographic dividend, we have a stable government, we've had our ups and downs, but I think in terms of the facilities, the infrastructure, we've seen a large sort of increase in that as well. There are certain sort of caveats, there are issues. I think if we see a stable government and policy and regulation, I think India is going to continue to be one of the shining stars in any portfolio for a global investor.
And how do you see this, the acceleration that has been there in the recent past? If you were to attribute some reasons for that, what do you think it would be?
I think if you look at it, you'll have to take a step back to about 10 years ago or 15 years ago, the global financial crisis. That's when people were looking for growth, and there were very few countries which had a democratic government in place where investors were sort of cautious but willing to invest in. And so that's one. We've had a long history of that. I think post 2014-15, after the government has changed, we've seen pro-reform, we've seen regulation changes, a lot more investor-friendly regulations coming in as well. So that's one. And I think the whole relative scenario, right? Within emerging markets, you've got foreign currency has been stable. We've got reserves today which have kept the rupee depreciation to a bare minimum. I think all of these things add up.
Sudhir, if I can ask you to step in here, as essentially you see a lot more LPs in terms of the domestic fundraise, and when you actually talk to investors and you talk to LPs globally, what is it that they talk about? Why does India tick?
So Dinesh, as we all know, finally capital chases growth, and the fact that this is one of the fastest growing economy. But I would still say that even now, despite all the numbers that we hear about $70 billion and so on and so forth, I would still say that we are not part of the capital allocation of all the global pensions, in the sense that we may be clubbed together with some emerging market exposure or some higher potential. But I think for a country of our size, eventually we need to get into, we will eventually get into a position where we get into that global allocation. And when I still meet a lot of investors, there is still that little bit of that India selling which needs to get done about the trajectory that we are on. Questions like the currency depreciation, which I would have thought that with 20, 30 years of track record of saying that we kind of, over long periods of time, you can prove that currency depreciations have been in the range of about 3 to 4%. It never goes berserk. These are questions which still come about. Questions like exits in the Indian market and stuff. This is despite players like Carlyle and PAG, etc., all present here who have done, some of them have been there for several years, have done many exits, but even then these questions still remain. So I would still think that there are a lot of investors who understand the India potential, have come in, who does large deals, multi-billion-dollar deals in the current Indian market. But I would still say that there is a lot of investors out there who have not yet, to that extent, to answer your question in terms of selling to LPs, where there is still a selling required. And I think, and which is what gives us the confidence that even $100 billion or $200 billion, these are all numbers that we will hit at some point in time as we get into the real country-specific allocation for India. Like, for example, I would think that there is an allocation for China already in many of these pension funds. Similarly, India will get there at some point.
Right. And I think interesting you talked about exits, right? And I think if you look at the recent IVCA report in 2021, there has been almost about $43 billion in terms of exits. If you were to go back earlier in previous conferences, say before 2015, lack of exits was always a strong topic for discussion. Are you saying, is that still a topic for discussion, or have investors and LPs moved on to essentially, with all these strong exits, for example, a Flipkart exit or the last year's $43 billion of exits, has that essentially helped assuage that fear?
So Dinesh, what I was meant, there will be a lot of investors who know India well and who kind of cross that hump and they see that there is enough exits that have happened in the last 5 years, but you still find a lot of investors with very limited knowledge of India, for whom still the question is, what are the ways of exit, how do you exit, transactions, and so on. And there is still that education that gets to be done. But the fact is now that you have statistics to back you. About 5-6 years back, you were saying based on a hunch, the size of the economy, the fact that there are multiple ways of exit, that we have a fairly mature capital market. All of these were still a little bit more of hypothesis that you would be showing. Today you have exits of several large IPOs, several large strategic transactions, PE to PE transactions that have happened. So you have a lot of data on your hand, but still you need to kind of cross the hump. And the last point I would say is the last 10 years have been, despite the fact that we have been a growing market, returns that have been made by LPs in the developed part of the world has been very attractive. So all of that also, why should I make this extra effort of reaching out to countries like India still remains. So with many of the LPs, when you're doing all your road shows and meeting people, there is still that bit of India selling that comes in. But I'm fairly confident that these things kind of ease out, and we are very well on the trajectory to say that we will be a very important investment destination going forward. There are so many factors. The last 10 years have not been easy, right? In the sense that the growth has been, while we have companies which have grown, the economy has not really grown to its full potential. We had bank balance sheets, we had corporate balance sheet that was stretched. Suddenly you find yourself in a spot where a lot of these have been resolved. There is a huge confidence among the entrepreneurial system. The way we handled COVID, the way we have put in place the payment infrastructure, all of that, the technology, companies kind of evolving. So there is a huge confidence both
the last 7 or 8 years. And that, I think, is still a problem for global LPs, especially, so there are two kinds of LPs. LPs who invested in the earlier cycle in the mid-2000s and have never seen money return to them. I think they are still not happy because most of those funds are still sitting on unrealized assets, written down assets, and people are stuck. Then there are LPs who are starting to look at India now. And as Sudhir mentioned, I think within global market, within global portfolios, emerging market allocation is, let's say, 1 or 2%. Within that, China used to be capturing 50 to 60% of that allocation, and all other countries put together globally were in emerging markets were the rest of the world, right? And India still doesn't have that single country destination, but with numbers going up, with the check sizes going up, some super exits, entrepreneurs, sort of companies growing and becoming larger, unicorns becoming, I think India is now coming onto the map, and we'll see more exits, and that entire virtuous cycle is now set up, where VCs are finding exits to mid-market Ps, and mid-market Ps are selling to larger PE fund players, and larger PE fund players are able to exit through IPOs and strategic exits. And now that virtuous cycle, I think, is beginning, and hopefully this is just, sort of only set to grow.
I don't want to drag the topic, but I think the short point I would make is I probably carry a little bit more optimistic view than Sudhir. I personally think in the last 3 years, whether you call it the inflection point or people who are fan of physics, the escape velocity to get into a different orbit, I do think India has got into a different orbit when it comes to private equities. You've got $1 billion trade. You know, if you think about exits, you got public markets which are buoyant, it's deep. You got sponsor to sponsor trade happening. You know, one fund selling to another, which was 5-7 years back considered, there's almost like a stigma around it, right? And it's a very deep market today where big funds are transacting at the PE level. Forget VCs selling to private equity. And finally, I would say the financing markets, and there is now a technology around dividend recaps, especially if you are a controlling shareholder. So with all forms, getting capital out, there's proven technology at scale. So I do think, I think on exits, yes, there are always some funds, which is by the way there in the US also, and that's why this is a very tough industry to be. But at an average or at a median, I do think India is broken off that issue.
Thanks. So are you saying, Amit, that the Indian private equity industry is actually matured? So there was a lot of mistakes, as what Neha mentioned, in mid-2005, mid-2000s. You had a number of investors which basically made investments that shouldn't have been made in the first place. And managers have matured, and hence as a result of it, the newer investments that are taking place are actually seeing exits, where there's a lot of old dead wood which is still lying in the system. Is that?
Yeah, I mean, there are various ways to kind of to nuance it, there is no doubt about it. I mean, I often say that we are probably, if you take early 2000s as the years when industry started, kind of the teen years are over and we are in the adult years of private equity in the country, right? And to that extent, definitely we are mature, right? The other manifestation of the maturity, and which probably is a topic which is close to our hearts, where I sit in, is buyouts, right? If you think about buyouts, they're now 2/3 of the market, right, in terms of the dollar deployed in the last few years, and the trend is likely to stay. You see a lot of supply coming in on buyouts, whether it's MNCs divesting, whether it's kind of families asking themselves what's core to me, what's non-core, sponsor to sponsor trade, generational changes, all of it. So there's enough supply. But I think more importantly, and to your point on private equities maturing, if you think about funds being here for a decade or more, funds have built muscle, and this just as one or two. There are a number of funds which have now built muscle to run, operate as a controlling shareholder, right? That's internal through our operating advisors, operating teams. But the one fundamental change which is often not noticed, and I'll pause after this comment, is the way management talent in India has taken up to private equity. I think that is one change which is probably, I would say, underappreciated, but it's the fundamental change which is likely to drive the growth of buyouts going forward and the sustainability of private equity. Because if you step back, I mean, I often tell my team, we either are looking for owners who operate like professional managers, or we are looking for professional managers who are looking like owners, because those tend to be great deals, right? So if you're in a minority shareholder construct with an owner who works like professional manager, great, you got a great partner, right? Or else you're really looking for a class A CEO, on the basis of his or her conviction, you go out and deploy capital. And I think the fact that the top talent in the country wants to work, and we are kind of suitors for, we're able to attract as an industry, that talent is now kicking off this virtuous cycle. People want to work for us or the industry, and on the back of their conviction, we are able to underwrite a different view of the future than the last 5 years, and that's feeding off to our returns, and that cycle is just going on. So I think that's one fundamental trend, and that to me is the biggest symbol of private equity being matured in the country.
Absolutely, and I think buyouts and majority-owned transactions is something that we should talk about a bit more in detail. But I think before I get to that, just want to invite Nikhil, and I mean, you are relatively the more recent fund that has entered the Indian market, right? And I think if you were to just talk a bit about what has prompted that and what has been your learnings.
So I would say one of the things that motivated us to enter India market is really the fact that there's maturation of the Indian PE industry. And by that, what I mean is we are moving towards, as Amit was saying, more buyout transaction. And that sort of is to answer your question as well, like why buyouts, why is it so important? I think as you think about the number of transactions going up and the dollar deployed per transaction going up, one of the things as a PE investor you need to have to build conviction is the ability to control your destiny. And what a buyout transaction in a way allows you to do is basically have control on the value creation through the period of ownership. And the second part, which we were talking about a little bit earlier, was exits. So vast majority of minority investments that were made historically, people struggled with exits because the optionality, the number of avenues for you to exit were limited. You were at the mercy of the promoter in some ways. But as a controlling shareholder, as a PE player, you now can explore more options and maximize and optimize the process to maximize the value of the asset. So I think that was one part of it. I think second, as Amit also alluded to, is the supply of these assets is actually a part of the maturation where you're getting a lot more assets, be it spin-off by non-core assets by conglomerates. You have corporate in stress looking to divest asset to sort of pay down debt. And then you have promoters who are okay with now partnering with PE firms as minority to drive value alongside the PE firms, right? So the supply has expanded. And then the last thing that I would say, again, to sort of build on what Amit said, is the availability of talent. And I would divide that into two parts. One is talent availability, and the other part is talent mobility. So talent availability, if you look at the sectors where buyouts have primarily happened, are healthcare services, pharma, financial services, tech-enabled services. And there, the depth and quality of management teams is very, very high. And therefore, the availability is plenty. Then the question becomes, why is talent mobility important? Because for the longest time, there was high quality talent, but they didn't want to move to a PE shop. But in the last few years, what you've seen is a lot of management teams have really done well in a buyout situation, right? When the PE owner exits, they have had a pretty significant wealth creation opportunity. And similarly, you've seen VC-backed companies where a lot of professional management teams have made a lot of money. And so that then has incentivized a lot of people who were on the sidelines in terms of high-quality management teams are now exploring opportunities with buyout funds to say, okay, I want to be part of it. So I think it's all of those things coming together which has allowed us to effectively participate in this market and be excited about it.
So would you say that a large part of the market would actually grow to be a more buyout or a majority investor-owned market in India? So if you were to sort of crystal ball, crystal gaze, would you say that the market, the larger proportion of the Indian market would be a majority investor-owned market?
Yes. So maybe I would divide the answer into two parts. I think one is volume and one is dollars. When you look at volume, probably it'll be a little bit more balanced. You would have a lot more minority investment because the check size is small. But when you look at the dollar invested, I think you will see vast majority of them actually being buyout because the average ticket size per transaction is quite high. In fact, prior to this, we were having a chat and Amit mentioned, like you do one transaction like Hexaware, that's a large ticket size. And that will disproportionately impact in terms of the dollar deployed. So you will, at least I would expect more buyout and more capital being deployed in buyout type situations.
So, Sajid, if I can bring you here, right, I think clearly you are essentially a growth investor. And I think primarily, as we all sort of won in the private equity space, we said that we were actually backing entrepreneurs. And that was the key exercise. Right.
So
and I think when you look at a buyout and a platform business, you're actually building businesses, which is very different.
Sure. So I can give everyone an introduction on Iron Pillar. We are a growth stage and a late stage venture capital fund. We invest typically, our first check is about $15 million and we add across different pools of capital to about $50 million. So we are a traditional, venture capital fund. We take minority stakes. But to sort of weave into to Amit's point as well, at some point, cap tables need to be cleaned up. And there's several investors, market is mature downstream where you have significant larger funds and sovereigns and pensions, etc. But at some point, older shareholders need an exit, promoter wants liquidity, business goes to a certain size whereby people are like, this could be rolled up into something much larger, so which probably gives a lot of opportunities to other folks on the panel. But maybe I can move into what interests us because, technology is obviously something that the larger firms are looking at. When you look at larger businesses, they grow at a certain percentage rate, but obviously technology companies grow significantly faster, which is why you're seeing the sort of global funds as well deploying capital into technology. And obviously we've seen this change happen, because of COVID, people have, interacted with technology businesses in a very, very different way. We were forced to transact online, whether it was financial services, retail, agriculture, e-commerce, etc. So that's definitely one theme that is very, very interesting, right? Digitization of services. The other theme, obviously, for us particularly, when we talk about what's interesting, is built in India for the world. We saw that, in the 80s and 90s with the emergence of the IT giants. We personally believe that there will be a lot of value which will get created by Indian companies, and we talked a bit about, good talent in India. So we will find that there will be a lot of interesting entrepreneurs that will build businesses in India for the world. One of them is a very, very large, successful company in the US called Zscaler. It's a $40 billion market cap company. The founder had one vision. He wanted the whole back end of the business to be in India and just the front end in the US. So obviously, things like, dollar denominated revenue, large customers, you get the whole arbitrage of Indian cost base is also a very, very interesting theme. So, and obviously going forward, these businesses will mature and have listing possibilities at NASDAQ as well.
Sure. I think technology is clearly an important factor, right? And I think when you look at most buyouts and larger businesses, clearly our technology, I mean, we were just talking earlier, you look at a buyout of software services businesses and a whole host of other opportunities. So clearly technology is going to be a big driver. What I was trying to get to was between minority investing versus majority investing. And where do you see that to be an opportunity? And is that something that would grow?
Oh, absolutely. So there's a fund called Thoma Bravo in the US, done significantly well, and they're focused on software companies and software that they create. You have Vista Equity Partners that focuses on the same as well, and these are typically investors that are control investors. They go out and work with the promoter. They clean up the old cap table. They add a lot of systems and processes that have worked very well for them in their portfolio. So people are graduating into those kinds of deals. We are a earlier investor, so typically you don't have the size of checkbook to do a control deal. But over a period of time, definitely investors find a lot of comfort in actually controlling a lot of where the company goes by having a majority stake.
Dinesh, if I may just add one quick comment on this minority versus majority. This is a very clinical or a transactional way to kind of think about it. But if you just step back, I think where the industry is, and hopefully it's maturing even further, is the fundamental difference is private equity or venture capital is value-added capital. A lot of people ask me that, with public markets, would your kind of business dry up or would the pipeline look now? Maybe in short term, yes. But structurally, as long as as a founder, management team, promoter genuinely recognizes the value add which a private equity or venture capital will bring, I think then the stake is a secondary conversation. Now, what's the best way to bring that value add, right? If the biggest value add is to get a global management team, maybe control is a better stake because, that gives talent that confidence, right? If it is more strategic, more M&A, one particular lever to play, maybe people can do it with strategic minority stake. So I think as an individual or as an industry, I don't think we should be hung upon what's the stake. I think the real question to ask is be kind of honest to the promise of being value-added capital, and whatever is the form of stake which lets you deliver that value-added to that portfolio company should determine what stake you acquire.
No, absolutely. I think, Harsh, if I can, I just wanted to come to you in terms of one, you have seen for the past decade, worked with almost everybody on this floor, right? And you have seen businesses, the change that has taken place from majority to minority to tech investments to platforms. If you were to talk about some of the fundamental changes that you have seen in the way deals are happening, or essentially the lessons to take away from that, what would that be?
So I think this is a reflection of what Amit and Nikhil have just said, which is that there's generally been a shift to buyouts in terms of dollars deployed. And deal terms have roughly gone along with that, although they always trail. We've seen a standardization of deal terms, which earlier used to get debated a lot. There have also been new kinds of tools, instruments, capabilities, which have come in partly through regulation, whether it's in the capital markets, it's yielding type of investments, bankruptcy reform. So the regulatory framework is kind of kept up, but it's by definition a trailing factor. It'll have to continue to keep pace with the change. I would still say there's an element of what we do. I mean, there are some prolific deal makers here on the panel. There's an element of what we do that should not feel like rocket science, but ends up feeling like it. I mean, it suits us as lawyers, obviously, and that's what we tell our clients. I think as the market matures more, for instance, it should not be rocket science to do a take private. It's a very standard, common types of transaction that happens in other markets. And I think it requires a little bit of a shift that private equity actually, or acquirers in those kinds of transactions, actually deepen the market. it should not be seen as taking away a listed company. But by and large, the framework has kept pace. It's a trailing indicator. So wherever the other people on this panel go, the law generally follows.
Yeah. You talked about take private, and I think I just want to bring in one perspective and just get your views. Essentially is that the markets have been pretty buoyant over the last few years. What impact does that have on the private equity deal doing perspective there, and how correlated is that? Anybody?
Maybe I'll start. I think that's what I was alluding to. If you think about it, maybe in the short term there is, one could argue, negative correlation, right? But I think again, going back to your point, if we truly believe the markets are mature, this is a place where they feed off each other, right? How, the fact that, if to Sudhir's point, if exit is any concern, and if you're operating in buoyant public markets, as private investors, we get visibility on liquidity events, right? That where will we divest, right? I mean, last year is a great example. The most kind of robust private equity market with $70+ billion, and I think one of the most buoyant public markets when it comes to IPO. So they do coexist, right? On the other hand, I think when the promoters see some great examples of private equity-backed IPOs, the way they were received, the way their preparedness were, both in terms of the governance and more importantly, the core of the business model, I think it feeds into the private equity market in terms of the sourcing of the deal, etc. So I think they kind of coexist, and in my view, there's positive correlation than negative.
Just to correct Amit, so I never said that. Neither am I pessimistic, nor am I saying that exits don't happen. What I meant to say in the beginning was to Dinesh's question on how do LPs perceive India, and I was saying that there is still a lot of LP population out there which needs to still cross the hump as far as India is concerned. And we do have it. There is a significant momentum that we have been able to say, but we still need to do a great job of selling India. I think that is probably a little bit more incumbent on funds like us, which are raising money for the domestic investment. But that's not to say there is a huge market, and that's been there for a long time to come. It's not that it has happened in the last 3 years. Some of us have been managing funds for over 15 years, and we have delivered exits across cycles, done full fund exits, and so on and so forth. But that doesn't take away the fact that it is kind of given for many of the LPs in the world, and there is a lot of, while there are many of them participating in the Indian market, but there are several who are not yet doing that. The second point on correlation, as far as Dinesh, the fact is very valid that it feeds off each other, and it is a good exit environment that allows you, and each of those, there is no need to segregate buyouts or early stage, etc. Because only when somebody takes out and buyouts does the earlier stage of investors make money, and that's how they raise more capital. So this entire chain has to grow, and if any one of those elements break, then you will find it impacting the other end of the chain as well. So, and in terms of dollar billion, it will always be true that buyouts will be much larger than the earlier stages, because by you're kind of taking a more mature company, you're cleaning up the cap table, you're providing exit to a whole lot of other investors. So it is but natural, but the impact that can be created by the growth investment is still far higher in terms of the fact that you're spurring a whole set of new companies and making that thing. But frankly, I don't see capital markets, what we used to speak about 15 years, that capital markets is a threat for private equity, that a promoter given a choice will first go to the capital market rather than raise money from private equity. That has changed completely. Today, if you look at most of the IPOs, even the minority situations that happen, most of the IPOs have been invested by private equity earlier. So to that extent, private equity is today the first port of call, and many companies which would want to go public would say that I want to raise a couple of rounds of private equity capital, ready myself for a...
That there's a secondary exit by the private equity firm to another private equity firm. And then the other kind of secondary is where the entire private, so there are two kinds of, again, within the second piece, there are GP-led restructurings where they restructure their entire fund and sell off their portfolio to another private equity firm or to a secondary buyer who believes that there is value on the table. And then there are LPs who sell their stake in the fund as a secondary stake to another LP where they need to exit for either strategic reasons or liquidity reasons or any other such reason. So I think what Abhit was alluding to, the secondary of where one investor was, where one PE firm was selling their asset to another PE firm, was a little bit, it had a little bit of stigma where people said, you know what, maybe you're just changing hands, there is not too much of value, who knows what the value is. That definitely is changing. And I think that is now changing because 20 years ago there was no VC sort of segment was non-existent. The buyout segment, there was probably 1 or 2 players in the market who were doing buyouts, and therefore the entire segment was just growth equity across and lower mid-market where the most of the fund managers were $100 to $300 million sizes. That has changed. Okay, I'll just finish my point. So I think that has changed 100%. There is an ecosystem which is built up, and now that ecosystem is just developing for secondary exits of the second kind, where either GPs are restructuring their entire fund because they believe that it is easier and their effort is better focused on doing something else and someone else can manage the portfolio better. And then secondly, LPs are saying, you know what, we've been invested here for too long, we want an exit now for different reasons, and therefore that entire segment is now developing. And I think that again will grow, and that will bring more liquidity into the system for LPs, which will again bring LPs back into the market, saying, okay, we invested, let's say, X dollars over the last 10 years, now we've gotten X plus back, and therefore let us now recycle this capital back into India, into the private equity sector.
Great, absolutely. I think it's been a great discussion, but I think we've run short of time, which is there. And I think I was completely blindsided with the positioning of the timer there, because you can't actually see the time there. I think maybe we need to change the position of the timer there.
Yes, sir, we will. But even if you miss that, you can't miss me.
I think that's no excuse, but I think we've had an exciting discussion. I think if just a quick word, I mean, if we were to have this topic next year, should this be 100 billion or should it be 150 or 200? I mean, are we underestimating the potential? Yes, no.
Maybe I can take that. I think one thing everyone must appreciate is that, you know, investors are in the business of making money. So you actually, if you're investing $100 billion, all of us have, you know, call it 25, 20. I'm not saying this matter of scale, but everyone has a certain IRR threshold they need to deliver. So does Neha, right? So when you talk about $100 billion coming in over a 5 or 10 year period, that money has to significantly multiply. So that is a big question. Certain fund managers don't raise very large funds because you have to have the ability to deploy the capital, return the capital back.
Great. I think we're just running short of time. Just a quick response will be.
No, I think if you look at our P to GDP ratio, it's still, you know, kind of subpar when you compare to Western markets. So 100 billion should happen. Now, when and how, you know, it's too difficult to put a timeline, but it'll definitely happen sooner than later. And I think the $500 billion exit will follow.
It's cautiously optimistic as always.
No, same here. I think we don't know when, but definitely in the next 3 years.
Very soon, Dinesh. Unless we hit some self goals like we are as a country, we are never, it's not very difficult for us to do. But given the normal circumstance, I think there's a lot of stars that are aligned for us. 100 billion will happen much sooner than what any of us anticipate. And why? These are just numbers. I think the fact that that as an economy we will do very well and attract a lot more capital.
The last word from the lawyer.
As the lawyer, of course, I'm the most qualified to talk about the numbers. No, I think Sudhir summed it up well, which is these are just numbers, but I think the trends are here to stay and the numbers will simply be on those lines.
Thank you very much. That was an excellent discussion. Thank you very much for your time. Thank you.
Thank you, Honorable Moderator, for moderating this session. And please stay with us because we must say thank you to you for taking out time and joining us here this morning for the first panel of the day. I request you to please present them with mementos, a token of our gratitude. Let's put our hands together, everybody, for the speakers of the first panel of the day at the Mint India Investment Summit and Awards. Very grateful that all of you have made it here. Yes, sir, to all of them. And once again, I'd like to urge all of you, our esteemed delegates, to post, share, like, comment all that you can, all that you want, using the hashtag MintIIS2022. You can also tag us at LiveMint. And once again, a huge shout out to our partners, presenting sponsor Trilegal and powered by sponsor MobiKwik. So let's talk about cleaning up the mess and fueling the growth. Ladies and gentlemen, credit is the fuel that is necessary to keep an economy firing on all cylinders. The Indian banking system for years has been reeling under the effects of a massive bad loan problem. Corporate bad loans, though, now seem to be coming under control, but over-leveraged corporate balance sheets and the pandemic have put a dent to corporate credit demand, which is picking up pace, but rather slowly. This panel will discuss the role of the banking system, private credit investors, and ARCs will have to play to ensure that the Indian economy does not run out of the fuel to meet its ambitious growth targets. And for the same, I'd like to invite on stage the speakers of this session, Amit Agarwal, Head Stressed Asset Investment, Edelweiss Alternative Asset Advisors. Good morning, Amit. Welcome. Indranil Ghosh, Managing Director and India Head, Cerberus. He'll be joining us virtually. A very warm welcome to you. Kapil Singhal, Managing Partner, Private Credit, True North. Good morning and a very warm welcome to you. Ameya Khandge, Partner, Trilegal. Good morning. Aye, please, come. Ishwar Kara, Chief Executive Officer, Kotak Special Situations Fund. Good morning. Please take your seats, sir. Nachiket Nayak, Head Corporate Lending, Arka FinCap, will do the honors of moderating this session. Good morning, sir. And I hand this over to you. Ladies and gentlemen, before the Honorable Moderator begins this session, I must request you all to please settle down and take your seats.
Okay. Thank you, everybody. And the title of the session reminds me of a very interesting dialogue which the Fed chairman, Ben Bernanke, actually made to the US Senate when he was begging of them to pass the TAR bill. And he said, credit creates an economy, but lack of credit can pretty much destroy it instantly. And we are pretty much in that ballpark where if you see over the last 2 years, and I'll spend a couple of minutes opening the session with setting the backdrop, we've seen initially demand to be pretty crunched given the pandemic and the uncertainty around it. And now hopefully we are beginning to see a good revival, and consensus seems to suggest that we might just be revisiting Capex Mahotsav, as some people are calling it. On the supply side, interestingly, we've had a spectacular run in the equity markets with all-time highs being hit. Very often people questioning why it was so, but so be it. On the credit side though, which is the other source of capital for companies, initial part rather muted, expected to be so with the amount of risk aversion that we saw. But now we are at that threshold where if you are seeing a confluence of expected growth and equity having played its part, the ball's in the court of the credit providers. And that's what we'll probably spend some time on, getting a sense from the esteemed panelists here by way of how are they reading into the situation. First, by way of the likely demand for credit, and then of course coming to the sources, where are things placed, one by way of the conventional sources, and then also by way of the newer platforms that a lot of the panelists kind of run and operate. So let me open this up by way of getting a sense from the panel, and we'll keep it as open-ended as possible, by way of getting a sense from them of where are they seeing things from a macroeconomic environment perspective, and then coming to sectors by by way of certain key drivers of Indian economy, whether it's commodities, whether it's industrials, whether it's the clean energy, which has been the flavor of the last few months. The newer age platforms, are they credit ready? Are they likely to be off-takers of credit? So let me actually go, why not, offshore to Indranil and get his sense by way of his vantage point in Singapore, how he's seeing the India story unfold and what's it holding for people outside.
Good morning, everyone. Glad to be joining you guys remotely and hopefully next time in person. I think India remains one of the key economies that global credit investors or alternative investors are focused on. And definitely a market where most investors feel that the regime is such that one can operate through various parts of the capital structure. The previous panel spoke about equities. The panelists here have participated in senior secured to sort of mezzanine to distressed lending, and we've seen over the last 5 years all parts of those capital structures being reasonably successful for investors, especially foreign investors, and hence we feel that India continues to offer a significant avenue for most foreign investors to continue investing further in the credit space. One of the things that Nachiket mentioned was clean energy, and that's definitely something that is of great interest to foreign investors. We've seen in the past foreign investors taking actually a lead in the space where they've sort of seeded a bunch of platforms which have now scaled up. They've been extremely successful, resulted in reasonable returns. And hence, foreign investors continue to be further attracted to the sector and continue to deploy, again, across the cap stack for clean and renewable energy. Why don't I pause there and pass it back to Nachiket?
The financial sector in India is concerned. So specifically to get your sense, given that the financial intermediaries pretty much funnel credit into end users, how are you seeing that space, one, by way of some of the existing platforms changing hands with players like y'all, and the sector in general by way of a credit demand and supporting growth point of view?
I think as far as the Indian financial services sector is concerned, it's actually gone through up and down phase over the last 3 to 5 years. And I think is now coming to the end of the tunnel where the light is clearly visible. People have either provided or resolved for distressed assets and have now sort of moved on and are slowly but cautiously restarting lending. And I think that's going to be actually, from a foreign investor standpoint, I think that's going to be a big challenge for us, given that we see banks and NBFCs will start sort of competing for the credit pie much more aggressively over the course of this year, which has been missing in the first half. But we also feel happy about it, given that the market sort of depth increases and it enables us to do more where our risk capital is more appropriately suited. We also think that transfer of some of these platforms to investors like us enable these platforms to get recapitalized and sort of get back to either resolution if this is a pool of stressed assets that are being passed on by because resolution also ends up needing additional capital, cannot be done in a void. And also where platforms which are performing credit platforms are being transferred, hopefully foreign investors bring in further equity capital to sort of create much more investable capital across the space.
Let me now open it up to the investors on the panel or the credit providers on the panel and get their sense on the traditional sectors which have driven growth and credit demand in India, call it commodities, call it industrials, call it infrastructure. So just open house, Ishwar, Kapil, Amit, your views on these 3 or 4 sectors.
Thanks. Hi, Daniel. Missing you around here. The way we have seen our fund play out, we raised $1 billion in 2019, largely to address the distress and special situation landscape, which at that time was pretty robust. But as we went along, we saw that either a large part of those NPLs have been resolved through strategic buyouts or through other financiers who have come in, and also thanks to some delays in the IBC process, etc., that the market had soon changed. And credit, which was usually the structured credit, the wholesale credit space where NBFCs, credit mutual funds, etc., were playing a large role, they kind of had their own issues, and most of them have either closed down or they have gone slow and moved to the retail space. So this threw up a lot of opportunities for us. And as we speak right now, we've deployed around almost 90% of our total corpus. And of late, we see that the nature of the transactions are more in the growth and the development space, rather than in the distress or the special sits kind of space. And with that background, we are on the road to raise our next fund. And we are looking to call it a strategic situation fund rather than a special situation fund. So I think that's the way the market's going right now.
Kapil, how are you reading? You all also are in the midst of closing your fundraise. What are you reading into investment opportunities? And again, any specific themes, sectors that you see appetite in?
Nachiket, the way I feel about, let's say a couple of big picture comments on India and the way I've seen it evolving. And I speak from a credit perspective, not from a general. I'm no expert in Indian economy, but I do believe that having built a career over 30 years in credit, I can speak with some confidence on, how I see the credit market, emerging. The way I think about credit is there are 2 things that are definitely changed for India, and they're all for good. And I think that is the fundamental basis of why I've continue to be so bullish on Indian credit. One is there's a lot of criticism, Nachiket, on IBC, but the fact is this has given the comfort of any domestic or international investor to have a basic downside protection, which is the fundamental basis of giving credit. Till now, credit has been thought of as, as somebody described, I was meeting somebody recently, has said that, whenever he feels like he'll give you the money back. That's how, mostly, sophisticated, savvy investors have thought of India as credit. IBC has put a fear of God in the minds of Indian promoters. It is still a long way to go, but it's one of the most seminal shifts that has happened in India. And I'm sure Amit, Ishwar are beneficiaries of this, as they have seen attracting a lot of money in the Indian credit market. So that's number one. The second is in terms of the second problem with the Indian credit market has been there were a bunch of governance issues that prevailed in the Indian corporate sector. And I believe that the way government, the way regulatory authorities, the way IBC is set in, the governance standards of Indian corporates are constantly on improve. What it has done is, it has given a lot of opportunities on the distress side for the last 3-4 years. It's given a lot of opportunities on the special sit side. We are seeing a lot of refinance opportunities coming out of the NBFC, mutual funds, and the banks. They were the 3 main components of providers of private credit or credit in the past. We believe the time is now for these, kind of segments to now move into the AIF sector. Primarily at the back of good governance standards, primarily at the back of IBC, and the events unfolding post-ILNFS, post the Yes Bank, post couple of mutual funds which ran into the problem. And structurally, we believe close to 3 lakh crore of supply in the private credit market has been disrupted in the performing credit side. And I think that's a huge number. If you look at the total funds, Nachiket, that are there today operating, a bunch of people raising money with us, but the total supply is less than 30,000 crores. So I believe it is set extremely right for the way the market is set up today, and we feel extremely bullish in the performing credit category, special sit, real estate, distress. Fundamentals of credit have been set right. I think that's most important. We'll love to play all the categories going forward in future, but we believe performing credit market in the current stage is set in the right space. Starting with refinancing, and as the capex cycle will pick up, this is going to be a lot of growth financing as well.
Okay, cool. Amit, you all run products by way of funds across various parts of the capital structure. How are you seeing each of these dynamics play out?
No, sure. I think in our understanding, credit is very important for the economy. And I think we have a fair bit of growth coming our way. And if that growth has to come in, credit has to play an important role. In my view, we look at credit in three large buckets. One is the traditional banking credit, then it is the shadow banking or the NBFC credit, and then there is private credit fund. Within private credit also, we distinguish between performing credit and special situations. And I think each of them has a role to play. I think India today is having a sort of a very weird is not the right word, but it's a very strange yield curve where people with higher ratings get fairly cheap amount of capital, but even mid-market companies or slightly lower rated companies find it difficult to raise capital. And flexible capital is the need of the hour when you go for financing growth, while the traditional banking system is more attuned to normal credit. If you see, the mainstay of credit growth has been retail, which is, I think, almost double digits, 14% odd of year-on-year growth this year. Thankfully, the wholesale numbers are also reasonably good for December at 9%. But the fact is that if credit has to grow exponentially, then a large part of that will have to come from private credit, because the non-banking finance sector will only finance a limited amount of capital of type of flexible capital that we need. I think on the private credit side, yields will continue to remain a concern, because I think the private credit markets needs almost a 400 to 500 bips spread from where the banking credit comes in, even on the performing side. Obviously, for special situations, the yields are higher. But even for special situations, today, the stock as it stands is in excess of $100 billion, which is not a small stock. So there will always be a requirement for special situations financing to basically recreate value in a lot of companies. And in India, to create infrastructure is very difficult. So a company which has created infrastructure, the best course of action for the banking sector and the economy is not to let those companies go into liquidation. So we see annually at least $5 to $10 billion of deployment across private credit in various spectrums. Obviously, the banking credit will be much larger and much higher, but again, it will be more towards the highly rated companies. That's how we see.
Sure, sounds good. Coming to the person who kind of has seen how this, what Kapil mentioned, if I can say, a change in behavior of borrowers fructify in the last 4 to 5 years. Amay, how have you seen this dynamic play out by way of how borrowers used to feel it's a luxury to repay debt to now feel it's more a sword on their head? What have been these legal changes? What have been these regulatory changes? Where are you seeing things kind of now settled by way of the environment, at least from credit being appreciated by the borrowers, or are we still some time away?
No, I mean, definitely. I mean, when Kapil was speaking, that probably resonated very closely with my own thoughts on this. Clearly now, the market is very, very different and very, very significant, seminal, as Kapil put it, right? We've got, I mean, there was a point in time where borrowers really, despite statutes like SARFAESI, DRT and whatnot and what have you, borrowers really had the upper hand given the kind of litigation timelines that people were facing, right? As long as you had status quo in your favor, you were basically negotiating endlessly with creditors. I think the two things that have changed are, I mean, there are 2 or 3 things that have come and sort of come into this confluence. One is, of course, the fact of IBC, where lenders are in the driver's seat. Point number 1. So that's a big negotiation shift. You may say whatever you want, and I agree with him that on the timelines or whatever, but the rules of the game have changed. Today, a borrower knows that he can lose his company come what may. And I think that alone will change behavior to a significant extent. The second very important thing, which has never happened before IBC, is everybody is on the same level playing field. You know, whether it was SURFACE, other statutes, you could always pit one class of creditors against another. You know, certain kinds of credit will always be circumspect about coming in because they don't have the same set of rights. Now, IBC, whether or not you pursue it, has brought every creditor, whether secured, unsecured, domestic, you can come in through AIF, FPI, bank, and you're all on the same footing. I think, so, I mean, while it creates its own conflict amongst creditors, the fact is that this remedy is available universally, and it makes the supply of that credit so much, in a manner of speaking, easier for the borrower, because it's now just more bankable, right? So definitely, I think the third part is, of course, accessing foreign capital now. The regulatory regime has never been this favorable. You know, historically, you needed banks or NBFCs. You needed to be regulated entities in India. You had foreign sources of capital which are highly regulated through ECBs. Now, if you just look at the spectrum between the AIF window opening up, between ARCs being able to do more and more on the distress side, with ECBs becoming more and more liberal, today it is fairly easy to get foreign sources of capital in different currencies into India for a range of purposes which are much wider than were possible. So yeah, I think borrowers, the right borrowers, have access to different pools of capital, different sort of, at different parts of the capital structure, depending on the needs. It's all there. And
good. It looks like the honor of the contract is kind of falling into place between the creditor and the debtor. So that's always good to hear. I'd like to now shift on to the supply side by way of the platforms delivering credit and how they are placed currently. Before we come to the alternate platforms, I want to spend some time and get your sense on the more conventional, and if I can indulge and say boring platforms of banks, bond markets, and probably NBFCs, the few that are still left on the corporate lending side. By way of how you see them, they were in a fairly risk-averse mode over the pandemic, and rightfully so. But are you seeing them far more gearing up to open up pockets to fund the growth that's likely? Liquidity, of course, is pretty awash, so that's something which the central bank has ensured. But are you seeing that risk aversion going away and hopefully their ability to step up to the plate coming back? So again, three of you all, what's your sense on each of these markets? Ishwar, with you first.
I think if you look at the credit offtake numbers, which have shown a decline actually, as a percentage of credit to deposit ratios have come down. Also, if you look at the ratings of the corporates who have actually borrowed, more than, I think, close to 97, 98% is only to all the AAA rated. So it is a very bipolar. So while credit is available, money is available, but it's going only in the direction of the superior, so-called superior high-rated paper. So then what does the rest of the market do? So the rest of the market is where the NBFCs used to play a very large role. The debt mutual funds also used to play a very large role there. But with them going very slow, I think that's where the key opportunity will come in. And that's where we come in. And that's, as Amit said, there's a 5% arbitrage over there. And if you were prepared to take some kind of equity risk as well, you can bump that up by another 5%. And that would give us the kind of hurdles that each of us in our respective funds look for.
Okay. Kapil, you have been a part of an NBFC before, your current avatar. How do you see their role kind of evolving and settling in this new day?
Indulge me, this answer could be a little longish, because I've lived an experience of almost, couple of years in a largish NBFC, plus, we are in the fundraising mode now. We've been thinking about what's happening in the market. The way I think about Nachiket is that NBFC model and then subsequently mutual funds have supported the growth of private credit in India. There's nothing wrong with it. I mean, as you're developing a country, as you're developing an economy, somebody has to support. You can be all critical about it, say that, they were not the right structures. But the reality is that has given a fillip, and we've created a 3 lakh crore kind of financing between the NBFC banks and the mutual funds. The fundamental mistake, I think, which happened in the NBFC, Nachiket, was the fact that it is a levered, it is a rated, and it is a regulated vehicle. And what it does is it creates wrong incentives for the well-meaning, good managers sitting in NBFCs to do the wrong things. There's nothing wrong with the people who have managed those businesses. It is very simple that when things go wrong, the fundamental basis of credit is you need to take action. But instead of taking action, if one starts to think, what is it going to do with my rating? What is it going to do with my leverage capacity? What is it going to do with my regulatory capacity in terms of what my net NPA ratios are? And I've seen this and I've lived this. The reality is structured credit, nuanced credit, anything which is out of ordinary, anything which doesn't repay on time should never have been done in regulated vehicles. It should have been done always in flexible vehicles where you can protect downside by taking quicker action where you have the right incentives. Look at where we are today. We have 3 lakh crore of supply which has been impacted. Even before that, before we go to the big picture numbers, the second problem was the NBFC models evolved where all of them wanted to list. So the zeal to create asset books, the zeal to create higher AUMs was a supreme kind of need for the hour. Look at the way they borrowed, or they raised money from their for deploying in assets. They borrowed from the bond market, they borrowed from the bank market, and they borrowed from the equities. That's the 3 sources of capital. Equity was a flexible capital, and there you could deploy anywhere you want. From any money that came from equity, you could do any structured trade. Bank was fairly inflexible capital. So look at the whole behavior. You borrow from banks, you are an NBFC, you're regulated, and then you go and deploy in non-bank assets. Third was a more flexible form of capital, which is bonds. Bond market is today shut for NBFCs beyond any corporate-backed NBFCs. People are saying that unless you are a corporate house, I'm not going to give you many beyond 3, 4, 5 years leverage. Maybe the good times will return where you'll be able to raise cheaper financing, because that was the fundamental basis of an NBFC model. Leverage the book, live with the regulated issues, and lend cheap and create a larger book. I think that model is finished. Where we are today, the NBFC model is going back to being a liability model. They will take risk on the asset side, they will do small trades. 2 of the largest NBFCs today, which we kind of deal with, their maximum ticket sizes on individual corporate trades are less than 50 crores. They can potentially write a 1,000 crore check given their SBLs, but they are doing less than 50 crores. So while NBFCs are coming back to the market, but they're not coming back to market in a meaningful way. And Nachiket, you and I have spoken about this several times, that the way to then do the NBFC market lending is to form a club and keep the exposure size small and then do this financing. I don't think anybody's going back to the era of booking a $100 million trade in NBFC. It's not going to happen. Mutual fund markets, you look around who's raising money today. Some of the AIFs, some of the manager entities of the mutual funds are today in the market to raise money in the AIF format. They've become very clear that an alignment structure where a single bad news can, in a newspaper, can create a run on the mutual fund is not the right structure. I don't think mutual funds did anything wrong, by the way, in terms of asset quality. What they did wrong was the fundamentals, booking structure of that entity. And I think this is exactly the point I was making earlier, that stage is ripe today for an AIF. It's going to take time. But today, if you look at the number of AIFs being raised today, I think we are very excited by that.
Perfect. I mean, bond markets, they were always meant to be the promise and the balance, if I can call it that, of the banks. Have they been able to play credit? Were they the right places to play credit, especially after the 2-3 episodes that Kapil mentioned? Today, are you seeing them meaningfully play credit? Where do you see them supporting the system from a growth point of view?
So when we talk about bond market, I think we talk about the entire spectrum of bonds, right? From retail bonds all the way to a private credit or a special situations bond. And again, the range is fairly wide. I would say that, as Ishwar rightly said, that 97% plus funding is to AAA rated corporate. For them, raising the bonds is not a big challenge. The real bond market will come when the depth is there across rating spectrums. And that will happen only over a period of time. That has not happened as yet. If you see, the entire private credit business is happening through bonds only. Most of the investments are either happening through, let's say, a pass-through certificate, or happening through a direct NCD or convertible bonds in some cases. but there is not enough liquidity in that system. And it becomes very difficult to underwrite companies as a bond market investor. And I'll give you an example on a no-name basis. We had a corporate which we had financed at a fairly high, double-digit rate. And over the last 5 years, they have kind of come out of the shadows and they have continued to be with us because of flexibility. We wanted to sell that bond off in the market, and we found only so many buyers interesting or excited about that bond, and finally we were able to sell 1/3 of the bond out in the market at fair price. But the fact is that there is, if I put that on the exchange, a good company, 1:3 debt to equity, good sector, will that bond automatically get traded? I think the answer is no. So I think it's still a very OTC market, a very 1:1 market for sell down of these credit bonds. So only when the market expands, when there is enough information, the exchanges, the listed exchanges, the rating agencies are doing more, the bond market is doing more, and it gets a depth. That is when real junk bond market, as I would say, could potentially get established. And that is some time away, in my view.
Perfect, thanks. Indranil, FPIs have been fairly active, both on the single-digit pricing side, especially given what's been happening on the soft interest rates globally and on the forward curve. Do you see that dynamic continuing, given the fact that global interest rates are likely to rise, and with the whole conflict situation, currencies seem to be in turmoil? Before coming to, of course, the alternate credit, like where funds like y'all perform, just wanted your sense on more the rate-driven investing that FPIs have been doing.
Yeah, I think as far as FPIs are concerned, interest in the India markets will continue to be fairly strong. And in fact, if anything, a lot of special situations investors like us are now going to slowly start doing growth credit, as well as low single digit, higher quality financing. And that's a space where if you look at what's happening with global alternative asset managers, right, who are trying to sort of grow their AUMs, they've realized that special situations is a great place to be in terms of IRRs that you can make. But opportunities in today's environment, where the world is flush with liquidity, still flush with liquidity, is few and far between. However, they have also found markets, India being one of them, where they have gotten comfortable with the local dynamic, the regulations, the way resolutions happen, and they have had the opportunity to look at a host of counterparties and come to a conclusion as to who they like and what segments they want to play in. And hence, we think that a lot of FPI interest will continue. The traditional guys who were doing the high quality stuff will continue to focus there. I think green financing is a big avenue for FPI who want to check the ESG box, and no better country than India, where growth and clean energy growth itself is pretty robust. Alternatives like us will now start doing financing for both growth and also for opportunities where the traditional banking sector is probably restricted from providing financing, or has to form a consortium to fund a big project vis-a-vis someone like an alternative investor who can potentially write a fairly large check as a single sort of counterparty, which brings additional flexibility to the table. So I think as far as FPI flows are concerned, despite the increasing rate environment globally, which will obviously translate into some pricing adjustments locally as well, we will continue to see significant participation from FPIs.
If growth is coming back, do you see the change in the nature of deployment of fundraise now moving from picking good value to now actually supporting new money or genuine growth?
I think each fund will have its own way of investing, and as I said, all the markets are large enough. Today, I don't think there is too much dry powder on the special situations side. I think overall, Even if we look at all the focused India funds looking, I don't think there will be even $5 billion of capital chasing the opportunities on an annual basis. And while the stock could still be 100 billion plus, as I said. So I think people will keep finding interesting opportunities. Are there size, if you talk about size, the size of opportunities is larger towards growth and capex oriented opportunities. You could do maybe even 300, $400 million deals. But on the stressed asset side, deals in the range of 50 million to 150 million will continue to come into the market. And focused funds like us, we are raising another $1.5 billion fund, anywhere between $1 to $1.5 billion. And deploying that over a 3-4 year period time is not very big challenge, because as growth happens, NPAs also happen. I think they're necessarily a byproduct of a very fast growth. And since funds have 4-5 years of horizon for investing, getting opportunities is not a problem in that state. Having said that, I think performing credit will have its own special opportunities. And all this bucket is, as Indranil rightly said, is what traditional banking cannot cover, and what, let's say, the NBFC sector has now completely vacated either the space or reduced participation in that space. So yes, this will continue to be a largish opportunity.
Okay, good. Kapil, you've, again, just in the midst of closing your fundraise, one is traditionally a lot of alternate credit has been supported by offshore institutional LPs. Just wanted your sense that given a large part of your fund is domestic, smaller ticket money, if I can call it that, do you see that constituency of domestic non-institutional LPs, or hopefully institutional LPs domestically beginning to get far more attracted towards these alternate credit platforms?
So from a domestic, I think the question is around whether we are getting enough interest on the domestic LP side, right? My two-bit on this is, if you look at international landscape, and I'll just try to correlate that with the domestic landscape, the largest deployers of money are pension funds, endowment funds, insurance companies. And if you look at the way, and if you think about it, I mean, the fundamental question that has always bothered me is why the same set of guys do not finance the domestic, why that they don't comprise the domestic supply. And the answer lies in the fact that the government has been very careful in regulating these institutions and allowing them, or not allowing them rather, to kind of deploy in riskier assets. And the more I see, if you look at the way insurance regulations have moved, the way pension fund regulations are today moving now, I think the government is making all the efforts to make sure that it is enabling the boards and the management of these companies, these pension funds and insurance companies, to invest in these asset classes. The bigger question, Nachiket, remains is whether these guys, the managements of these companies, are still ready to invest in these asset class. And what is the track record? What has been their past experience? What are the learnings and what are the kind of, let's say, bad experiences that these institutions have had? Having said all that, I think on the whole, my experience in the last 12 months has been that there is a general kind of acceptance of this asset class in the domestic institutions, especially the insurance companies. And we've got a lot of traction from insurance companies. We believe even the pension funds, going forward, as the pension fund market develops, as, I don't know how much, you're aware, but what I understand is pension fund is today growing at about 20% per annum. It's a huge, you could be having a third of supply coming from a doubling of the entire pension fund market in the next 3 years. So I believe there is a whole world that is emerging in the domestic supply of institutions, and that again is a big area of, kind of excitement and enthusiasm for us.
Okay, yes, cheers to that. Ishwar, the ARC model, given that now we have a national bad bank and we've got a change in regulation where now another category of AIFs has come into the picture, what do you see by way of their value addition, if I can call it that, or business model that they can cater to going forward in light of the change environment?
Yeah, Nachiket, I'll take that, I'll break that down into two parts. One is the NARC. So the NARC per se has been formed to take care of the larger assets and also in helping, aggregation of debt. So the way I see it as an AIF is that he is actually going to be a great, boon for us, because the biggest problem which I can see Amit smiling, is it takes us at least 2 years for us to aggregate debt. And it's quite difficult to be sitting over there negotiating with each banker all the time in consortium meetings. And I see the NARC helping us a great deal in doing and achieving this, because they will act as an aggregator. They would pick up this debt at whatever clearing valuations. And then people like us would then bid for these assets and then provide resolutions and solutions either in the form of growth capital or one-time settlements, or we could do structured transactions in the sense that you allow the NARC to continue with that asset on the debt side, restructure the debt, right-size the debt, and we come in for growth either in the form of equity or structured debt or plain equity, mezz debt. We could play across the capital stacks. So therefore, I see the NARC as a great boon for us, and we are really looking forward to engage with them. The second is on the other ARCs. I think that's what you want me to address. The other ARCs will find their own space. They have been active, and with the new regulations which allow AIFs and other body corporates also to acquire debt, water will find its own level. There was always a dearth of capital in that industry. And I would see, most of the ARCs moving into the retail segment. And as we see it right now, the arbitrage on the 1585 scheme, etc., has all gone. Today, it's become more of a cash market. Some NBFCs, of course, continue to be selling to ARCs on 1585 basis, but I think that will also, go away. And it will become a largely cash market. The ARCs, that is apart from the NARC, will play the retail and the smaller ticket space, whereas the NARCs and the funds will start, picking on the next cycle of NPLs that we create.
Yeah. Okay. Wrap-up comments. First, comment to you and to Indranil. Anything you want to see different from a legal or regulatory perspective to ensure that this time round we don't revisit issues of the past? Amay, first to you and Indranil. From a legal and regulatory perspective. Yep.
Yeah, I mean, very quickly, I'd like to see stability and predictability. I think just that's my takeaway. I mean, we have these avenues, for example, the unavailability of VRR, for example. We've got the route, and for suddenly 5-6 months blindsided, you don't have the route available. So stability and predictability, I think, will go a long way, even on the existing set of regulations.
Indranil, from your side, from offshore, anything that you would want different?
So I think we are making reasonable progress. One of the things you mentioned was AIFs for special situation funds. While that regulation is quite encouraging, there are still certain issues which kind of render them difficult to use for foreign investors. Similarly, gift city regulations evolving, that's an interesting space that we are sort of watching out for. But for all of these, I think we need to have a couple more rounds of iteration so that these become actually usable routes. And hopefully we will see the regulators and the government kind of act on these suggestions that have already been put up very quickly.
Last question to the three gentlemen on the table here, on the dais here, sorry. They say we are revisiting the golden era of 2004-07, right? With abundant growth, if I can call it that. Unfortunately, people tend to forget that that was followed by 2008 and the three-deaded words of GFC. Any advice to both borrowers and lenders so that we don't, again, revisit ghosts of the past? To all three of you, so take your pick.
No, I think the only advice would be to just keep your leverage in check. I think that has been the bane. Because you can have events which are outside of your control, just like the Russia-Ukraine war, sending the commodity prices and so the working capital into tizzy. So keep your leverage in check and don't basically make capacity expansion plans in a way that all capacity comes again together and hits the market and there's no demand at that point of time. So I think just a fair assessment is helpful and just keep things in more context.
Kapil?
I'll again speak a little more thematically from an investing fund manager perspective. The biggest pressure a fund manager faces is, what is my peers doing? How much are they investing? And why am I not doing the same thing? And that is the pressure I think all of us need to take care and make sure that we do the right things, despite all the growth that is happening in the market, and we do end up doing the right things. The second reality, Nachiket, in the market is that we are all in the third-party business. We are no longer investing out of our prop books. A mistake that I make is going to impact the Ishwar's raising or Amit's raising. They are bigger guys, but even what mistakes they make is going to impact the entire market. So I think if, as a community, we meet often and we do all the right things, we end up doing something good for the industry is what I would want to take away from this conference.
Oh, okay, great to hear. Ishwar, last words to you.
Yeah. Learn from your old mistakes. Don't repeat them. There are always room to make new ones.
Here's to new ones then. Thank you very much, panelists, and thank you for the crowd for an engaging discussions. And like I said, hope we revisit the 2003-07 era and don't end up in the 2008 era. So over to you. Thanks for that.
Thank you to the moderator for moderating this session. Amit said, keep your leverage in check. I'm here to keep the time in check. That is why I come and take my position a few minutes before. I'm going to request you, sir, to please say thank you to our honorable speakers and present them with mementos, a token of our gratitude. Ladies and gentlemen, can we all put our hands together for them, please? I request you all to remain settled down. We're going straight into the next session. Thank you once again to all of you for enriching us with this panel. This next panel coming up, ladies and gentlemen, the topic of the next session is my most favorite one in the whole world, the green economy. If you really think that the environment is less important than the economy, try holding your breath while you count your money. The environment and the economy are really two sides of the same coin. In the future, we cannot sustain the environment. If that happens, we will not be able to sustain the economy either. Taking all things environmental, climate change is inarguably the biggest global challenge that we face today. India has made huge commitments to cut its emissions and transition itself to a more green economy. Amen to that. Let's talk more. I'd like to invite on the dais the speakers of this next session. Kavita Saha, Managing Director, Infrastructure India, CPP Investments. Good afternoon. Aye, please. Deep Gupta, Managing Director, Macquarie Asset Management, Co-Head of Southeast Asia and India. Good afternoon and welcome. Nagesh Basavanhali, Managing Director and Group CEO, Greaves Cotton Limited. Good afternoon and welcome to you too. Chaitan Maini, Co-Founder and Chairman, Sun Mobility. He will be joining us virtually, ladies and gentlemen. I'd also like to invite on the dais Neeraj Mohan, Partner, Trilegal. Good afternoon. Are you please? And Utpal Bhaskar, Chief of Bureau, Mint, is all set to moderate this green session. No stop, no look, just go, 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 go green. Here comes, according to me, the most important panel of this summit, the green economy.
Thank you. Yeah, thanks a lot. Thanks for making time for this. There couldn't have been a better panel than this to discuss this. I've been covering this space for a few years now, and from a time when green used to be more like a CSR kind of an option for companies rather than a pure play business. And how has the world changed? It's from the commitments that we have made at COP26. And these are not only commitments that they have been made, it's absolutely intrinsic for us to follow through if countries like ours need to have their position at the global table as well. Thanks a lot for making out time for this, and obviously the hall here is here to listen to you. I'm only here to moderate. I would like to start this discussion with Kavita. In fact, from your early years of investing in green in this country and infrastructure, how has this been for you, the experience, primarily because obviously we were having this chat a minute back where he said that problems, one of the refrains was the problems remain the same, nothing much has changed. Or has it changed actually?
So thank you, Utpal. And I would say that what has changed is the scale and scope of investments, the direction of investments. I mean, when I started investing in India, I mean, I was investment banker for many years before that, but when I started investing, people were still investing in coal-based power, you know, and from there, I think we have seen a sea change in the availability of opportunities in the green space. So I think one is how the direction of what is available has changed. Nowadays, I think everybody talks about investing in green power, but you see very few, or if none, which come from the regular channel in old, you know, the fossil fuel-based power. Secondly, when renewables actually even started as an opportunity, the individual size of the projects was very small. I still remember a time in 2006 on advising a project which at 120 megawatt was probably the largest renewable power facility in the country. And now you are talking about hundreds of megawatt, gigawatt scale projects. And commensurate with that, I think the size of the investment opportunity, you know, where there is a lot of capital which is wanting to come in and invest, and you have projects which are of that scale where capital of scale can come in and invest. I think that's the change that we have seen.
The scale. What about the problems? The problems have been the same, or have they changed? As in, has there been some kind of a, because the government says, at least from the part of the government, that there's enough traction and all the impediments have been removed. Has that been the case? Because you are the guys who are actually putting money where what you're talking about.
I would say that the problem which still continues to remain to some extent is that of the financial health of the DISCOMs, and who are ultimately the counterparties to most of these projects. But even then, I think that the problem has been recognized, and while you know there have been announcements by the government to address the financial health, the tangible step that they have taken is that now you have the federal entities, you know, the NTPC, the SECI projects, which are actually trying to take the role of the counterparty, give a measure of you know, confidence to people who are investing in these projects, and thereby increasing the credit profile of these projects.
Right. So obviously, DISCOMs being, there has to be someone who pays you for the bills that are being raised. Also, green per se, earlier the landscape was all about solar, wind. Now, this landscape is also very rapidly changing. So there's storage, there's hydrogen, there's green hydrogen. We are talking about RPOs. Deep, I wanted to get your views on this in the sense that when you go overseas, when you talk to people around the world, how do they perceive this green economy story for India? Because as she rightly pointed out, someone has to pay for what is being out there. It cannot be more to do like a intention which comes across very well for the climate. It has to be sustainable economically as well, and also obviously for the environment as well. So in your interactions with the investors globally, how do they perceive our green story?
I mean, if you look at the world, I think there are three regions which kind of drive a lot of innovation. I would say US, China, and India. And so India is always on the radar. It's not something that people are not looking at. Everyone's looking at India. There is a start and stop which happens in India. So if you went back and looked at the infrastructure investments that we did earlier, and by we I mean the investing community, people who are foreign investors who are coming to the country, you would see that they face challenges in the greenfield side of things, right? And so people have evolved their strategies to say they can be brownfield. which does mean that a lot of infrastructure capital would like to see some certainty around regulations. Unfortunately, it's not possible, and I agree with you. The green economy bit is not just renewable energy; it's green hydrogen, it's transmission assets which come, it's waste to energy, waste management. Everything gets covered in that green economy. So I don't see any reason for why investors would not look at this. A lot of our limited partners do ask us questions about what we are doing with this, and so there's a lot of interest. I think the change is that you will have to tailor the capital, and I think everyone can understand that. You'll have to tailor the capital to the respective sector. So if there's something which requires $20 million of seed capital to start the business, for that you'll need a different kind of capital. If you are looking at an operating solar asset, you'll need a different kind of capital. So as a shop, Macquarie's and my business, Macquarie Asset Management, is just making sure that there are different pools of capital with investors available. They are available, I think, at different costs and different risk profile. But to be fair, it's very positive. I mean, my view of what's happening in India is very, very positive. We are one of the economies which is driving a lot of innovation globally, and people are watching us. So I expect a lot of capital to flow into pretty much everything that we've talked about, but especially in green economy.
Right. So transition is the big story of our times, and in corporates have been, so in my limited conversations, we find that there is this huge focus towards how, so for example, there are large industries, large captive power projects. You then want to get onto this because obviously it's also cheaper as well. You don't want to depend on a grid which is expensive. I wanted to get Chetan into this conversation. Chetan, you were the guy who saw it all coming, right? I still remember the vehicle. In fact, it was absolutely, some would say that it was much before its time, and then maybe Tesla caught up. So, the story that's unfolding right now in India is the story of energy transition. Mobility is a very, very important part of it, and electric mobility as well. There are all different kind of models which are being looked at right now. What is the difference that you see from when you were doing this and now? Obviously, you're still in the thick of things. But what is the transformation that you would have seen over a period of time? As a country, are we behaving differently?
Yeah, I think there's been a sea of change right now. I mean, I launched Reva a little over 21 years ago, so it's a long time. If you look at it from a macro level, where energy prices are today for renewable versus where they were, that's a huge shift. You today have it cheaper than gasoline equivalent. Look at where gas prices are at a micro level. The commitments being made at a macro level related to climate change and policy, right? So, we didn't have subsidies, we didn't have concessions. Today, you have the famed subsidy in the country. You have a host of positive policies, the recent battery swapping policy network that's come in on this front. If you look at technology, battery prices were, $1,500 a kilowatt at that point. They're less than 10 times that. If you look at where motor and electronics have gone, look at your cell phones and try to extrapolate that into what you're seeing today in electric vehicles, you're seeing a huge shift on this area on technology on this front. If you look at the financing available today, the number of startups that have been financed to that been done 20 years ago. So and of course, areas of the ecosystem available, people and capabilities. It's a much flatter world today in terms of technology and access to the information. So I think what we've seen is a lot of things that have never come before together have come. If the oil crisis in the 70s was a challenge, you didn't have tech at that point. And if there was a resurgence in the 90s, well, you still had issues around oil prices and energy security areas. So I think today is the right time where all the macro conditions have come, and it really paves the way of electric mobility, but integrated much better with energy. What you're trying to see today is how does energy and mobility come together. And clearly the government's new policies, thought process around swappable batteries is a step in that direction where it's actually saying that we're now sharing batteries, we're looking at energy and mobility linking each other together, which allows renewable energies to come into mobility, where the impact would be, significant, right? If you think of India today, we
if all our vehicles were electric this year, highly unlikely, we would probably consume 25 to 30 gigawatts of renewable energy, which is far less than what we produce today. And if we fast forward this to 2030 and say that all vehicles were electric, what would be needed in terms of renewable energy? We need probably around 250 gigawatts, which is probably less than half our target of renewable energy, which means that India at a level has theoretical capable of running its transportation on the sun, renewable energy. If you think of the impact that would do to $180 billion oil import bill, it's huge. So I think it's about this linking of energy and mobility that I see is going to be the big shift in the next 10 years. That's going to make a huge impact at the sustainability level and at the cost level.
Also, from a national security perspective, given that we are talking this at a time when interesting things are happening in different parts of the world as well, we never thought we would see a time when there would be a kind of a concerted action on strategic petroleum reserves. Countries acting in tandem didn't do much to moderate the oil markets, at least. However, the prices are now coming down. It's say around $102 per barrel from the scare that we saw around $138. Obviously, we didn't go up as high as 147. But I wanted to get Neeraj into this conversation. Neeraj, one of your constant refrains has been the problems are there, we all know. Financing is the big issue. Climate finance has to play a role. The budget this time, which was presented, which talked, there was a huge focus on climate, as in, for whether it gets translated or not into action is left to be seen. But like every government, at least the intentions have been announced very prominently. Your take on this?
So yeah, so as you rightly said, I've been usually critical and pessimistic about what the governments are doing or they should be doing. But actually, to give credit to what we have seen happen over the last 2 years through this COVID phase, I think without actually completely destroying the apple cart, the central government has tried to do whatever it could, at least for furthering the green economy and the whole green industry. And it's been done by a variety of quick fixes, like coming out with an amendment to a rule or coming out with a notification. So they know what the problem is. They immediately reacting to the problem. Probably not in the most legally robust manner, but at least addressing what the issue is. So from the government's end, I think we have seen tremendous efforts into bringing this sector up to a level where it can attract serious capital. And when I say serious capital, I mean serious foreign capital. But again, if you talk about financing, like you mentioned, what is probably hindering more financing in the sector is still the sort of perception of risk and the inability of those investors to probably appreciate the risk in totality and find ways to mitigate it. So, like, everyone knows what the issues are. There's nothing new, and we've been talking about this for the last 5-8 years since this industry has been booming. But I think the trick is now to figure out a way to live with that risk, to mitigate that risk, and still make money. And that is where that the various forms of innovative financing in the green industry is very much required, where the risks are brought to a manageable level and you still make money.
In fact, very quickly, I wanted to ask you this, and I also wanted Kavita and Deep to weigh in on this as well. How do you price risk then? Say, for example, how do you calibrate risk? It's a federal structure. While the center can keep on talking about things which sounds very nice, at least on paper, at the end of the day, it's the states which needs to carry this forward. So in such a scenario, and these states are nations in themselves. You just look at the size and the number of people these particular services cater to. How do you do that then?
So I guess the answer is to look beyond the state, right? All this while, the dependence of this whole bankability of DISCOMs, bankability of NTPC, bankability of SECI, I think we need to look beyond that, because there's a huge market outside of these agencies that the private capital can tap into. You look at at least that's what the government is also trying to tell the market. See,
the CNI space is a
absolutely. I mean, you look at the changes that the government is trying to bring in terms of must-run status, open access, ISTS waivers. These are all measures to encourage the industry to saying, okay, stop selling to the DISCOM. Don't only rely on the DISCOM. Go out and sell to the private consumers. And if you look at 8 years back when serious foreign capital started following renewables, they came in and they put their weight behind DISCOM PPAs, SECI, NTPC PPAs, right? And the sector boomed. If that same serious capital were to now put their weight behind CNI and private PPAs and a variety of other sort of variations of virtual PPAs, synthetic PPAs, whatnot, right? If that same interest and same sort of money can follow these new avenues, in the next 5 years, you'll see that market which is as robust as the current SECI NTPC market.
Right. Kavita, how do you, given that, Neeraj raised a very interesting point. These are grandiose statements as well as the center makes. How do you really see this playing it out in the States? Because ultimately the projects are there, the off-takers are there, money has to come from there. How do you manage it then?
I think one of the organic ways in which this risk has been addressed over time is the cost of supply. Maybe 10 years ago, renewables were supplying power to the grid at a very different price point. Today, the price points that we are talking about, which are competitively discovered and which everybody knows is very finely priced, it just makes sense for the state to have more renewables in the mix, right? So it is no longer a good to have, it is a good economic sense for the state to be buying power from renewables. So I think one part of that is addressing the cost of supply. The other part is the way that the market, treats the not so good states in the bidding process itself. So you'd actually see that the price which is discovered for states which have good credit risk or for, NTPC, SECI type projects are very different from the amount of bidding activity and the price at which the more delinquent states are able to get power, right? So in a sense, the market is pricing in delinquency, the market is pricing in, or rather the bidders are pricing in delay, and that is built into the price. So I think the reward really for the state is to kind of be credit worthy, is that it will just get larger power at much better rates than those states which are delinquent.
Yeah, and given that there's a huge focus on manufacturing, if you're able to bring down the pricing of electricity, which is a huge cost into manufacturing, you'll be able to attract more industries as well. Deep, how does this play out for your projects when you take these calls?
See, the two parts. One is commercial. So, we all know India is a big country. There are different states. They are like countries themselves. So you, as a very technical way of looking at it, you do the modeling based on the credit rating of the state and the appropriate discount rate. So that's very simple. I think the other point, which is more sort of fundamental, and this now I've talked about in every conference that I've been to, which is the regulatory certainty. India is an emerging economy. You differentiate yourself from other emerging economies, and I look after Southeast Asia as well, is by having a certainty around the contracts that you sign. And so it's very simple. It's not very complicated. Some of the risks that we see today are based on, obligations around the contract being breached, and those contracts, not enough thought having gone into what the obligations would be in the future, right? So I would say I also look after the road sector, and there you've seen over a period of time the concession framework coming to a level where it's a lot more bankable. You don't have a lot of challenges, and obviously it's a lot more driven by the center, so you've got that thing to sort out. But in general, I would say commercial is very easy to solve for and try and take the risk. It's the regulatory 0-1 risk which people are worried about. So I would say the government, and this is not new to the green economy and the sectors we're talking about, it's true for pretty much every sector. If the regulations are a bit more stable, people are always happy to come.
So are we a rules-based regime? After what has happened in states such as, and I'll take names here, say this Andhra, Telangana, Gujarat, so-called the poster state for investment, and where a lot of these things were first stabilized. How does that then pan out?
I think in general we are rule-based. It's just that there is, in most assets, especially in assets like infrastructure, we've invested a lot of capital upfront. You do need some certainty. You can't wait for things to linger on for 5 years, because in that period the project can actually die and you could have NPAs and then banks will have problems. So the reality is, I think that there is a fair judicial process in place, which could be followed more swiftly.
All right. All right. That's a very interesting way to answer it. As you rightly said, you absolutely gave me an answer, which is like, for people who report on the subject, so obviously we keep on looking for stuff, which then, if a large investor like you has a view about a state, it absolutely makes the headlines then. I wanted to get Nagesh into this conversation. Nagesh, the story of Indian industry right now is of transition, which is how Indian industry is going to play a part in this energy transition. Large corporates, and I'm talking about some of them, have been doing business in a certain way, and has worked out very well for them, and that's the reason why they have achieved the scale that they have been able to do so. For an industry in which you operate, how has industry been receptive to this change? And what has been particularly your playbook about this?
Thank you. Good afternoon, everybody. When you look at the industry that we operate, we are in the mobility industry, which is probably going through one of the biggest disruption that mankind has ever seen in terms of the deepest technological disruption, right? When an opportunity like this comes along, there's an opportunity for newer areas to emerge, not just in terms of technology, but also business model disruptions. So how are industries grappling with it? I mean, obviously, everybody goes through that. I mean, there are new age companies that have come in. There are the incumbents have jumped in. And I think both, at the end of the day, have an opportunity, because the opportunity size in India is huge. When you just look at the last mile mobility in India, and then when I look at the two-wheeler, three-wheeler population, right, that makes up close to about 80% of the population, right? We are talking now pre-COVID, that's about 20 plus million, 20 to 22 million, right, pre-COVID. And then you make it up 75+% of that is up for grabs. Point number one, right? The size of the pie is big. Unit economics is coming down. Chetan touched upon that in terms of the energy prices dropping over the years. I mean, short term, I'm going to not talk about the last 1 quarter, but when you look at it long term, right? Also, it doesn't take too long. You go to a Delhi street in November, and I think you get the answer, right, in terms of what we need to do long term. So when you look at a fuel agnostic policy, and you touched upon whether it is clean CNG or hydrogen or in the future electric, right? Some of this is inevitable. And when it comes, and then you have an S-curve happening. Other countries like China have seen this happening. Today, China's electric two-wheeler population or the mobility population is about 35 million two-wheeler scooters, right? And both new age companies and traditional companies have succeeded. So the industry itself, we see a huge opportunity for change. The things are coming together. The government has also played a huge part in this with the addition of the FAME 2 and then the state governments jumping in. And in a place like two-wheeler and three-wheeler, the infrastructure is not such a big issue that you would hear in a four-wheeler. So I would say the time is ripe, and I think you will see the
Sorry to interrupt your chain of thought. You mentioned FAME. Now, FAME started with a big bang, didn't do much. So that's the reason why we see this new avatar of FAME, so to say. Also, and particularly when we talk about mobility, aren't we again putting ourselves, and I would love Chetan to come in on this, that if you look at, you're talking about things like lithium, you're talking about some of these minerals which are not around here. There's already a lithium triangle which has been taken care of by China. Don't we run the same risk that we ran in terms of crude? Because obviously, as a government as well, you cannot bet on one technology. You will have to let the market decide which technology does better. There are different, science evolves, and there are new plays which is happening out there. On the mobility part of this, and Nagesh, I would like you to answer this, and then obviously I'll pose this question to Chetan. Are we not falling into the same trap that we fell in earlier, which was maybe in this case of solar, where manufacturing happens in China? Similarly, while PLI and other schemes are there, but at the end of the day, you need the raw materials. You cannot just imagine them to be where you want them to be. Your views on that?
Yeah, I think fair question. When you look at what's different this time, even compared to recent times, right? One of the things that FAME did well was not only, of course, providing the subsidy, but also insisting on a local manufacturing policy. That was a key. So when I look at my own vehicles, which are the high-speed two-wheeler, right, or the city-speed two-wheelers, more than 90% of the products or the subcomponents are coming from Indian manufacturers. That was a difference compared to the solar industry, right? And lithium cells, to your point, yes, the battery chemistry today, it's lithium. Tomorrow, it could be something else. We've already heard of certain companies looking at sodium and others, right? That will evolve. Are we dependent on lithium cells for a Japan or a China or a Korea, I think, or some parts of the world? I think the answer is yes today, right? Will that change in the future? Probably the answer is yes. So when I look at it, the ability of moving people and moving cargo is not going to go away. We need to move people, we need to move cargo. When you have like-to-like comparison, rupee 50, roughly, at 75 rupees of petrol, right? Typical IC engine costs you 1 rupee 50 paisa or something plus at 75 rupees, yeah? A typical electric two-wheeler costs you about 20 paisa per kilometer or less. When you look at the cost economics or the unit economics, and over the life cycle of the product, I mean, I think the answer is there. Short term, yes. How do you manage the lithium? How do you manage that? How do you make sure that you're not indebted to a particular area or region? Fair point. I would let Chetan take that on. Thank you.
Thanks. I think lithium is an important part, but if you just take as an example the same scooter, and today we use, say, swappable batteries on it. The cost of the lithium is, first of all, in the cost of battery, half of it is electronics and everything else, and the half of it is the cost of the actual cell. So if you start from a lakh of rupees, let's say the battery was 50,000, in which then the electronics, which the actual cells will maybe 20,000 or so, 25,000, and in that, a small percentage of that is lithium. So net, that may be 10,000 rupees or less. If you look at over the next 7 years, the amount of energy that same vehicle will probably use on this area, it's going to be 54 that. So if you look at from a total amount of import bill from a country point of view, yes, we may switch. We will not have all the raw materials, but the quantum of amount we need will be significantly lower. And it will be important for us as we scale the business in the next 5 years that, like we have strategic alliances for oil, we will need certain strategic alliances for lithium reserves with countries that have surplus on that area, right? At the same time, what's also happening is the energy density is going up every year around 10%. So with the same raw materials, you're getting 10% more energy, or you're going to use 10% less amount of raw materials to gain the same amount. So the amount of raw materials is reducing significantly. The third is the recycling process is increasing significantly better today than it was 5 years ago. And in the next 5 years, it's only going to get better. And so you're going to be able to recycle these batteries and then use lithium from that on this area. And the last thing is alternate technologies are now coming in, which they always do at this point as one raw material goes up. And we've seen that when, we've been pretty good inventing those things, and that's been happening here. So I don't see that as a challenge for us industry in the next 10 years. I think for us, the challenge is how quickly we can execute and get and be part of this. This ecosystem change has happened globally. It's growing at a phenomenal rate, and how does India step up itself as it achieves a higher level of electrification in the next 5 to 7 years?
Right. Thank you, Chetan. I wanted to ask Deep this question. Deep, you briefly mentioned about the stability of rules. You talked about the certainty, if there is a certain kind of the idea being do not change the goalpost once something has been put into play. You also take care of a region which is huge. How do you rate India vis-a-vis the others?
I think India is quite mature compared to Southeast Asia is what I would say. And obviously Southeast Asia is a mishmash of economies, and if you include Singapore, that's a developed country. The rest of it, most of it is Philippines, Indonesia. I would say India is quite relatively quite mature compared to those. And when I meant by mature is that, we always keep, usually the discussion in India is about cost of capital and are you going to make the right return. You end up getting good assets, so you'll find a good, well-run solar asset, but you'll have to pay for it. And what I mean by good, well-run is that there'll be a contract, there'll be lenders who are locally available, there'll be consultants and technical operators who are available in the market, and you can find some deficiencies here and there, but you can fill that up. You would have the right governance practices available, and you can get the right talent to run it. So it's usually a lot better than what I find elsewhere, but I'll not generalize because some of the other companies, like in Philippines, we own a company which is the largest geothermal company in the world, 1.5 gigawatt of capacity. They run it very, very well. So I wouldn't generalize, but in most cases, I would say that India's journey is far ahead of the rest of the region.
Very comforting. Anita, how would you, Kavita, my apologies. Kavita, how would you, the Deep answered this question about how India is far better than others. In your opinion, because while you do take care of this market and obviously in your models, you see that what's happening elsewhere, how do you rate us? Both on as the maturity of this space and also on the regulation side of this.
So I would say with regard to maturity, the exciting part of being in India is that there are so many other aspects of green which have not yet been explored or which are in very initial stages, right? So a lot of us still look at green as basically from the renewable power generation space, but there is that entire ecosystem of how power is scheduled, how it is delivered, how it can be enhanced by technology, which are not yet in the scheme of things. They are in a very nascent stage. The other part, which is you come at it from the green part, but the other part is that how do you reduce the gray in the gray to green? Things like carbon capture, which are again in a very, very nascent stage. And that is actually the direction in which we are seeing other more developed markets, that play starting to come. So I would say in terms of the opportunity is the most exciting thing. The other part which I referred to in my opening remarks about scale, we are seeing larger and larger scale, which enables large investors to come in and invest.
A very quick question there. So are you referring to stuff which is happening behind the meter? Is that what you're referring to? Say, for example, today, why should I have a modem in my house? Why should that meter that is there take care of everything? So, for example, and there are all kind of things which are being planned right now. This is the Internet of Things which has been talked about. There's a reason why I see players like Jio coming into this space. In fact, a lot of people weren't able to figure what was the big play out there. But we see that smart metering, 250 million households needs to be put with smart meters. That is the reform-led scheme which is being talked about. Is that what is the kind of going forward when you look around? Obviously, you're looking at new opportunities as well. Are those the sectors that one needs to look out for?
I'm just talking about concepts like, we have a platform which provides the technology where household users can schedule when do they want to run their laundry depending on the price of power at that point of time.
Day of
right?
time,
so,
yeah.
So I think these kind of concepts, plus also the more, usual kinds of concepts like enabling industry to replace DG sets and engines with, things like battery storage and natural gas power. So I think it is basically what incrementally you can do to in the spectrum of gray to green. So not only renewable power generation, but also the myriad ways in which you can improve the way that that things are done.
Right, absolutely. Thank you, thanks, and I think that's my cue. And thank you for this discussion. Also, it's also very fascinating to say that from the days when when we started this conversation, when I mentioned that it used to be more like a CSR, and certain film personalities used to be the largest investors in green energy purely for the tax purposes, the sector has absolutely turned a corner. Thank you, everyone. Over to you.
Thank you to the moderator. Thank you, Utpal, for holding these proceedings together. and enriching us with knowledge from this session. I request you to please present our esteemed speakers with mementos, tokens of our gratitude. Thank you very much to all of you for taking the time out and joining us here for this panel, The Green Economy. And please do come together for a group photograph. Meanwhile, all of you ladies and gentlemen, continue using the hashtag #MintIIS 2022 and tag us at Live Mint. A huge shout out to our partners, presenting sponsor Tried Legal and powered by sponsor MobiQuick. Thank you very much to them. After lunch is positioned a fireside chat that circles real estate and the road ahead. Thank you very much to all of you once again. On that note and with that thought, let's head out for a hot meal and come right back into this hall for more hot discussions on investing for India at the Mint India Investment Summit 2022. We will see you all back in your seats at 2:15 p.m. sharp, please, 45 minutes from now. Thank you very much. And I hope I have woken you all up nice and proper for lots more coming on at this summit and awards. Before we dive into the first session post-lunch, here is an interesting factoid for you. Real estate and the road ahead. Take a look. And so next up is a fireside chat that circles real estate and the road ahead. Work from home, work from anywhere, hybrid workplace are some of the terms that have become the mainstream of the last 2 years. The pandemic has brought major challenges for the commercial real estate sector with frequent waves of new variants and resulting lockdowns, while the pandemic, combined with low interest rates, has given a boost to the previously ailing residential real sector. How have real estate players navigated these tumultuous times, and what growth opportunities do they see emerging from the pandemic? Let's talk. Madhurima Nandi, Senior Editor, Mint, is in conversation with Ankur Gupta, Managing Partner, Real Estate, Brookfield Asset Management, in this next session coming up. Please welcome Madhurima, and please welcome Ankur. Good afternoon to both of you. And the stage is all yours.
Hello. Hello and good afternoon, everyone. Ankur, thanks for joining us here today.
Thank you.
To set some context, it's been 13 years since Brookfield has been operational in India. It has over $20 billion of assets under management, of which $7.5 billion is in real estate alone. It owns and operates over 45 million square feet of office assets and is easily one of the busiest and most active investors in the sector. First off, Ankur, I wanted to ask you, if you could give us a sense of where India figures today in Brookfield's, pecking order as a global investor. And given what has transpired in the last 2 years, has that changed or modified Brookfield's, vision or India strategy, so to speak?
Okay, thanks, Madhurima. Thanks, Min, for having me here today. Thanks, everybody, for attending this panel. First up, as you mentioned, we've been in India for more than a decade, of which the last 7 years have been very busy. All through pandemic, we've continued to expand our business. And the one thing that probably separates us from the very beginning, for more than a decade, as I said, we've been setting ourselves up for creating a business. So yes, we are large investors here. We put out more than $20 billion, out of which almost $8 billion is in real estate. But all along, the strategy has been to build businesses that can transcend investments. So we are also a developer. We are an owner-operator of assets in India. So all of the 45 million square feet is being operated, developed, accounted for, tenant management, including running operating hotels. So that's been our strategy in India, which probably differentiates us a little bit from how private equity investors might have approached the Indian market. But also what's important is that India is very important for us as an investment destination and as a place that Brookfield sees a disproportionate amount of capital coming into the investment world for a variety of reasons. India is a high growth economy. Brookfield, as a philosophy, is largely invested in income producing, cash generating assets, as we call the real economy. And India provides a fantastic place where we have urbanization, we have suburbanization, we have real growth, we have decent inflation. So overall, as an economy, the macro trends are fantastic. The micro may always be a little bit more volatile than the West, but over a decade, over a 2-decade period, that volatility, if you look at the trend lines of the volatility, like the one that we show in this investment, the V, it may be volatile, but the trend line is positive. So just in context, we have about 690 billion of total assets that we manage globally. More than 1/3 of that is in real estate. So as a quantum, the 20 billion may look small, but I would say that from almost 7 years ago, we've come a long way. And the trend is looking more and more positive. India is a top investment destination for Brookfield today. We have more than 70 investment professionals who work for Brookfield today in India, and more than 20,000 operating professionals who work for various companies. So all in all, the business is deep and it's very exciting.
You know, a lot has been said, you know, about the disruption that has been caused by the pandemic and the impact that it's had on the commercial office sector specifically. You know, could you give us a sense of how the commercial real estate sector is making a comeback? What is the pace of recovery, and how far are we still from, you know, the highs of 2019, which was like a landmark year for the office sector in India? You know, it saw an all-time high in leasing, you know, tremendous investor interest. You know, so could you give us a sense of that?
So let me try and differentiate a pandemic versus economic cycles for us. Let's say 2008, or during the last great you know, economic crisis that the world saw with the banking sector in the West especially going through turbulent times. There were many companies who would have leased millions of square feet which didn't exist the next day. So you would have 1 million square feet, 2 million square feet that basically the lease was worthless because the company had filed for bankruptcy. In a healthcare or in a pandemic which was largely driven by a virus that took the world by storm in a very negative way, and we've had subsequent waves, these two are very different. So all through the pandemic, through our entire office portfolio, and in many cases our retail portfolio, there was no such binary event where suddenly tenancies stopped, rentals stopped flowing in. In fact, we collected more than 99% of rentals across our businesses. The good part about the commercial business that we operate is it's a very critical part of organizations' overall business. So except for periods when the government mandated absolutely no travel to work, our offices were still functional, the servers were still running, back-end infrastructure was still fully operational, and a steady return back to offices were felt as every wave subsided. And since end of January, we see that traffic is back in most of our parks. So yes, it's been as I said, it's been turbulent last couple of months or last couple of years, but fundamentally the business that's underlying our real estate has only gotten stronger. And that's a good part, because most IT companies, digitization of the global economy is actually on high octane right now. So the fundamental business is doing even better. What happens during such periods of disruption is it separates the better quality real estate, the better quality assets from the average ones. It makes us all aware of the quality of our spaces. For example, quality of air. We've always been very vigilant, especially in cities like the ones that we have in North and in places in Bombay, about the quality of indoor air. We've always measured ourselves to low double-digit AQI indexes, which is the best in the world. And this was pre-pandemic. Now, during pandemic, a lot more attention was made. So it gave us a chance to actually talk about the high-quality assets that we had. And people were willing to listen. The Hotel Leela portfolio that we have, it's the top-notch hotel portfolio in the world. Now, when business was booming across the globe, you may not be able to differentiate from average properties, but that realization has come to the marketplace now, and the quality of service has also come to the fore. So it's not just quality of assets. Who's providing that extra mile service? that's become important. So yes, it has been challenging. There were periods of serious challenges, but I firmly believe that an office is an environment which creates organizations. Even startups who started off in garages didn't start off in their bedrooms, right? So office space is here to stay.
Speaking of organizations, traditionally we've seen ITS companies sort of, spearheading the absorption and sort of leasing landscape in India. Do you think that will change? And secondly, do you see, what are some of the other sectors, that you think will emerge as front runners in, again, the leasing ecosystem? Startup unicorns, for example, which have significantly taken up, a lot of office space over the last 2 years.
It's absolutely right. I think, you make a very good point that the type of companies that occupy spaces will keep evolving. Back in the 70s, you would have an overload of banking companies taking high quality spaces, which changed in the 90s and 2000s into IT companies. And again, software or technology is not just a sector, it transcends all sectors. So today, when we say IT clients, they are consulting companies, they are banking and financial services, insurance, etc. So that line between what's IT and what's non-IT is actually a very blurred line right now. That being said, even commodities companies are going deeper into technology. Life insurance companies have a very, very strong back-end support that's doing the risk management. So I would say the sector today in India, from the days where it was more outsourcing based or knowledge outsourcing based, it's now, cutting edge work is being done in India for the global economy, and that's what makes me very, very positive about the future trends here.
When we talk about commercial office sector today, you cannot but talk about the shared working or co-working sector, which has, to my mind, been a unique beneficiary in the course of the pandemic. So I wanted to ask you, today we see not just startups, but even large companies adopting a hybrid workspace model where they want traditional workspaces, but they also want a little bit of flexible workspaces for their employees. What is your, what's your outlook on that? And also Brookfield, when you all acquired the RMZ office portfolio, you all acquired their co-working business, which is called CoWorks. What's the strategy with that business?
So let me give an anecdote. We talk about IT, yes. Today the word is SaaS, software as a service. We've always prided ourselves in Brookfield and said we are offering a service to our clients. We own great assets, but it has to be packaged as a service. So, somebody better than me can coin a better term for it, but real estate is a real estate as a service offering from our side. And shared workspaces, flexible way of offering that spaces, and not just flexibility in terms of lease duration or the way you charge your tenants, but flexibility in terms of the end user profile. Why should every company have their own boardrooms? Why can't we have shared boardrooms? Why can't we have shared food courts? Why can't we offer food as a service to our clients? Why can't the amenities in an office park be of the highest order? Why cannot there be a way where all these amenities are on an app available to all of the office users? Today we have more than 400,000 people who work in a Brookfield asset in India. It's a very powerful workforce that is unified in who their office landlord is. So I think that's really how we think about the flexible workspaces or co-works as it's called. Co-works is not just a flexible or a co-working place. Co-works is our answer to providing services of the very highest level to our office tenants. Whether they are taking up 5 floors from us or 50 desks, that's a business decision, but our services have to be top-notch to everybody.
In the over a decade or so that Brookfield has been in India, it's, I think, clearly moved beyond just a commercial office investor and operator. You all have invested in residential, hospitality, of course. But going forward, Ankur, what are some of the other sectors that Brookfield is exploring, in terms of investment opportunities?
So for us, real estate provides a backbone of the economy. And we always have this term in hockey, which is don't look where the puck is, look where the puck's going. I believe that the renter economy is here to stay. Population is a lot more mobile. Geography is history now. You have people who are working in Bangalore in 1 year, they move to Gurgaon, then they come to Bombay. So the rental space in residential is exciting. We are doing a lot of that work globally. We think India is poised where there's a very large shadow market for rental residential market.
When you say rental, do you mean the co-living space or rental housing?
Co-living is one part of it, but rental housing, serviced apartments, making it easier. So whatever makes economy function better, more efficiently, whatever makes consumers' lives easier, I think that's where the business is going to go. India has a young population. Our median age is 27. The median age of a home mortgage taker is 37. So think about 15 years when somebody starts working, about 22, 23 these days, till 37, they are renters, right? And high quality spaces which is available for somebody, not having to negotiate individually with the unorganized sector, not having to talk about, their personal profile, but it's just based on credit history. I think that's really where the puck's going. So we are quite excited about partnering and exploring this sector with participants here. We've been investing heavily into our hospitality venture at the Leela. We think that business will continue to grow. And ultimately, as we all know, the e-commerce, quick delivery, warehousing, infrastructure, the supply chain ecosystem in India is going to play out. And last mile logistics, urban warehousing, as well as large format warehousing will be developed in the country. That being said, we are a large player in the office business, the mixed use space. And I think as cities continue to evolve, that will of course remain the core area of our real estate operation.
You mentioned hospitality. In 2019, Brookfield acquired the Leela Hotels business, right? And that was your entry into the hospitality sector in India. Of course, after that, 2020, COVID struck, and we know the impact it's had on the hospitality and travel sector in particular. Going forward, I mean, is Brookfield exploring sort of newer opportunities in the hospitality space, or will you sort of expand the Leela portfolio that you have already?
So all through the last couple of years, we've been investing heavily in the Leela business. From about 8 hotels, we are now close to 13 hotels. So we've actually opened 3 new hotels last year. We've invested significant capital in upgrading the existing Leela assets as well. Not that a lot of them needed too much upgrade. They're the best in the business. Some of them are best in the world. And we've continued to buy more hospitality assets. Both within the Leela platform and outside the Leela platform, because not every hotel may fit the brand. We could look at expanding the offering in Leela, but also look at partnering with other brands as the case might be. But we think hotel investments is again very similar to our theme about urbanization, with an added advantage of domestic and international tourism coming back post-pandemic. And I think good quality hotels run by dedicated management teams will continue to flourish in a post-pandemic world.
Coming back to office, where we started our discussion, the Brookfield India Real Estate Investment Trust was, the REIT was launched in early 2021. It listed successfully, and despite the challenges I think REITs have faced over the last couple of years, not just in India but globally, we are again seeing people return to offices. Leasing momentum is hopefully picking up. Rental values will also improve in due course of time. Do you think, what is your outlook on the REIT space? And, do you think REITs will also kind of pick up as things improve in the commercial office sector?
Absolutely. Globally, the REIT asset, as an asset type, is very large. Just in the US alone, the REIT asset type is more than $15 trillion. And in India, we just have 3 REITs right now. It's a small fraction of not just the global REIT market, but also the Indian office market. So as the commercial office market, reaches its, I saw some projected numbers about $1 trillion. I think we are almost there already. So a large part of those assets will ultimately be housed in a real estate investment trust. A REIT is a way to house high quality commercial assets. It's a way to make investing in REITs easier, or investing in commercial properties easier. A lot of investors have made significant amount of returns, and not just returns in capital appreciation in the REIT stock, but the form of returns, the form of making your returns is actually fantastic in a REITs. More than half the returns come from dividends. Most part of the dividends are tax-free in the hands of investors. So as the propensity to invest more capital in public markets in dividend-paying stock increases, because in India, because most stocks are valued for growth, REITs is a fantastic alternative for mutual funds, for retail investors. And I must congratulate that our regulator is doing a great job in making it more and more accessible to the lowest common denominator in public markets investing. In our REIT itself, we saw tremendous participation from Indian domestic mutual funds, which was not the case in the first couple of REITs, and rightly so. Probably the larger institutions internationally were a lot more familiar with the REITs. So both in terms of return profile, and I think the best formula in the world sometimes is winning. So as REITs perform well, more investors will come in, and that will lead to a fantastic feedback loop for more REITs to come up in the marketplace. But the fundamentals of business will ultimately drive value. As rates increase, as tenancies get better, as more assets get built up, they'll surely find their way into a public market story, and REITs are tremendous for that.
So, you told us the various opportunities that Brookfield may be exploring, in the short to medium term. But over the course of the next year or so, so what are some of the things that we can expect from Brookfield? So, I mean, is it in a wait and watch mode? Will we see, big acquisitions that Brookfield is known for? Some of them, give us a sense of what should we expect from Brookfield?
So I would say our business has become very predictable, right? We've been investing or investing in the sectors that we've been focused on for the last several years, whether it's high quality infrastructure assets, data infrastructure, commercial offices, hotels for the last couple of years, as I said, some form of rental or housing based stocks. So in many ways we've been focused, and we've been trying to repeat what we've been doing. So starting from the acquisition of the Unitech Corporate Parks portfolio in North, to buying assets in Powai, subsequently in BKC, Bangalore. So there's a consistent theme in that, and we continue to go deeper in assets and in sectors that we like, and also broadening our horizon around that core strategy. So my expectation would be that we'll keep doing more of the same, and being nimble enough to then explore other. But the investment philosophy remains the same, which is buy high quality businesses, buy high quality assets, pay a fair value for it. Don't be shy about buying the best assets as they're available, and make them better.
I have to ask you, there's been a lot of talk about, building offices for the future. I mean, are you seeing that being translated into reality? Are people really building differently? What do occupiers want today? Have their demands changed? Also, in terms of locations, we've seen in the last 2 years, Tier 2 has sort of become, a lot more mainstream. From e-commerce companies to warehousing players, everybody is talking about Tier 2 markets. From an investment perspective, Ankur, what is your sense in terms of the future of workplaces? And as a global investor, I mean, are you all still sort of focusing on the top 5 or 6 markets in India, or will you look beyond that?
So I'll take your second question first, and then I'll talk about workplace trends. As a global investor, it depends on which type of assets you are investing in. So in our hotel business, for example, we are in Tier 2 and Tier 3 towns, but they have a different story about tourism and about some other form of economy. When we enter the warehousing space, we will not be in city centers. We'll probably be in rural India a lot more than we have been. But as far as our core office business is concerned, we are in 7 cities now, and I think the focus will largely be in those 7 cities. While there's always some talk about Tier 2 towns and Tier 3 towns, and I call them suburbanization of India, India needs suburbanization. We are a very urban-centric country already. Our cities have a population of 20, 25 million people. So the way for India to grow is to suburbanize, and investor capital will find its way to where the economy is going. So whether it's this year, whether it's in a few years, that Brookfield finds investments in what are today tier 2 towns, but will become tier 1 towns, and they're comparable to tier 1 towns across the world. So I think it's a matter of time that we'll also look at those locations. But today, 7 cities is a lot for us. As far as future of workplaces is concerned, real estate has long been considered as a brick and mortar business. While that fundamental building block hasn't changed, the way of offering that service has changed. A lot more technology is built into sensors in the buildings today, right at the time of construction. Tenants' requirement from their offices keeps evolving, and landlords like us need to talk about it with them. It's about managing spaces for creating social distancing or quality of air. The vibe at a workplace, today the average age in most offices is younger today than it must have been 20 years ago. So again, as I said, where's the puck going? And I think we have to listen to our tenants, and as the largest office landlord in the world, the benefit that Brookfield gets and all of us get is we have the benefit of the latest trends across the world. We talked about live, work, play. I certainly believe you actually live where you work. It's not just live, work, play. A lot of us spend more than 10 to 12 hours in a day in our workplace. How to make that workplace work for you, offer the best food, offer the best amenities, the best way of playing, working out, etc. It doesn't just need to be a check in the box. It needs to be very well integrated into the way you want to spend 10 hours in a day. I think that's really where it's going. Otherwise, it still remains fairly simple business.
Yeah, I think with that we come to an end of this discussion. We could take a couple of questions if anyone has any. Yes, please.
We'll share the mic.
Question has to be very qualitative, since he has come to
when you said about this quality of air, and these days we are talking about a lot of platinum standards. So do you think all these standards are percolating with other developers also?
So the developer universe is fairly large. We've been at it for last several years in trying to accomplish 2-digit AQI indexes. Now, whether it's percolating or not is a tough question for me to answer today. But I can say that if it does not percolate, then it will be difficult for those spaces to be relevant in the medium to long term. And I think some of this will become table stakes. The tenants will demand it. And it's also a good thing for us to do. Better quality air, better quality filtration systems, water, having green energy. So you mentioned platinum. Platinum rating starts from how you conceptualize a building, how you source raw materials, what is the carbon footprint of your building during construction and post-construction, quality of the design that allows natural sunlight, the manner of creating a lighting system. All of that contributes. So today, if buildings are not gold or platinum rated, many global tenants will not even consider it and not even shortlist it. So I think it will become table stakes ultimately. Today, it might be something that is unique to us.
Fine, thank you.
Any more questions? Or should we move on to the next? Yes, sir? Yes, sir, we'll get you the microphone.
Thank you, Ankur. Great points. Couple of questions. One maybe as a follow-on to the first one. Sadhguru is starting this whole initiative on topsoil erosion. I don't know if you're familiar with that or not.
Yes.
That over the next 30, 40 years, there's going to be significant topsoil erosion, which will not allow, productivity of crops. So I don't know if that's an area that Brookfield is focusing on. And the second question was, since you have so heavily invested in India, is affordability of allowing people to own real estate an area of focus for Brookfield?
So I'll start with the second part.
Give us a minute, sir.
So I'll start with the second question first. So second question about affordability of home ownership. We have invested capital in affordable or mid-income housing projects more through our debt strategies. But I must say that if residential real estate is not affordable, it's not saleable. It's not a question of wanting to buy a house. If you have one home, you may want two. If you have two, you may want three. The calculus really is how much real estate individually people can afford. And affordability is always the only calculus that matters in the residential space. It's not by chance that stock market performance and residential prices have a positive correlation. So I think affordability, both in terms of wealth as well as being able to pay EMIs, is the single biggest driver for the residential sector. When I talked about rental-based housing, and we have a lot of focus in that space across the world, is because renter-based economy is the way to make quality real estate available to a wide variety of individuals starting at a very young age and make it easier to access. So I agree with you that affordability is important, and Brookfield in its own way, both in India and abroad, is focused on affordable, both in terms of sale-based residential as well as mostly in residential-based product. I'm not very familiar with the first part of your question, which is the topsoil erosion. As a student of the engineering stream, I must say that that's something which all of us should be worried about. Urbanization is here, and that's why I stress that suburbanization is probably the way to go, where we do not create large patches of urban swaths that may be ecologically insensitive and may not stand the test of time.
Thank you, sir, for your question. Thank you. In fact, sir, to expand on your question, the soil erosion is also largely related to the way farming is done across our country and the pesticides, etc., used, and probably less related to infrastructure. Thank you very much, sir, for your answer. And may I please request you, ma'am, to present him with a memento?
Okay, so Ankur, it was a pleasure talking to you.
Absolutely.
And once again, thanks for taking out time and being with us here today. And thank you, everyone, for being a great
Thank you very, very much to our esteemed speaker for joining us for this session. We'd like to thank him with a memento, a token of our affection and gratitude. As he said, suburbanization is the way forward for India. Thank you very much, and please come together for a group photograph. And thank you, Madhurima, for doing the honors with this session. Coming up next, ladies and gentlemen, panel 7 at the Mint India Investment Summit. And in this panel, we're asking India, the factory of the world? Let's delve deeper. The Indian government has been pushing hard on making India an attractive destination for manufacturing through programs such as Atmanirbhar Bharat, Make in India, and the various production-linked incentive schemes. A year into these PLI announcements, we take a look at what impact has been witnessed on ground. Can India really beat its Asian peers to become a top manufacturing hub, and are investors willing to back manufacturing businesses that have ambitions to build for both India and the world? Let's talk. May I please invite on the dais the speakers of this session. Padmanabh Sinha, Executive Director and Chief Investment Officer, NIIF. Good afternoon and a very warm welcome. Vivek Vikram Singh, Managing Director and Group CEO, Sona Comstar, joining us virtually. Welcome to you too. Pankaj Patwari, Managing Director, Advent India PE Advisors Private Limited. Good afternoon, Pankaj, and a very warm welcome. Prakash Bagla, Director Motilal Oswal, Private Equity. Good afternoon and a very warm welcome. Yogesh Singh, Partner, Tri-Legal. Good afternoon and a very warm welcome. And please welcome the moderator of this session, Alicia Sachadev, Assistant Editor, Mint. Alicia, I hand this over to you.
Well, thank you, Geetika, and thank you so much, gentlemen, for your presence here. An in-person event after a fairly long amount of time. And thank you, Vivek, for joining us virtually. Would have loved to have you here. But thanks regardless for making this happen. You're joining us from New Delhi, of course. And congratulations also, for being selected as part of the PLI scheme for auto components. The list has been out today. So, as Geetika was mentioning, the theme of this discussion is whether India can be the factory of the world. Manufacturing, as we know, is a very significant chunk of the country's GDP. It's a big employment generator also. But for some reason, we haven't been able to capitalize, our manufacturing capabilities and sort of leapfrogged in ways that we have in some other sectors like the services sector. Without wasting much more time, I'd like to, go across to the panel and ask them, what will have to give way so that we can really seize this opportunity that has become especially visible now in the light of, several supply chain headwinds that we have witnessed over the last 2 or 3 years, in fact. First, because of COVID, now there are, many geopolitical tensions also that we are witnessing. So it becomes imperative that we address this question sooner than later. Vivek, if I can start with you, can India really become the factory of the world? And since you're passionate about calling it the smart factory of the world, so let me phrase it like that. What can we do so that we do become, a global smart manufacturing hub?
Apologies for appearing as a giant head floating in midair. But that is the point of technology, and since we are talking about manufacturing, at least one of us should be in a factory, right? So I'm in a factory physically. So why, the short answer to your question, yes, India can be a factory to the world. I believe we already are. In the sector that at least I am in. In automotive, we are the largest producers of two-wheelers in the world, the largest producers of tractors in the world, the second largest producers of buses, the fourth largest producers of passenger cars, the sixth largest producers of trucks. So at least in the limited space that I work in, we are one of the world leaders. Can we extend that to other industries and what would be needed? I think it's a very important question for at least our generation to answer. I think the earlier generation, if you had access to capital and the ability to organize labor, you could be an industrialist, you could be in manufacturing. I think capital is not a constraint anymore, and neither is the ability to organize labor. I think we've moved to an era where technology and how you can leverage that in 3 ways. In application, so the convergence of hardware and software, how many grams of code can you, how many grams or lines of code per gram of steel for us? As a platform, what Vishal is doing with ZWorks, can you extend that to actually make productivity higher? And as an enabler in Internet of Things and automation, can you be such that your capital equipment is world-class, your processes are world-class, and you can compete with the world? I think these 3 things, if we do, and we can start owning or at least controlling the primary technology with which we produce our goods, we will get there. And I think there is a renaissance happening in manufacturing as we speak. In the last 3-4 years, I have seen more excitement in manufacturing than ever before. There is a lot of high quality talent that's coming in manufacturing. A lot of high quality startup. You look at the EV two-wheeler space, you look at robotics, you look at defense, and even the capital markets have appreciated that. So yes, I'm a very big optimist and I'm a believer in Indian manufacturing. And I think this decade will belong to Indian manufacturing.
Padmanabh, if I can come to you now. Traditionally, the manufacturing sector hasn't seen a lot of private capital flows. Is that changing now? And how does your investment pipeline, reflect that? You are a sovereign wealth fund. You're mandated with, investing in also areas that can aid the country's growth. So, your opening thoughts, and if you could respond to that.
So I think Vivek is working. Vivek summed it up well when he said there's a renaissance in marketing in manufacturing in the last 3-4 years, and ultimately, as investors, our investable universe will depend on really how manufacturing businesses are doing. Clearly, I think this is India's opportunity. Unlike in outsourced services, we've never been a manufacturing hub of the world, maybe for the reasons that we didn't have world-class manufacturing, design-led manufacturing at scale, except in a couple of sectors. And I think one thing that COVID made all of us realize is that manufacturing as a sector is strategically as important as infrastructure, because when global supply chains break down, whether it's something as basic as vaccinations or it is semiconductors, battery storage, areas like that, unless you have your manufacturing facilities, particularly for a market as large as India, you will be hamstrung. So we always had a favorable demographic that was well spoken about. I think what we have now is much stronger entrepreneurs and management teams, which is critical, because as investors, we are very focused on the quality, particularly when we are doing growth capital investing as we do, on the quality of the entrepreneurs and management teams that we are backing, the governance there, the focus on innovation, because we ultimately, as private equity investors, we are investing for several years, right? We want to invest in businesses which are sort of future-led, future-proof. We don't want to invest in businesses which will be mature in 5 years, but will continue to be high growth. So the sort of future-ready manufacturing businesses are extremely important, which is why as NIF, as a sovereign linked fund, our focus really is on new age manufacturing businesses, and whether it is 5G equipment, EVs, battery storage, electronics, these are particularly sectors of importance, where the inflection point seems to be coming in many of these segments, because as we said, the demographic was always there. Now we have high quality entrepreneurs and management teams. We have competitive taxes. People speak a lot about PLI, but what is forgotten about is the manufacturing taxes for new manufacturing at 15% plus surcharge is really competitive. So that was lacking earlier. That's now available. We have much more efficient supply chain developing. I think ZWorks was supposed to be there, but it's not there on the panel. So there is stuff happening on the supply chain side. And finally, research and design and development is important in terms of innovative rather than commoditized manufacturing. So all these provide for the right ingredients for us to look at providing growth capital. And NIF as a sovereign link fund, as you correctly said, we started off with the focus on infrastructure and now growth capital or private equity in sectors, including, so 4 or 5 sectors we identified as manufacturing, financial services, social infra, digital platforms. These are areas of interest, and since we are targeting, we already raised over $1 billion, targeting over $2 billion fund, we're really looking at sizable opportunities of scale that we can back, and these will have to be businesses which can be competitive, not just in India, but potentially globally as well. So yes, we're quite hopeful that in the next few years there would be attractive manufacturing opportunities. The other thing that as NIF we do look at is also partnering with potentially with MNCs as they look to set up base in India to become their local partners in some of these segments.
So you're correct to point out that manufacturing perhaps was not, a destination where even a lot of new enterprises would come up for the same reason that, even gathering investment there was a bit, perceived to be a challenge, but you're saying that we might be approaching an inflection point as far as that is concerned. Pankaj, you back businesses, in the pharma chemical space also, which is one of, one of the few sectors which have, sort of started to, reach the, sort of cost competitiveness that is required to, also start to be able to export successfully. Your opening thoughts about the opportunity that India can provide as a global manufacturing hub.
Yeah, firstly, I would agree with both the panelists who spoke ahead of me that probably the next decade is for manufacturing. I think as Advent over the last 5-6 years, we've invested in over 8+ manufacturing-led businesses. And as we speak, we don't run, our teams run, but we run 35+ manufacturing facilities across the country. So we've, of course, taken deep bets on manufacturing-led businesses. And we are seeing that also change in our pipeline of investments. Particularly in pharma, we've made 4 investments over the last 3 years. Historically, the sector had issues of depth, I would say, right? From an investability perspective, we had an issue of depth and scale. But that's changing in parts across a few select sectors. And that's being driven by 2 factors, I would say. On the demand side, it's both import substitution and export-led. Export-led, we've heard the story around supply chain, China +1, right? So I'm not going to repeat that. But that theme is playing out in some sectors, in some sooner than the others, but we're seeing sectors make that progression. I think on the supply side, what you're seeing actually is people getting cost competitive and moving up the ladder on technology. And I often say technology can either be used to create something innovative or become more cost competitive, right? And both plays are good place for you to do. And I think we're seeing that happen. As Vivek said, it's played out in autocoms. It's played out in formulations on the pharma side. We are seeing that play out on APIs and intermediates. We are behind on the KSM side. And we are going to see that play out even on the chemical side, and hopefully in a few other sectors. So we continue to be bullish on manufacturing.
Right. If I can pass that same question on to Prakash, you also have taken serious bets in the manufacturing space. How do you see the opportunity evolve?
Okay, so we are a homegrown fund, and we have been investing in India since 2006, right? And as an investment thesis, right from the word go, we have a very focused approach on investing opportunities. What we have really seen in the last 15 years that, opportunity, the availability, sheer availability of the opportunity was quite low, way back in 2006, 7, 8, 9, 10, and where we, of course, could find some and, back those companies. But of late, what we are seeing, and especially, I'm realizing it in the last 2-3 years, especially post-COVID, the number of opportunities which we are able to see and the quality of those opportunities, whether it is quality of business, whether it is quality of management, the entrepreneur himself, very confident about the opportunity and all that, we are seeing a very, clear change in terms of those opportunities which are presented to us, and very difficult to say. Can we say no to those? I will have to really think through, right? So I think this is one good change, one happy change, from an investor's point of view, that there are number of opportunities, right? And secondly, where I really want to, stress on one point is that, see, in around India, this entire skill-based manufacturing, India has a very large pool of, skill set which is available, right? Backed by, your English-speaking population and all that kind of stuff, right? And we are clearly seeing in some of the businesses that why someone would come to India and not go to, let's say, China, of course, is China +1 strategy for everyone, but not go to any other geography, right? So I think there is a very strong combination of skill set, the opportunity itself. What one will have to really see that, are you able to capitalize on that? And we are very hopeful that, some of these things are going to pan out in the next 5 to 10 years.
Right, so the next decade is looking encouraging for manufacturing.
Yeah.
Yogesh, what would you like to add? Same question, really. Your thoughts on the opportunity we have to become a high quality manufacturing hub, globally competitive manufacturing hub.
So let me stick to my day job, which is to look at things as a lawyer. I think from 2015 onwards, what we saw was that manufacturing was moved back into the limelight, and I think the government was the government was more aware and did many more things to bring the focus on manufacturing. From simple things like ease of doing business in India, from making it easier to apply for licenses online, though I'm not saying that everything is hunky-dory, but I think things have significantly improved. And if you stack up all those little things, it has contributed very significantly. I think the other thing that we are seeing is that between the states, there is a lot of good, healthy competition. And truly, manufacturing is being seen as a tool for social change as well. So which is why the state also comes forward and nominates areas and says, here is a developed piece of land and I'm willing to provide you this incentive and other things. Far better and far more evidently than what we used to see in the earlier years. I think having said all of that, as a what all would I like to see, I think my ask would be very simple. Very primary things like focus on rule of law. We need to be consistent. Whatever good work is being done can be taken away by one single regressive, retrospective step, even today. And the entire world is watching us. So we need to be even more careful. Number two, things like insolvency and bankruptcy code. I think we need to work very carefully to implement it. We need to work on the amount of staffing in our NCLTs and our higher judiciary and work on how we can solve larger issues regarding enforcement related issues. And other than rule of law, I would say focus on R&D, because I think, like Vivek pointed out to you, that you cannot just be a factory of the world anymore. You have to be a smart factory. So R&D, innovation are very important. There are many sectors where still there's no availability of capital. And we can talk about later, but things like defense, there has been very little capital that has been available for those sectors. So that. And I think the last and most important thing that we as lawyers tend to get asked is our IPR enforcement laws and regulations. We've seen very positive improvements and a recent move by the Delhi High Court to set up a separate High Court bench on the original side to be able to look into IPR enforcement measures. I think those kind of things are extremely important to make sure that this apple cart keeps moving along.
Right. Thanks for that perspective, Yogesh. I want to talk about the PLI schemes now, and the government has put significant weight behind those, tens of thousands of crores, spanning 13 sectors. We're likely to see design-led incentive schemes also in the future. So I want to get the panel's view on how successful they have been and how successful they can be in encouraging, class-leading global manufacturing in India. Vivek, if I can start with you, Sona Comstar, of course, is a supplier to some, really established global OEMs, and in sectors such as electric, vehicles, which is a significant, generational opportunity, if I may. How do you see the, schemes like that, pan out, when it comes? I mean, there's differing views, right? There's one view which says that it has enhanced capacity, and another view is that it may be looked as a sort of a viability gap funding, which is what you were mentioning, Pankaj. The other way to look at this is also that is it enough to just create capacities, or do we also need a technological component linked to that? So we're also moving up the technological value chain in manufacturing. So your thoughts on that, Vivek?
Sure. I think one PLI should not be called PLI, it should be called PLI. At least in our case, it's technology-linked incentive because it's not production-linked PLI. If you've seen the list of components that qualify, if you make Indian parts, look at pistons or cat onward, you get nothing. How much is the PLI as a percentage of just auto output? It won't be that much. Yes, what it does is it enforces a positive bias towards technology led capacity enhancement, which is what is the right way to approach this problem. Not just say generically put up capacity and we will reward you. So yeah, I'm a believer in manufacturing. It takes times. Once you sow the seeds, the saplings come out in 3-4 years, and to become trees, they take 7-8 years. It's slower than other sectors, but the result is far more long lasting. Unlike others where the technology obsolescence cycle is much smaller, here because let's say a platform, I know more about our industry, so I'm speaking about that. Any powertrain once developed has to last a minimum of 10 years. And it's a billions and billions of dollars in investment. So once you do enforce that change, the benefits of it are much longer. So yeah, I think this is the right approach, to be honest, and not just blind PLI, a technology-led PLI.
Now, do you agree that, in the creation of an ecosystem around manufacturing, let's speak about pharma particularly, we have started to do well in certain areas. What's the road ahead, beyond, APIs and generics? Let's look at the creation of pharma parks, plug-and-play facilities which were supposed to give confidence to investors, make setting up, manufacturing in India easier. Do those elements linked to PLI schemes also help?
So, overall, I would say it's a step in the right direction, right? Either PLI or pharma parks. All these steps, as Vivek said, rightly said, right, they reinforce the commitment and create this positive virtuous cycle. And so the first step is important. The second question you're asking is it enough or not? And do we need to do more around it, right? I think that is always debatable, whether there are more steps you could take. So for example, can you do more on the biotech side? Can you do more which is linked to R&D and therefore true innovation in pharma versus production? So you can always debate and say there's more to be done. And you can always also say beyond PLI.
What side of the debate are you on right now?
No, so I would say it's a step in the right direction. And of course, you need to do more to create the overall ecosystem to enable manufacturing.
What could those things be?
So for example, I mean, one of the things I said is, right, really focusing on R&D and innovation. That could be one of the things. B, if you're trying to bring manufacturing, to take an example of pharma, if you're trying to bring manufacturing of certain molecules within the country, are you creating the full ecosystem to enable cost competitiveness in the country, either from a labor law perspective or power supply perspective, right? So you have to look at it holistically, but as Vivek mentioned, is the right step, the first step, yeah.
Right. Prakash, do you also want to take that question and add your thoughts on, how the PLI schemes have fared so far? By design, what they incentivize, is it just production? Is that enough? And incrementally, how do we do better technologically also and continue moving up, the value add ladder?
Right. So, when this entire, PLI scheme was launched, I think the initial reaction was very good, right? And I think it all started from PLI on mobile manufacturing, which itself is almost 50,000 crores, right? So from an overall manufacturing industry perspective, this was like, something which was out of the blue. No one would have thought of something like coming out of from government of India, right? And incrementally, it kept on expanding to other industries, right? So I think, even at, at the topmost level, there would have been a thought process that, it starts from somewhere, and then it reaches where it is needed most, right? Whether it is around something which is not there, a very high skilled, high investment, something like semiconductors and all that, right? Where, there is no ecosystem in India, and you have to, along with an entrepreneurial capital, there is another pool of capital which is available to tap and make a viable business proposition, right? I think some of these things, and then this entire hydrogen fuel cell and all that kind of stuff. So my sense is that, this is like a journey which probably will go for another 2, 3, 4 years, where we really see that how things are going to pan out. And I'm sure, even at the topmost level, these guys would be watching that, how people are able to absorb this, use it, create capacity, and, and then it becomes more like, a cycle.
Right. Yogesh, how do you think about the PLI scheme? We were discussing earlier that the way you see it, as the government has also created these schemes, particularly targeting sectors where perhaps there wasn't a lot of fundamental push or that much of a market, or the industry perhaps wasn't, very enthusiastic about producing more. To that specific point, are the schemes in their current form successful? And what can be done to enhance, that proposition further?
So see, I think no one knows whether the schemes are successful because proof of the pudding hasn't come out yet. We'll all know in the years to come. I think it's a great description to call it a technology-linked scheme, because if you look at the preamble of the scheme itself, it says that the idea is to incentivize manufacturing of those products where the industry may not want to manufacture, or where there may not be any market. But we as a country and our government has chosen that those products need to be, we need to figure out a way to manufacture those. So it's a very nuanced way of looking at that. We cannot call it a subsidy, not just to save the argument for India when we have to defend it in the WTO, but even otherwise, it is not a subsidy, and that is the wrong way to look at it if anybody looks at it, right? It is meant effectively to encourage manufacturing of certain products which are in an identified list, because it's not necessary that the industry would be focusing on those products.
Since you raised the specific point of subsidies, I want to bring Vivek in again. The auto sector enjoyed quite a few of those, whether it was the MEIS scheme. How do you think the PLI scheme links to those? Some of those benefits, or let's say subsidies, were withdrawn, with the explanation that we don't need to overtly protect our industry, right? So there's only so much hand-holding, and you can only do it for so long. So how do you respond to that? Do we still need that subsidization, that sort of thinking process in the regime?
So look, 75% of our revenue comes from international markets. So when MEIS got withdrawn and replaced with RODDEP, it did hurt us. When money goes away, you do feel the pinch. But just on an intellectual basis, I think that was the right thing. Why should you just export should be incentivized irrespective of what they are? Why? Then why won't you just become a commodity guy and you maximize by trading and add no value? Manufacturing's core purpose as an industry is to add as much value as it possibly can while reducing the cost of addition of that value. That is it. Regardless of what you make, that is what you do. You take raw materials, you take capital, and you take labor. You do some processes, which is what we call technology, and that converts it into a good that is more desirable than what you started out with, and hence you can extract some money. That's what manufacturing is. Why should you get incentivized for making anything? You should get incentivized for making things that as a country and as an ecosystem and the global sector, mobility, needs those things. So I think it is the right direction as a policy. If we want to make India a smart factory of the world, that is the direction we should be pursuing, and not blindly saying production linked or export linked incentives. That, as Yogesh said, was protectionist, to be honest. And I think that 90s to 2000 era of industrialization, which was about let's protect this fledgling industry, let it become something, and then we will let them play with the big boys. And I think it's time. I think we need to do it on our own merit. We need to compete. We do that. And a lot of people in our industry, and some of them actually even in other manufacturing industries, have started competing with the people who were considered big. I mean, electrification, autonomy, and connected have reset the mobility industry, right? So the advantages of head start that the Western world and the Western companies had for 30, 40 years, they're gone suddenly. We are as good as them. And if you take engineering talent, pound for pound, I mean, Indians can go against anybody in the world for engineering talent. I mean, you go to any of these automotive leaders, you look at the engineering talent there. You go to the engineering department, most likely you'll find people who look more like me than, than a gentleman, let's say, called Rainer or Matthias. They will look more like us or Asian. We have the talent. I think our people's skills, especially in engineering, is the greatest asset we have as a country. If we can monetize that, if investors also, and I think Paddy said that you look for management teams, you look for entrepreneurs who have that vision, that drive to harness and own technology. You know, that JV age is also passing. We need to own and develop our own technology. R&D, I think Yogesh said that R&D needs to be encouraged. That is one step that I think we've still missed out. I don't know how to do it. I'm not a policy maker, but somebody needs to encourage that. We spent like 5-6% of our revenue in R&D, but not because we get any incentive for it, because that is literally the ethos of our business. 1/6 of our employee force is R&D engineers. That's our USP. But there's no incentive for it, except for, of course, success. But capital markets have been fairly good at recognizing that differentiation, by the way. So I think more of that, but apart from that, I don't think I can complain. In the last 4-5 years, from a policy perspective, we've got more than what we expected, to be honest. I never thought governments will do things for us.
Does the panel concur with that view? Okay, so I think everyone is in agreement, and with that, I'd like to move on now to, an export focus also, right? The PLI scheme is by and large geared towards domestic production, but we also need to become a factory of the world, is of course make products that are globally competitive. And our Asian pairs are able to, do that fairly successfully, whether it's the cost of logistics, labor, infrastructure, ecosystems. We have fallen behind in some ways. How can we sort of, recoup that opportunity, if I may use that word, and, what opportunities then do we have, and what will have to give way so that we can actually, China plus one, has been the discussion ever since COVID, that we saw large-scale supply disruptions. What can really be done to now seize that opportunity? For new enterprises, it has been a challenge of scale. Investors have sort of, Padmanabh, you are also, you have to generate returns on the investments that you make. So that takes, there's a gestation period to those things. How can you facilitate, the industry to generate scale? Whether it's backing it by capital, strategic investments, skill set development, what will have to give way essentially? Prakash, if you would like to take that first.
Okay. So, when we look back, that, what you really, what is really missing here, right? And when we go out and talk to, some of the companies where we have invested in, or even some of those customers who are sitting in the Western world, one thing which is very common is around supply chain, right? And, this is my personal experience. And when I was talking to a guy, sitting in US, he says, there is a lot more India can do, right? But how do we get that confidence that, you will be able to meet your supply chain? So my sense is that, supply chain vis-a-vis China, their comparison is only China, right? So from their perspective is like, their working capital cycle is going to be elongated, what will get stuck in India and all that kind of stuff. So my sense is that supply chain is one big, concern somewhere, which is there, from those global guys' perspective. And second thing is, which is all around, that around this, labor laws, labor practices and all that, right? And this is something, which is, in manufacturing, you employ a lot of people, right? And the practices which are there, these are different all across the country, right? You would have something in the north, something in the west, something in the south, right? I think there is a lot more thought process which really needs to go into, government tried doing something around labor code and all that, which is, of course, is a little bit in the back burner. But I think some of these elements, supply chain, labor and all that, and there could be more, but these are two top of the kind.
Sure, but Padmanabh has something to add.
Yeah, no, I think on scale, obviously, as you said, and since we have an arm which focuses on infrastructure, including investment in logistics, ports, etc., we have good visibility. So there are improvements happening in India. And finally, your factors of production have to become competitive, as you said, to get the return on capital. But I just wanted to add that it's, of course, scale is important, and the vision of the management and their execution ability to ramp up obviously will provide for that, and us as capital providers providing capital at scale. But it's, to me, for that export story to play out well, it's not just about scale, it's about quality and brand. I think that's where we must score, and our companies must score, if we can have a broad perception of high quality. It's not necessarily it'd be disruptive in terms of technology. A lot of our companies can be fast followers in technology rather than the innovator. But doing it with quality at scale is what is important. To me, that combination is what will help us get recognition as an export market. And finally, it has to leverage off the scale that domestic markets provide. Unlike in IT services where it was not based on the domestic market, I think in most aspects of manufacturing, where India will thrive is where we also already have reasonably sized domestic markets.
Right. Pankaj, do you agree with that?
Yes, I agree. I mean, how India can benefit from supply chain disruption is like a favorite topic of mine. We made 3 investments in the last 2 years on the back of that thesis. And as I've heard the panelists say, right, to take advantage of that, you need scale, you need to supply at quality, and you need to supply at the right cost. And we often ask global buyers, we often hear global buyers ask, am I truly de-risking completely by buying from India or not? Right. And do I have enough scale players from whom I can buy? The problem probably isn't there in autocoms, but it's definitely there in other sectors, right, where people question, are there enough scale players for you to do it? And I think private equity can play a role in accelerating that journey of creating scale. And there, of course, we can look at regulations even in a more liberalized way, right? Can private equity really be seen like strategics, or you look at that capital in a different form and shape because they're essentially not strategics, right? And can help create scale in the sector. So some of these things can help us accelerate the journey and take benefit of this entire supply chain disruption.
So that distinction helps. Yogesh, I mean, we're almost running out of time on this discussion, but before we, wrap up this conversation, I want to talk about defense. That's a space, you work in a lot as well. We haven't really been able to, we have a significant part of our budgetary spend is also towards defense, but we don't do a lot of cutting edge manufacturing there. What's the opportunity there?
So see, I think 13% of our budget goes towards defense. And if you take out pensions and all, and I'm struggling to convert this into US dollars, but the defense capital outlay budget for India is 1.52 lakh crore per year. Right? Of that, 68% has been allocated towards the domestic manufacturing thing. Now, defense is a very important tool in this because we need to have self-dependence. There's an increasing focus on indigenous capability. And historically, all our sophisticated arms and ammunition have come from outside except for our missiles and a few patches here and there, which DRDO and a few handful of Indian companies have done well. So we increasingly need to get investment. We are the ones who are going to be spending. So the monopsony over there works beautifully for us if we use it. So and just conscious of time, so I'll quickly wrap up here. So given that, if the way the government is looking to spend the money, if more companies are incentivized to set up bases in India and they build capabilities over here, because the way the procurement policy is, there is a prioritization that is given to a supplier based on the amount of indigenous content they have. And if you don't have indigenous content, then to that extent, you need to have an offset obligation of investing in India, right? Like you would have heard of the Rafale program and the offset partners and all that. So those being the numbers and the kind of opportunity and that being a very core base to manufacturing and with the offset incentives likely to go into the manufacturing ecosystem, I see that as the big, I call defense manufacturing as a dark horse for putting Make in India back on track.
Right. Thank you for that, Yogesh, and thank you, gentlemen, once again for being on the panel. Thanks, Vivek, for joining in virtually. I think this discussion should give us a lot of confidence in India's manufacturing story. Private equity players have attested to that, and I think we have it right from the horse's mouth. That there is a lot of optimism in this space, and traditionally, what hasn't happened in terms of private capital flows to manufacturing should now start to improve. So thank you once again, gentlemen, for joining us at Mint today. Thank you very much.
And Alicia, may I request you to please present the esteemed speakers with mementos. That's our way of saying thank you to you for taking the time out and joining us here. Thank you very much. And then, of course, please come together for a group photograph. And all of you in the audience, I continue to urge you all to post, like, share, comment using the hashtag MintIIS2022. You can also tag us at LiveMint. Ladies and gentlemen, when a few people in the audience start doing that, it's our cue that we need to give you a bit of a beverage break. So people mostly drink tea to live. I live to drink tea. I walk tea, I talk tea, and I live tea basically. It's like nice tea meet you. If you don't succeed at once, chai, chai, chai again. Everything I brew for you. Basically, let's just get this party started. Go grab some tea, coffee, and come right back into this hall for more at the Mint India Investment Summit 2022. I'd love it if I could see you all back in your seats in 10 minutes sharp from now. Thank you very much. it has. Our complete gratitude to them. An interesting factoid for you. Healthcare, the foundation for a robust economy. Attention on this screen. And the last panel of the day is on the greatest wealth of them all, health, the foundation of a robust economy. Vyayamat labhate swasthayam dirghayusham balam sukham arogyam param bhagyam swasthayam sarvartha sadhanam. Good health is the greatest blessing. Health is the means of everything. The fact that the Indian healthcare infrastructure had massive shortfalls was a well-known event before the pandemic. But the last 2 years have shown that to build a resilient economy, a strong healthcare sector is an absolute must. We discuss how India can resolve the shortcomings of its healthcare sector and what opportunities and challenges do investors see in this very important sector. May I please invite on the dais the speakers of this session, Dr. Amit Verma, Managing Partner, Quadria Capital. He's joining us virtually. A very warm welcome to you. Vishal Bali, Executive Chairman, Asia Healthcare Holdings. Good evening and a very warm welcome. Puncham Mukim, Managing Director, Everstone Capital Advisors. Manish Gaur, Managing Director, Multiples Alternate Asset Management Private Limited. Visalakshi Chandramouli, Managing Partner, Tata Capital Healthcare Fund. And Kunal Shah, Partner Trilegal. The moderator of this session, ladies and gentlemen, is Lalit Mistry, Partner and Co-Head, Healthcare Sector, KPMG, India. I hand the proceedings of this last panel of the day at the Mint India Investment Summit and Awards to Lalit Mistry.
Very good afternoon to everyone, and a very warm welcome to each one of you in this very interesting panel. Finally, working in this sector for last 2 decades, I'm glad that today we all can proudly say that healthcare is a core of our existence, of what we do, not only from the perspective of the well-being and overall the human beings' life care, but also the policymakers around the world are realizing the healthcare sector is a very important aspect of the overall existence of this human being. It's very unfortunate that last 2 years we saw that COVID India and COVID-19, how it made us realize that the healthcare sector is in a dire need for a huge investment that it requires, attention, and also prioritization from the policy makers. But beyond that, it did highlight that there was a need to bring all the stakeholders together and bring in together a cohesive efforts of strengthening the healthcare system, bringing the robust healthcare infrastructure, and overall, think about that, how are we going to finance the future healthcare system of the country? No stakeholders, whether it is public or private sector, will be able to manage the requirement of the funding that we require, build the infrastructure, and manage the infrastructure in the coming times without all of us coming together, thinking something of the new innovative models, and leveraging the large capital that exists across the value chain, across the sectors, across the stakeholders, bringing in together to drive this healthcare sector and build a sustainable, healthy India. I have a very esteemed panel today with me who've been doing the investment in the sector, being operating the sector, and also have a very strong opinion about what we should be doing for the future from last many decades. And I'm glad that I have today with me, to start with, Vishal, who've been spending more than 2-3 decades in this sector. Vishal, you have seen the healthcare sector grown from what I say healthcare 2.0 to now healthcare 3.0. What are those very important contours that are driving that healthcare sector should be brought into the priority, and how it will be very important in building a future healthy India for us?
So thank you, Lalit. Thanks for this invite, and it's a pleasure as always, and to sit here with the rest of the panel. For a very long period of time, we have constantly debated the demand-supply gap in healthcare in this country, right? And that demand-supply gap is always, from a numeric perspective, from a metric perspective, has always been seen by the number of beds. We all understand and we all know that that demand-supply gap is not going to get crunched in the next couple of years by just adding more and more beds, because that's got a limitation in terms of the number of beds that can be put in place. I think the conversation, particularly post-COVID, has changed a lot. And it's this entire virtualization of care that we are now beginning to think through very rapidly in terms of deployment of virtualization of care, along with physical healthcare environments, is the single pivot of change. For a long period of time, Indian telemedicine laws were in the making. Nothing really sort of got pushed in quick succession of time. But as soon as COVID hit, everything just changed. So I think, and the fact that if you look at the startup ecosystem today, there are about 4,800 startups which are in the health tech space. So the future truly belongs to physical and virtual healthcare together. I won't be surprised if in the next couple of years, and when I say next couple of years, maybe in the next 3 years, we'll have about 10 to 15% of our first-time consults actually go virtual. So what needs to be done is enablement. Again, from a policy perspective, I think forever, the government has been wanting to spend, or at least has a vision to spend about 2.5% of its GDP on healthcare. None of it has happened so far, but it needs to happen, because we can't continue to have a public healthcare spending of just about 1%, and rest of it coming from private healthcare. Second, I think enablement of virtual care, given the fact that more than 900 million people in this country are going to be sitting with internet access, is really the path to go. And I think if we are able to bring both of these together, we will see a very different healthcare world over the next half a decade. Thanks to the challenges of COVID, but also thanks to the opportunities that COVID has thrown at us.
So going forward, the gap that exists in the Indian health system, the biggest challenge is availability of the human resources, which is going to continue to exist as we expand the healthcare value chain with the new innovative models, ecosystem of startups, and also a new way of delivering the care. How do you see this challenge being mitigated by the private sector or by the public sector to enable the growth of the sector? Because this is going to be the core of this and foundation of this growth from here now. We do know that last 2 years there was a huge investment in the sector. Public and private sector invested in this sector. But biggest challenge is availability of the human resources in public and private sector. How that will be taken care?
So Lalit, I think the biggest challenge is definitely going to be not capital, it is going to be people. Because I think there is enough and more capital, and with all the capital that is even sitting in this room today, there is enough and more to be deployed behind healthcare enterprises. But I think people is going to be the main crux. And when I say people, it is both the medical and the paramedical side. We need reform to happen in that space. We need massive reform, while a lot has happened in terms of the medical education side, but I don't think that's even today enough. You can't be building medical colleges and 10-acre campuses, right? Because all of that needs to change. More importantly, nursing education has to get completely transformed. On the way that rules have changed, many nursing colleges, because they belonged under the trust umbrella, have actually shut down. So we are actually graduating lesser number of nurses today than what we were doing 3 years back. So until and unless that reform process takes place very quickly across every state in the country, then only we will be able to bridge the gap on the talent side. Obviously, I think the third big factor is also management talent, but the good thing is that you now have more and more people coming into the healthcare sector from other sectors, which is good because they're bringing new ideation. But to my mind, I think until and unless we resolve for the medical and the paramedical talent, no amount of capital will be good enough.
As you rightly said, the availability of the capital will not be a challenge, but availability of the human resources will be a challenge for the healthcare sector, which has been a challenge for last many decades. But the important thing is the way the healthcare sector is shaping and the way the consumer is demanding the healthcare in India. It will require a very skilled, large number of human resources to fill this gap, and very immediately, in fact, on a high priority. What also is happening is that availability of the capital, although has given the growth to this sector, one of the biggest challenges, all of this growth is happening in compartmentalization. The private sector is working differently, the public sector is working differently. There is a very limited coordinations and integration of the policies, reforms, and implementations. How do you see going forward that if you have to build a healthy India, how are those public and private sector need to work together in this sector?
So I'm sure that others have more ideas around that, but I think we today work in two compartments on the education front, starting point, right? Unlike in many other parts of the world where clinicians in the private world actually have teaching assignments on the public side, and likewise, the public side participates with the private side, particularly on the clinical relationships. We don't have much of that in this country. So either you are sitting on the public side or you're sitting on the private side, and there is no integration. I think it starts from there, because if one were to look at the talent gap, which starts on the medical side, the fastest way is for the two sides to come together and work together. The second one, which I think has been done in bits and pieces and pockets, is this entire public-private participation, and nobody in the private side actually believes in that. Basically because it has been completely one-sided, where there are no returns at all for the private side. So if both have to come together and do a combined ecosystem, then the PPP model itself needs a new definition. Otherwise, it will remain in documentation. So that's another big area where, because there is a lot of infrastructure which is sitting on the public side, there is talent which is sitting on the private side. How can you even augment that talent to go and look up that infrastructure which is on the public side and work along with that? There will be a big uptick of the number of beds that can be created in this in this sector in this country.
Okay. Let me bring in Pancham Mukim, Managing Director, Everstone Capital Advisors. Pancham, Government of India has, in the last 2 years, came out with a lot of policy changes around the telemedicine, National Digital Health Mission, or an Ayushman Bharat Digital Mission to drive the digital health ecosystem in the country. Also, there was a larger awareness, adoption, and I would say is acceptance by the consumer about the virtual care, which was never existed in last 2 years. How do you see this space, digital health providers coming into the larger ecosystem and helping in bridging the gaps that exist today in the Indian health system?
Thanks, Lalit, for having me here, firstly. I think what Ayushman Bharat has done Ayushman Bharat's digital mission has done is, it is probably the first serious governmental effort at aggregating a massively fragmented ecosystem, right? What this will, or what it can potentially do, and several private players have attempted that in the past. India is a very large out-of-pocket market. It has a very large general physician OPD market, which is outside the hospital and the institutional network. Once people have their unique health ID, once medical records go electronic, I think that'll be a massive step up for the patient, right? It increases the interoperability of one patient moving to across multiple hospitals. It increases power. It gives power to the patient, gives voice to the patient, because he's not then dependent on one doctor and his treatment so far, and carrying his papers of multiple years of treatment into another network, right? So all of that sort of changes, or could potentially change, once hospitals start integrating their HMISs into this digital mission. I don't know how that will happen, when that will happen, how long it will take. Service providers will have to sort of work on their technology at the back end to sort of start integrating this into the digital mission. It's still some time away where full integration happens, but it's a great initiative where at least the patient has a voice now, and the patient and his treatment is priority versus just, doctors are gods in hinterland, for example, right? And that can change. There is more accountability that can come in, more data, and, treatment methods will change, right? They'll be more scientific rather than just an experience, right? Healthcare, which was so far just sick care, can actually be healthcare now, right? And preventive healthcare can actually take a big boost from this.
And do you think there is a need for a larger support for the digital health ecosystem, both from the policy perspective, regulation perspective, and also from the acceptance perspective from the existing traditional healthcare providers, to work with the digital health providers to enable and create both forward and backward integrations that can enable a better delivery system in the country?
I think that's already happening, right? You have, players like PharmEasy who have created some of these models already. There are other businesses like Pristine Care, M-Fine, etc., that are working with hospitals, integrating their digital offerings, their technology offerings with the hospital management systems, information systems, and making sure that their interfaces, hospitals have digital interfaces now, right? This was not the case till 2-3 years back. It was very, very scattered, that attempt. Post the pandemic, post some of these government-backed initiatives, that's taken wings, right? And this will sort of take a few steps ahead in the next 2-3 years as some of these businesses become larger, start spending more dollars on some of these initiatives. It's to do with how much you market yourself with capital, right? And that's the only way to educate a patient, to educate a person that you could do this as well. You could move your healthcare records from here to here, right? And that will put accountability back onto the doctors and the hospitals.
Well, I am sure that last 2 years, what we witness is not only between public and private sector, but also the providers across the value chain, that we moved away from competing to a complementing ecosystem, I guess. And that is something which created a larger synergy, integrations, and creating a very patient-centric value chain. And we saw a lot of new value chain emerging in this from traditional care. And I think this will continue to grow with public system, private sector integrating or not. But I'm sure the providers and the partners across the value chain, which include the hospital players, medical devices, pharma companies, diagnostics companies, research, a lot of them coming together in creating new value chains. I'm sure we will have multiple value chains across in going forward. I'm sure this entire ecosystem will change. Let's move to Manish Gaur, Managing Director, Multiple Alternate Asset Management Private Limited. Manish, in the digital health, what we've been increasingly witnessing is there is a larger focus on the overall disease management aspect of it, more focused on a disease management, outcome focused, and lifestyle management. How do you see this space enabling in a better care, creating a preventive and a wellness ecosystem, and taking that care to right inside the home actually? How that is going to continue to grow, and what's your view on that?
Yeah, thank you, Lalit, for having me here in the first place. See, I think as the economy grows and as our GDP per capita crosses that important threshold of $2,000–3,000 per capita, I think the overall wellness becomes more and more in people's mind space. And we have seen this across sectors, not just healthcare. If you look at consumer, if you look at so in the technology sector, I think a number of new initiatives which are happening, which are just focused on overall better eating, healthy eating, better exercise regimen, and so on and so forth. I think that overall awareness and number of companies which have come up to actually encash on that business model, which has been getting funded from all kinds of players sitting on this table or across the ecosystem, you are seeing that already proliferating. For example, India is a diabetes capital of the world, right? And we are seeing a number of companies who are trying to figure out how you can give comprehensive care to diabetic population, which is not just about continuous screening of blood sugar levels. It's also about what kind of food they eat, what kind of physical regimen they should have, and as well as what kind of preventive care their children can take because they are more susceptible to those diseases. And I think across all of this, we are also seeing technology play a very important role. As we say, every deal you evaluate these days is actually a technology deal, irrespective of the sector you are doing it in. And that's because with the increase in computing power, as well as with the increase in AI ML capabilities, I think we are able to predict things much better now. And that trend, I think, will continue. Be it the amount of work that is happening on genome sequencing, be it the amount of work which is happening on the entire better prediction of cancer recurrence, for example. One of our portfolio companies is Quantify, which has done enormous amount of work for people where they have been able to use specific markers and predict the amount of cancer recurrence probabilities. They've also done some good work in predicting hemorrhagic instances. So what I do see is that the abundant availability of technology is playing a great role in overall management of the disease and not waiting for a thing to occur and then trying to solve it. And I see that trend continuing to accelerate at a very fast pace.
Do you think we are moving towards a more value-based care and outcome-focused care in India, maybe not very immediately, but 5 to 10 years down the line? Are we moving towards that with your invested company and a lot of patients also looking at what is an outcome, what I gain by investing in the health, whether it is in terms of preventive healthcare or wellness? Do you think the consumer is now looking at what is that getting out of this care, investing in this? And do you think this is a kind of trend that you will see in going forward?
Yeah, no, definitely. If you see the whole value chain, right, I think as you rightly pointed out, earlier healthcare was about you get a disease and then you try to manage it. There's an increased awareness of, making it very clear to to the larger populace that you can do much more to avoid being in that place in the first place, be it through regular preventive health checkups. I mean, government has done some work there in terms of giving tax benefits for that, or getting into scenarios where insurance penetration is increasing. The whole idea that you can actually reduce your costs post facto by actually getting yourself insured. And if you see insurance companies, they are trying to tell you that you will get lower premiums if you do preventive health care. So I think people are trying to become less reactive and more proactive about the overall health management. And I do see, as I said, that will probably proliferate much faster, because all these things you can do once you have reached a certain level of per capita income. I think initially you are more focused on survival. And I think as the economy grows, other factors come into play. And I think some of these business models are evolving and are growing very well. And I would see that a lot more holistic healthcare is likely to emerge over the next 5 to 10 years, supported by government initiatives as well as private capital.
Great. Let's move on to Kunal Shah, partner Trilegals. Kunal, with the last 2 years, the policy changes that happened, the way the public and private sector have come together, the way the consumer or the patients have accepted the new change, emergence of the digital and virtual care, there has been a lot more adoption of new trends and technologies that have been existent for a long. How do you see going forward the overall regulatory framework changing? And what are those important contours that that are required to create a very robust ecosystem where both digital and the physical care can work together and the patient interest could be safeguarded going forward?
Thanks, Adit. So, it's curious. Everybody on the table agrees that one of the biggest issues that we face in the Indian healthcare sector is the lack of human capital or trained people, which when you look at our country, which has a very high demographic dividend, and younger population, begs the question, what is it that we need to do at the back end to actually help healthcare? And that's where I think policies, regulations come in. So I'll give you a few simple examples, right? In other, when you go to more developed countries, for instance, in every square kilometer or 10 square kilometers, there is a medical college, there is a nursing college, and there is a hospital. Now, the disparity in India, vis-a-vis at least just access to hospitals or even just primary healthcare centers between the urban centers and the rural centers is massive. So the government needs to bring in policies which help that. And what could those policies be? So, it was mentioned there's enough capital in this room. Generally, compared to 5-10 years ago, the access that India has, not just in the healthcare sector, but even in other sectors to capital is quite high. But the entry barriers for capital are so complicated. Let me give you an example. If you want to set up a hospital, even in semi-rural Punjab, for instance, your first challenge is where do you get the land? How do you identify land to get the hospital? Because the government is not necessarily going to provide it to you that easily. Your second question is your title diligence on the land. Your third question is your stamp duty on the land. By the time somebody gets into the process of setting up a hospital or even a primary care center, whether it's through purely private route or public partnership route, there is a level of exhaustion. And returns come in much later. I'm just saying, even if you want to look at this as a sociologically sensitive sector, where capital is required and PPP is required, the back-end infrastructure needs to be strengthened. So the policies need to make it easier to invest in healthcare. Now, whether that's nursing colleges, that's one side, whether that's more doctors, whether that's the availability of land, that's something that needs to be improved. I think he made a very interesting point on insurance. India is one of the larger, we are not a welfare country from a medical welfare perspective at least, because there is no, Ayushman Bharat has started, but there is a long way to go for that. So everything that a patient has to spend is out of his own pocket. So the mentality is to avoid going to your doctor or to primary care center till you have no choice but to go to that place. So if you want to change that mentality, I think investments in the insurance sector, which back up, medical insurance, which back up healthcare, become very, very relevant. Again, there the government can come in. The entry barriers to start an insurance company in India are massive. So healthcare is incentivized by that. So I think if we help the infrastructure around healthcare, that will add to making healthcare more robust and, add to our demographic dividend, and now this has become a personal issue for all of us. Post-COVID, if you're not healthy, your productivity is immediately affected. And if you look at the most successful individuals, generally they have their professional life is extended because they've managed to take care of themselves. So from a government perspective and from an economy perspective, healthcare should be, in that sense, your primary sector where it needs focus on. And the government should do everything they can to be able to incentivize that, but not by entering into the business of healthcare, by making it easier to enter into the healthcare sector, whether it's for private participants in India, whether for offshore capital or otherwise. So I think that's something that the government can help in terms of policy changes.
What we saw in last few decades across various other industries and sectors, government doing an economic development agenda, bringing in the policies, reform, resources, and bringing the public and private sector together. We have also seen recently in last 2 years that happening through a production-linked incentive for pharma and medical devices. Do you think now there is a need for creating similar ecosystem and economic development agenda for a healthcare sector, which not only makes the availability of the capital for the sector at a lower cost, but also there is a larger focus of support, as you said, on the regulatory aspect, implementation aspect, and also from the perspective of incentivizing, which you said, which when I speak to some of my friends in the industry, they say, we get a land at the same price, we get electricity at the same price, we pay the salaries at the same line of what other industries pay. So what is an incentive for me to invest a 200 crore in a healthcare vis-a-vis with any other sector or any other industry? What's your view on that? Do we need that kind of an agenda? And what could be a role of a private sector, especially, how could we be part of this economic development for this sector?
So I'll break it into two parts. The private sector just needs to be ready. That's pretty much the role of the private sector. The government, on the other hand, needs to, and I'll give you a few examples of the kind of incentives the government can offer which can work, right? So for instance, let's say there is a platform which wants to set up 10 hospitals, right? And compulsorily has to set up 5 hospitals in rural areas or semi-urban areas. If the government can ensure that even if the capital contribution is the same, but they can minimize the time and process in actually setting up the hospital, then that will be great, because most investors that we speak to don't necessarily have a problem in catering X percentage of any hospital to, let's say, the economically weaker section. The question is predictability. So, things like, tax breaks, stamp duty breaks, those are the obvious ones. But even if the state government and the central government don't want to lose revenue, if a greater degree of predictability can be introduced in acquisition of land, in, like a single window clearance as far as approvals are set up, having a more local level medical sort of statute of, like a RERA, for instance, but a more local level body, instead of everything being done at the central level or the state level, will really incentivize the private participants to come in a lot quicker in the healthcare sector. And the disparity that we see in our country, between cities and semi-urban areas and rural areas, will decrease a lot more. So that's where the government needs to work in, is on the back-end infrastructure.
It's very important, in fact, to bridge that gap, because going forward, the ecosystem is expanding significantly. There is an exponential entry of the new entrants. The ecosystem is changing. The things that have not been addressed from last few decades will become more challenging for all of us going forward. Issues like the regulatory framework, the data privacy, who is responsible for managing overall, the data privacy aspect, who is going to take care of the patient, whether it is a remote health management providers or a hospital provider and all. There are many changes and many issues that are open and that will require an address. Let's go to Dr. Amit Verma, Managing Partner, Quadria Capital. Amit, you are around? Amit, can you hear?
Yes, and apologies that I'm not there in person.
No problem. Amit, we have been talking about the digital health ecosystem, bridging the gap between the traditional health value chain. But one of the areas where the virtual care, the remote health management, or telemedicine, you can name it, how it is going to bridge the challenges that we have in the rural area, what we witnessed during the COVID time, the lack of availability of human resources, doctors, infrastructure in rural area was equally challenging as it was in urban area. How are the various private sectors new business models, and going forward are going to bridge this gap, and what is the role that you see as an opportunity for the private sector to invest in the ecosystem, which is more focused on the rural health management?
Thanks, Lalit. First, let me start off by saying something provocative. While we all know all the damage that COVID has done in the past 2 years, I view this as a once in a lifetime opportunity to change the paradigm of how we deliver healthcare in our part of the world. Most of us who are doctors have heard dogmas of how medicine should be practiced in a certain way, and we weren't allowed to change it because everybody would shoo you away. This is this opportunity to change anything that we had thought was normal. And that's how, when I think about what needs to change, three important things. The advent of digital technology, which includes not just telemedicine, but also the wearable technology to get chronic care sorted out. Number two, to me, very importantly, is this unique opportunity now to focus on general outpatient care, declutter the super specialty tertiary care hospitals by making the GP the paramount person for the well-being of the patient. And I'm coming to the preventive aspect over there, because God knows we will never create enough infrastructure to treat all the patients that we are going to treat. It is just a matter of time. And the third most important thing, which is the paramount thing for everything that we do in this country, is making it affordable. Just because we are poor does not mean that we should get away with shoddy quality. So if you ask me, what we need to focus on now is to create reliable, reproducible health data. As mentioned by Pancham earlier, that while we claim to be the diabetes capital of the world, if I say there are 50 million diabetics or 500 million diabetics, both of us could be correct. We just don't have the data. So if we have to come up with reliable public health policies where both the public sector and the private sector can jump in, we have to start creating data. And to me, it then starts off an ecosystem where all stakeholders will get equally rewarded, and we will create P&Ls which will start to make sense, not just for the patient, not just for the provider, not just for the investor, but overall.
So, Amit, the lack of availability of data was one of the biggest challenge in the COVID management. We've been working with the government and also with the few private sector. When we were looking at the data, to understand the health profile of the population, where the COVID was really spreading very fast, we had a very limited data of understanding about the population, their health profile, for enabling us to, have a very specific designed COVID response for us, and have a very strategic view that, what could be the patient profile which be most at a highest risk for COVID-19, depending upon the variant and all that. But this data was not available, and this data is not available even today. Going forward also, I'm not sure how that data would be available. Today, all of us are sitting in this room. We visit so many doctors, so many labs, a lot of healthcare providers that we have sought in last many years. All of that data, we do not have it. Yeah, it's like you have earned your money, but you don't have that money with you. You have all it in your bank, but you don't have your health data. Imagine your data that would be there with you for last 10, 20, 30 years. That rich data would have really been very resourceful for the providers to make a decision and plan a care regime for you, So this is going to be a challenge for a 1.3 billion population country, yeah? And we are expanding. We are growing in terms of our population, and also the challenge and the complexities. I'm not sure, the number of providers that we had earlier and compared to what we will have, it will make it more challenging for us to, aggregate this data, how this data is going to be aggregated, how it is going to utilize, and a lot of privacy, policies, regulation in and around this. Now, tell me, Amit, in terms of the going forward, the lot of startups and the providers are working in this space. Do you really think that India also needs something called as what we have seen in NHS, and KPMG has been part of it? It is like donating your health data, creating a health data bank, where every individual actually signs up and say, I'm going to donate my health data towards the country or a health bank, which is going to utilize this data. for analyzing and understanding the, the health profile of the geography or, in a population where we stay, and utilize this data in the better resource planning, overall health management, and also utilize in the better care and predict some of the infect which could prevent a lot of, diseases and the deaths in there. Do you think that India should also embark on such kind of a journey?
At the cost of sounding provocative, Lalit, my great belief is that we in India function very well when there are two incentives. Either there's a stick or there's an economic incentivization to do something right. Hoping that people will voluntarily give up the data, I don't see that happening. I think where we spoke about what the government can provide, there are two areas where I think there could be a push of pushing towards everybody enrolling so that their EMRs are standardized. And that's where I do believe the greater incentivization for people to give up their data, that will certainly lead to it. My last comment here on this topic was that till we don't have the data, this rural-urban divide is going to get personified because of lack of resources that we will see in the rural areas. And that is what we need to focus on. And I am extremely bullish about creating business models which can be very viable if we are able to capture the huge volumes that are available in those markets. And as you start to see the democratization of healthcare, this will become increasingly important and has to be a go-to area for investors.
Agreed. Now, let me go to Visa Lakshmi, Managing Partner, Tata Capital Healthcare Fund. Visa, you've been investing in healthcare startups and businesses. As Kunal mentioned that, the healthcare providers generally take a lot of time, to break even. There is a gestation period is very high. There is a regulatory framework, operating complexities, increasing challenges on various aspects of, the expansion and others. What are the key aspects that you suggest going forward, especially to focus on bringing in the innovation in this sector? Because at times, this challenges actually kills the innovation at very early stage. Some of the innovation can help in prevention of the diseases, early identification of the diseases. But due to the challenges that exist in this sector, which is legacy issues in the sector, also from the investor perspective, what are the challenges and what are the enablers that you think that can help us to bring in the innovators and the new startups in this sector?
So thank you so much, Lalit. I think this question about startups, I don't think startups are the only ones who need to address innovation. I think it's a prerogative of the entire ecosystem, be it the biggies, the corporates, the NGOs, or be it even the startups. But specifically, since your question addressed on the startups, I think the ultimate purpose for the startup is how big of a pain point are you addressing? What are the key issues, the key macro issues? And especially since a lot of us talked about healthcare, maybe I want to talk a little about, within the pharmaceutical sector itself, India is so unique in terms of a dual challenge of both chronic as well as an acute challenge of disease, in terms of the disease pattern that we are addressing. So there could be startups which can address that particular challenge. How do you bring about, say, a platforms, or how do you have specific startups which address this chronic challenge, be it on a systems basis, be it on a product basis, or it could be in terms of addressing pure infectious disease, etc. So it's not necessarily the prerogative of a challenge. From an innovation perspective, if you look at the entire ecosystem, right, and here we are touching upon life sciences, we are touching upon healthcare delivery, diagnostics, medtech, etc. Across the entire system, the ultimate innovation needs to be what is it that brings the patient and the doctor together in a more effective way. So, given the fact that today access is the biggest challenge for us, so can the innovation need not be something that is addressing a big problem. It can address a problem in terms of accessibility of healthcare. It can address a problem of the disease areas. It can address the problem of supply chain. So that's where that entire, the challenge for the startup. So what is the big purpose that this particular startup is addressing? I think, they need to think about that larger purpose. So.
You have worked in the pharma sector for a pretty long time. The pharma sector has really made us proud, all of us. India is considered as a pharmacy of the world. There's a lot of learning from that sector, if we have to take from the last few decades. What are those key learnings that you would suggest that, that healthcare sector can take up, and become maybe the healthcare delivery hub of the world or this region? What could be those contours?
No, true. I think from a pharma sector, see, clearly pharma sector is now, I think since the 70s, the fact that the sector got the advantage of being able to take advantage of the process patents that were there in our country, because India was still not a signatory to the TRIPS until 2005. So to that extent, I think pharma sector had that head start. So by virtue of that, and the fact that there is a huge talent of chemical engineering skill sets and the chemistry skill sets, I think that talent was available in the country, and we had educational institutions that helped in producing chemical engineers, chemists, synthetic chemists, not necessarily biologists, but people on the medicinal side, people on the bench chemist side. I think that was a big, I would say, an advantage which the pharma sector enjoyed. And the second advantage was the manufacturing advantage. From a manufacturing standpoint, I think given the fact, today we proudly say India has the second largest number of US FDA approved manufacturing units, right, after the US. But it all started with the chemical engineering advantage. So we had the ability to manufacture for the world markets right from the start. So we didn't go sequentially. So we were not just domestic manufacturers. And I think over a period of time, through constant learning, I think those, that's what made today, the pharma sector today the largest generics hub in the world. Now, if you were to extrapolate these learnings to the healthcare sector, I think a lot of us said that talent is the biggest issue today in the healthcare sector. I think, you look at every specialization, not just physicians. You look at some of the specialty physicians, say an oncologist, a radiologist. For a country of this size, you only have about 12,000 radiologists in the country, right? And the scan volumes have grown exponentially, but that's not enough to address that. So can you have another parallel system where you're able to generate healthcare workers, healthcare administrators, and the entire healthcare talent ecosystem in a massive way, like how we produce chemists or like how we produce the manufacturing people? I think that's the challenge that the healthcare industry needs to look at. So if we have the people backing, I think capital will flow. I think we already have we are now at a situation where global talent is at our doorstep. It's a matter of, and we have, I think, been innovative enough to identify asset-light models of doing business such that it is, it helps, it is beneficial, economically beneficial for the investor, etc. So my sense is that even the healthcare system, healthcare industry can take a lot of learnings on this. The one final aspect is, I think, in the pharmaceutical system, there were, I would say, several homemade entrepreneurs today, and each of these entrepreneurs today are big conglomerates in their own right, in the top 10 pharma houses that you see in the country today. They're all people who have built institutions out of from starting on a standalone basis. And I think a similar kind of an institutionalization from a management framework, if that can be also adopted, I think it will go big for the industry.
Sure. I guess there's also a challenge in the sector, both from the policymaker and also from the patient perspective, is the profit that is attached with this noble profession and the sector. The moment the profit is attached to a healthcare sector, the eyebrows raise across the value chain and the stakeholders. I've been part of private sector and public sector, and all they believe is why the profit is attached to this sector. Okay, and I believe that we are in a sector where there is a profit with a purpose. Okay, this is a series that we run across the globe, advocating that the sector is very noble, but for you to grow this sector, there is a need for involving the private sector and the investors. Unless there is a profit to this purpose, you will have a very limited number of participation from the providers, investors, and the businessmen, and without which you will not be able to create a value system or a robust health system for the future. Vishal, your take on this, last few minutes on this.
So Lalit, absolutely yes, right? Because first of all, I think we are building enterprises on other people's capital. We have a fiduciary responsibility for the return of that capital. And I think healthcare is a societal mission, but given the fact that there is so much of private capital that has gone behind building private healthcare enterprises in India. In fact, I don't think that any of us would have been in a position to receive the quality of care that we receive today if private capital in this country had not come and supported the healthcare sector. And that requires a return, right? Because there is a momentum to that. So we are at a very good position as a country and as a system in terms of the opportunity that we have to scale up this sector. There are different models that we now have, whether it is the multi-specialty healthcare delivery side, the single specialty delivery side, the entire technology-enabled healthcare ecosystem that is getting created. And all this will be sustainable and it will be profitable. And those profits going back into creation of more infrastructure should be the sole purpose here, because that's another way that we want to bridge the gap. But return on capital is something that we can't close our eyes to.
I agree with you, because all of these resources are going to drive and enable us to build a sustainable healthcare system for the future. It's very important that we realize that today each and every individual values the importance of the good health for the family, investing in the healthcare. And I think that as a stakeholders, whether it is a public or private sector, we are at a very right stage to be part of this, the next phase of the healthcare sector, where we believe in creating a sustainable healthcare system. The healthcare system, which is not only, we believe that it's a cost to the, the economy, but it's also going to drive the GDP of the healthcare sector and the country. So let's give it off from here. And thank you everyone on this panel for your time and your opinion. Thank you very much, and thank you everyone.
And thank you to the moderator for taking these proceedings forward. I'd request you now to please present the esteemed speakers of this session with mementos. It's just our way of saying thank you to all of them for taking the time out and joining us here. Ladies and gentlemen, let's all please put our hands together for this last panel at the Mint India Investment Summit and Awards, as enriching as all the others yesterday and today. Thank you very much to the speakers. I'd request you to come together for a group photograph. Please do come together for a group photograph. And all of you are esteemed delegates. I hope you will continue posting, liking, sharing, commenting your thoughts, views, and experience at the Mint India Investment Summit and Awards, where we talked and talked and talked about investing for India. I, Geetika Ganjudhar, thank you all for being such a fantastic audience. A loud cheer for the entire team that put this summit together. Thank you very much. Ladies and gentlemen, do have a great evening ahead, and we will hopefully see you at the next Mint India Investment Summit. Until then, keep dreaming, keep building a brand new India for our future. Namaste and Jai Hind. I, Geetika Ganjudhar, welcome you all to the Mint India Investment Summit Awards 2022. It's so good to have you all here. Esteemed industry captains, sector experts, society thought leaders, and members of the fraternity, all building together the future of the Indian economy. Thank you all for making the time and joining us here this evening. Thank you very much. The summit this year, ladies and gentlemen, has had the presence of a packed house on ground, and huge numbers have logged in to watch the live streaming online on our social media handles. We've had 2 days, productive ones, of brainstorming with the sharpest mind of India Inc. and the investment world, talking about how we can make India a bigger attraction for global capital as we aspire to achieve the goal of a $5 trillion economy. Astute observations, constructive critique, valuable predictions, and path-breaking solutions have all emerged from these 2 days. Had to happen. On stage and in the audience were the architects of the India of the future. Good work will be done to get us far, and may I also state that good work and great work has been done to get us this far. And that is why it is most apt, fair, and also desired that we recognize the ones who've created the India that we live in today. A great nation, yesterday, today, and tomorrow. And thus the Mint India Investment Awards, a grand end to the Mint's annual 2-day flagship event, Mint India Investment Summit, which is widely regarded across sectors as a key thought leadership platform for the private equity, venture capital, and investment banking industry in the region. The Mint India Investment Awards was institutionalized as Mint's endeavor to recognize the best minds in corporate deal making, investment banking, mergers, acquisitions, private equity, and the venture capital industry, and are celebrated as one of the most coveted awards amongst the investment community. Ladies and gentlemen, this is the 3rd edition of these prestigious awards. Some of the past winners include Mr. Hemendra Kothari, who also is here with us today as our guest of honor. Today, Mint is awarding investors and entrepreneurs in the following 4 categories: Venture Capital Deal of the Year, Private Equity Deal of the Year, M&A Deal of the Year, and Deal Maker Hall of Fame. To open house, may I please hand the podium over to Mint Editor-in-Chief, Sutajit KK, for the opening remarks. He will also set the context for these awards and introduce us to the esteemed jury of these awards. Good evening, sir. Over to you.
Thank you, Geetika. Good evening, ladies and gentlemen. A very warm welcome to all of you to this award ceremony of the India Investment Summit. Yesterday and today, we discussed what an exceptional year this has been for India's investment landscape. And this evening, we are so pleased to be able to celebrate exceptional individuals who have made this an extraordinary year. We have chosen winners for the best private equity, venture capital, and M&A deals through a jury process. We drew up a shortlist using deals data from our sister publication VC Circle, and then an elite jury decided the winners. The Dealmakers Hall of Fame Award, which is given for a lifetime of achievement and service, was picked by the Mint Newsroom. That's me and my colleagues. This evening, we look forward to celebrating excellence in investing and deal making, and we are so pleased to have with us some of the legends of Indian finance. Mr. K.V. Kamath, a titan of both industrial credit and retail banking revolution in this country, is our chief guest this evening. A very warm welcome to you, sir. Mr. Hemendra Kothari of DSP Group, a legendary investment banker. And as Geetika said, a former winner himself of the Dealmakers Hall of Fame is also here with you. A warm welcome to you and your family, Hemendra Bhai. Mr. Ajay and Dr. Swati Piramal of the Piramal Group are also here with us. A very warm welcome to you and your family, sir. I'd also like to welcome all the award winners as well as all our guests this evening who have come here accepting our invitation. Thank you all for joining us, and I hope you have a good time. Thank you.
And that was SK, as we call him, welcoming all of you to this evening. Thank you once again, everybody, for being here. Ladies and gentlemen, as he just said, we are indeed privileged to have as the chief guest for this evening a towering giant from the world of finance, really, Mr. K.V. Kamath, Chairperson, National Bank for Financing Infrastructure Development. A veteran banker, a thought leader, and truly a path blazer. He's often credited with changing the face of India's banking industry. He was the man who catapulted ICICI Bank Limited to the status of India's second largest lender. He was also the non-executive chairman of Infosys Limited, India's second biggest software services exporter. He was the first president of the National Development Bank, funded by the 5 BRICS member countries. Mr. Kamath is credited to have built the multilateral lending institution from scratch. Mr. Kamath also spent 8 years at the Asian Development Bank in Manila between 1988 and 1996. In his current role, Mr. Kamath is heading the government's new development finance institution, which is tasked to help fund long-term infrastructure projects in the country. It is always enriching to listen to you, sir. Ladies and gentlemen, let's put our hands together for Mr. K.V. Kamath, our chief guest this evening at the Mint India Investment Summit and the awards. Mr. K.V. Kamath!
Good evening, and thank you. Thank you, Mint, for inviting me. And let me in advance congratulate all people who are being celebrated today for their achievements. Congratulations. I was thinking what is the best subject that I could speak on, and whatever I think on finally coalesces down to where do we head? 'Cause I would think that's top of mind given events of particularly the last 2 years, and also the aspirations that have been set out by our leadership over the last few years. To put it in context, given the events of the last 2 years, I will probably talk on three key frames, as it were. The first frame is reset, the second is recover, and the third is research. The first clearly is or has to do with reset of minds that took place post the COVID lockdown that we had, the first COVID lockdown that we had. Sometimes we tend to forget it, but I think it is sometimes useful to recollect what had happened thereafter, consequent to the reset. First, that reset happened in a blink. It is not as if it took a long period of time. Individuals were able to take in things which they never did before and do those things. For example, I found older people getting to be very adept at using a handheld device, of manipulating a Google sheet or an Excel sheet, and of course using an app, because there was no other choice. You had to do that, and you had to use a payment system. So clearly a reset which was thought never would ever happen in our generation happened, as far as even the older people were concerned, and of course the younger celebrated it. Along with that came the providers of technology and the various platforms, and they also met, I would say, the needs and what was required for the day, and that changed the face of the recovery process. Of course, work from home, all these things became part of our lexicon. So the reset did not take time, it happened very quickly. And say about the second quarter after the reset, I was at a CII National Council meeting, and I heard for the first time somebody from the infrastructure sector say, equipment manufacturers say that their sales were up 30%. So that was the first time I heard that things are coming back faster than possibly coming back faster than what we had thought of. So the reset had happened and we were getting into recovery mode. And of course, 6 weeks later, we had corporate India saying, we are almost back to near capacity production levels. So one day I called a friend, auto component manufacturer in Chennai, and asked him, what are you running at? He says, near about 100%. So I said, are all your people back on the shop floor? He said, no, my people are not back on the shop floor. I said, then how are you managing? He said, about 75% are back. Basically, there is process change, there is technology, and so on and so forth. And we have got going with 75%. So I said, are the rest going to come back? The answer was very interesting. He said, when we expand further, they'll come back. Because at this point, they are not coming back. So I said, that should then translate into a productivity gain of, let me say, 25%. And very quickly, the quarterly results came in that quarter. And we did see that the quarterly results indicated that EBITDA levels were up 25%, profit levels were up 25%, and corporate India was bouncing back. So just I want to end this part with what was the outcome of this reset of minds and the recovery that we had. I think we came out of it with almost a 25% productivity gain, which, as any economist will tell you, to get that order of change takes a whole lot of investment and also a whole lot of time. But this virtually happened again in a blink. So I think we have all come out much more healthier and much more competitive to stand up in the global context and basically do what we do best, market our products and ourselves in that. So I would think for us, learnings from the crisis have been hugely positive. I also like to put these learnings as we go into the next phase, which is, I said, research, into, I would say, 5 Ds. These Ds are, I did not invent those Ds. I saw them somewhere, but I massaged them a little bit. And I've used this a couple of times because it bears well to understand where we are coming from. The first D is there's somebody who's heard me talk about this just 2 days back, who's smiling there, but nevertheless, I will say it. The first D is demographic. The second D is democratic. The third D is demonetized. The fourth D is digital, and the fifth one is a consequence of all these disruptive. So what does demographic mean? Not the meaning that we have been used to. The way I interpret it is demographic means it is now age is no bar. Demographic advantage was meant to be we have youth, and that is going to be a big advantage. I am now saying that demographic means that age is no bar. It spans the entire spectrum of age, as it were, and that is our advantage because everybody has become skilled in using things which are relevant today, starting with technology. The second is dematerialized, not very difficult to demonetized really, not very difficult to understand. The device on your hand, earlier on you needed probably 10, 15, 20 different devices to do. And now basically you are doing it in, with the one device. Second, a few years back, just 2 years back, we said connectivity. Oh, but we don't have connectivity universally in the country. That is no longer a challenge. Then you said that, oh, connectivity may be there, but where is the affordability? You will not be able to afford data. We run probably the cheapest data platforms in the world. So basically, everything has become available to us on a platter. The third one is even more interesting, dematerialized. It is dematerialization, again, not in the context that people talk about, but a very simple context. Let us look at things around us, which did not exist a few years back, whether it is Uber, which you take is now a given, Ola, which you take as a given, Airbnb, which you take as a given, and I can go on and on and on, which basically work from home, if you want to put it in. To me, is a dematerialized exercise where you are not materially in your office, you are somewhere else, but doing what you're doing, probably more efficiently and much more, I would say, productively in the context of overall dynamics of the organization. So clearly, these are disruptive things, and they all are, in a way, digital. So digital and disruptive is going to be a part of whatever we do. That is very clear, and that is why when I was looking at the agenda over the last 2 years, it was like, each of these was being driven by people who are here and people who have, I would say, facilitated the process of driving these 4Ds in India to a disruptive level where you can disrupt and proceed. That's at one end of the spectrum. I'll come back to this briefly in a moment. But if you look at then what is happening on the path to resurgence, I think there are several drivers, and the government has been very clearly articulating what these drivers are. Yes, we have a lot to do in the entire infrastructure space, and in infrastructure I would use a broader definition of infrastructure. We should start with looking at getting our water equation right so that we have both carbohydrate and protein met. So we get the water equation right, and there's a whole lot of infrastructure involved there. Then we get into the conventional infrastructure which we understand and is being driven, whether it is roads, ports, airports, rail, et al. I think all those are getting driven. Power, green power, you can go on and on. Those are all getting on. And here I think we will in a moment touch upon who have been the drivers. Is it government or the private sector? What has happened to the private sector? Why did it not be in all areas? They're in some areas and so on. But clearly happening. If I benchmark what has been done in the country I spent 5 years very recently, I clearly see that this journey is a 25-year journey. And that is exactly what we hear the Honorable the Prime Minister talk, and we hear what the Honorable Finance Minister say. We have a 25-year runway ahead of us starting now. We have already caught momentum. It is not as if we are at a standing start. We have caught momentum. And in that journey, I think there is a whole lot of infrastructure to do and so on. So when people say our capacity will be doubled in say 5 years or 7 years, I say no. Our capacity probably will need to be tripled at least for us to meet the aspirations of the people. And those aspirations, again, the government pegged it very simply to say that we go from 2.5 trillion to 5 trillion, and then we can say 10 trillion. Of course, aspiration then can be moved further ahead. But what I'm trying to say is that the path to investment, whether it is in infrastructure or whether it is in manufacturing, is a long path with plenty of opportunity, during which period we will get the economy and the people of this country up in terms of their aspirations, meeting their aspirations, and letting them grow with the country. I said that I will connect two more pieces. One is I saw also in the session, you had a session on private investments and will bank be able to lend and so on. Let us put it in context. I've been in the banking business now for 50 years plus. In those 50 years, I have never seen banking balance sheets as clean as they are today. As healthy as they are today in terms of capital adequacy and in terms of bad assets. So talking about bad assets to me is passé. It is done with. It is over. So let us use one metric. How quickly that recovery that I talked about. I was chair of the committee to look at the restructuring, the expert committee that the Reserve Bank set in 2020 June. After talking to industry groups, after talking to rating agencies, we came to a number, and our own deliberations, we came to a number that needed restructuring, estimated number. The estimated number was 7.5 lakh crores. Round it off, those days exchange rate, $100 billion was what was required to be actually restructured. 1 year later, we closed shop. What was the amount that actually came up for restructuring? About 7% of that number. Less than 7 billion, 6 billion and odd was the number that came up against 100 billion that we had. Why? Because that recovery took place at a pace which none of us anticipated, and corporate India stood up. So to say that private sector is laggards and the banking sector is probably not helping them is not right. And these were the larger corporates. And the smaller corporates, the MSMEs, benefited from the 5 lakh crores of the guarantee structure. Again, a very innovative structure that the government put out. So these got things back on par. I'll complete the third part of it which is required. One is, first part is, do you have a healthy banking system? Second part is, are they liquid? They are liquid, so I won't go into that. Third part is corporate India healthy. Because you could have the banks healthy, but if corporate India is not healthy, then you have a problem. Now look at corporate India. Again, look at history. Just not very long. The year 2000, corporate India ran at an average debt to equity ratio of 3.7 or 4:1. post-Lehman, and actually through the 2000s, and definitely by the time of Lehman, that ratio came down to maybe 1.8:1, 1.8 debt, 1 equity. What is it today for the top 200 companies in the country? Near about 0:1. There is no debt in the top corporates in the country. Hardly any debt. Even for working capital, there is hardly any debt. So again, I would think it is the cash flow generation capacity of corporate India and their understanding now how to proceed in this market that is driving, I would say, the new India, which relies on cash generation, less of debt and so on. So we will see, at least in manufacturing India, I think less reliance on bank debt to expand. You will see them using internal generations for almost everything except large greenfield project. Short of that, it will be all through cash generation. That is happening. And also given the fact that 30, 40 years back, it took 5 years to set up a project. Today, you probably are doing it in 18 months, 12 to 18 months. So you don't need that lead time to get to market. If you see capacity increases required, you can get them up to speed very quickly. So I think the banks are ready to lend. Corporate India, on the manufacturing side, is more or less self-sufficient. So that part of it, I don't think the banking sector will be asked to play a big role. The users of the output, that is the retail buyer, I think he is going to be or she is going to be the main source of demand for banks in this area. Then we come to the infrastructure field. There it's an interesting milieu, and the same question can be asked, where is private sector? I break it into two parts. One is the events of last 10 years, where in private sector entrepreneurs who went for infrastructure projects have been hurt. The question is, why were they hurt? It is easy to paint with a single brush and say A, B, C, D reason. But I think we are missing the key reason why private sector got hurt. As I say it, the private sector got hurt because of what I call unforeseen risks. Risks which they could not foresee when they did the project. Nobody could foresee. For example, if, let us say, a license that you already been given is revoked. Is that a risk that you could have foreseen? I mean, I won't elaborate, but these sort of risks hit you in large measure and people got impacted. And to, again, understand this risk, I will use one example. Take the companies which have been hurt because of the reason they went into power generation using fossil fuel, primarily coal. But even before that, there are people who went gas and got hurt, coal and got hurt. But then you move on to people who went into power generation using the green technology, whether it is particularly solar. How many of them have been hurt? Not too many. Why? Because apart from getting the land right and your purchase contract right, and even there are now, I would think, structures which make it, de-risks it almost entirely, they're not facing any other risk. Whereas the fossil fuel guy has to manage the risk of getting that coal, either mining that coal or transporting that coal, fluctuations and so on and so forth, environmental clearances, so a whole lot of things which went wrong. The reason I'm saying is the private sector investor is a very cautious investor. He has to be. And he will invest when he sees that these risks are properly handled. And I think we are heading to that situation where those risks are being handled. In the interim, the government has taken the mantle of spending for infrastructure, which is good. So you see the other area which got hit was private sector investment in highways. Again, the government took over and those are moving. Private sector investment in fossil fuel generated thing got hit, the government took over. So I think that the government has done what was required to step in where there was a challenge and drive investment. Let me complete this part of it by saying there are other areas where private sector has invested and we do not talk about it. For example, almost the entire telecom space is now private. They have grown this sector up. There are challenges, but there will be challenges everywhere. But at the same time, we are the lowest cost provider of data in the world. And this is entirely private sector driven. Ports, airports, private sector. Green energy is private sector. Who's talking of, I would say, hydrogen, and it's basically driven by private sector. So I would think there is space for both the government to spend where needed, and they are doing it, and they will do it to greater measure. It's very clear. And the private sector to come in and fund. And there, I think the structures were not in place, and that is why the government has thought of institutions like NAPFID. And it's not going to be only one institution. The government is saying there could be more such institutions because it is right timed. 30 years back, 25 years back, when Hemendra advised me that I need to rethink where I am going, and we repositioned ourselves from being a bank, from being a development bank to raising capital and becoming a bank. The reason was we did not have access to long-term funding. Today, NAPFID will have access to long-term funding and other players will have. Why? You will have because the pension industry did not exist then. The insurance industry did not exist at this scale at that point in time. So things have changed, things are evolving, and I think we will put in the structures to fund the long-term development of India and the progress of India over that 25-year time frame. The last point that I want to say is that when we look at the future, we also need to add one more, I would say, cherry on this pie, the pie being the growth pie, and that is the entire digital drive. Again, Honorable Prime Minister talked about it as the digital economy, the digital startup economy, and so on. All of you are players and supporters of that. The numbers are there, I don't have to repeat it. Aspiration 100 billion. I'm sure it will happen in the coming year. All this comes as equity to drive this pie. This pie today is what in our neighbor? It is 30% of the economy, on top of whatever that economy was. And if we are doing all the other things that we are doing, infrastructure, manufacturing, et al., if we grow at 8%, let us say, and the pie is 25% of that, you are in double digits. So you can look at it any which way. I see that digital will give us a 2 to 3% boost to what we are already doing in terms of growth. And that will propel us further at a rate that I don't think we are fully comprehended as yet. That, to me, is the 25 years we will look forward to, where we will grow, the old industries will grow, new industries will grow, infrastructure will develop, and this whole new digital economy will drive the speed to a greater level than we have ever seen. I think I am slowly exhausting my time. I am not as much of an expert as Mr. Wagul, who could actually say, I'm going to speak for 30 minutes, and on the 29th minute and 59 seconds, you would come to an end. So I might have missed my timing by 1 or 2 minutes, but you will pardon me for that. But I leave you with great optimism that we are on a 10% trajectory for a very long period of time. We are not going to run out of runway on this journey. And I end by again congratulating all the people who will be celebrated today. Thank you again, Mint, for having me. Thank you.
As he said, here's to supernova growth over the next 25 years. Ladies and gentlemen, a wise man had once said that great men don't live in vain. The history of the world is but the biography of such great men. Thank you very much, Mr. K.V. Kamath, for joining us here this evening. I'd also like to thank all the people watching us online, thousands of you as we speak. Stay tuned in as we now head into an energizer that will also entertain your minds. Joy Bhattacharya is here with us to quiz us happy. He's, of course, a famed quizzer, orator, writer, and sports producer. He is the former team director of the IPL franchise Kolkata Knight Riders. He's also served as director for the FIFA Under-17 World Cup, which was conducted in India, and has later served as CEO of the inaugural Pro Volleyball League. He's here to engage our minds in a Stasi quiz. How about that? At the Mint India Investment Summit and Awards, please welcome Joy Bhattacharya.
Sorry, thank you, Gitika. Lovely being here. Thanks, Srijit, for allowing me to come here. Well, I actually, I have a confession to make. I actually have a connection with private equity and investment. In 2010, at that time I used to work for the Kolkata Knight Riders. I did a program in IIM Calcutta, which is a place, I've done many quizzes in and hopefully won a few in my time as well. And after I did that program, after 3 months later, typically placement people sort of start messaging and calling. So since I belong to KKR, they turned around and they send me a lot of messages saying, sir, would you like to take some of our people for a pre-placement talk, pre-placement this thing in KKR? And I said, look, at this point, we are doing a pre-placement nets where we are looking for 2 leg spinners and a middle order batsman. And then they figured out what it was. Then one of them actually turned around and said, no, I'm an all-rounder. I said, the all-rounder slot right now belongs to Saurav Ganguly, so you'll have to wait a bit. So that was my connection with KKR and equity and funding. This quiz is, I will have to confess, not too much about that because I know very little about it. But what I do know is that the kind of people who are in this business are among the sharpest and smartest people in the country. And quizzing is not about, people with Coke bottles, glasses, mugging things. It's about just thinking about things a little bit longer and figuring out connections that you would never know before. So I'll give you an example of a question that I love. If you can have that light off for a bit, please, because I can't see the audience too well. If you know the answer, just put up your hand and I'll try and come to you, okay? I'll try and see most of the hands that are up out here. Okay, question number 1. And this should intrigue you. Think carefully, okay? Question number 1. Take a look at that. And this is a visual coming up. Which company's advertisement is that? Okay, somebody's got their hand up there. Sir, your name, please. Yeah. Which company's advertisement is that? Let's hear your name.
My name is Vikram. Looks like it's IKEA.
Looks like it's IKEA. Vikram, absolutely right. There's a prize there for you, Vikram. Wonderful. Could we have the next slide? Yeah. Basically, they figured out there's a stat in the world which says that 1 out of 10 Europeans are conceived on an IKEA bed. So they decided to take it further and they made it an actual ad saying, okay, these are the people who are conceived in an IKEA bed. And that's where the ad comes from. So you get what I'm trying to do. More questions on visuals. Just hold on to the visuals for a bit. We'll put on the normal screen. I'll ask a few other questions before that. Okay. Question to you, nothing to do with all this. Which Indian of independent India became Prime Minister before celebrating his 21st birthday? Think carefully. Which Indian became Prime Minister before celebrating his 21st birthday? Proper bona fide Indian Prime Minister. It's not a Prime Minister from Kashmir or anything. There's a trick out here, and I think somebody might have guessed this trick. Yes.
Morarji Desai.
Morarji Desai, but he was about 79 years old.
Born on a leap year.
Born on the 29th of February. He's born on the 29th of February, so the poor man could not celebrate any birthdays. So I never said he was 21 years old. I just said he could celebrate it only 21. But Desai, I didn't get your name. I'm so sorry. Sridhar, well done, Sridhar. Lovely, lovely answer from Sridhar. Please give him a big, big hand. Please remember, we are giving away prizes. Lots of books we're giving away. Okay, the next question, and this is one I love. Okay, anywhere in the world you'll go and you want a cup of tea, it's either going to be called tea or cha. Okay? Almost everywhere it'll either be called tea or cha. Where is it called tea and why is it called cha in some places? Or what's the difference? Anyone? Why is tea called tea some places and cha in some places? Yep, somebody there with an answer. Look, I'm just running up to you not because I like you very much, but because I have to do my 10,000 steps for the day.
Hi, this is Suraj here. I think if you have got your tea from China, if the origin of tea...
Why don't you stand up?
Yeah. The origin of the tea is from China. I think those regions call it cha. For tea, I don't recall what it is, but one part of the answer.
Lovely answer. I'll give it to you. Terrific answer. All the tea that comes all tea came originally from China. Even we stole it about 140 years back. The British stole it for us. But all tea coming through land routes were given the Chinese name cha. All tea that came to Malaysia and went by sea were given the Dutch name or the teh, the Malaysian name teh. So if you see tea in Malaysia, it's called teh tarik. So tea comes from there. So if it's come by sea, it's called tea. If it's come by land, it's probably called cha. Okay? Okay, something else that all of you will be very interested in, or I think all of you already know quite a bit about. A gentleman called Josh was in love with his partner, a lady called Palak Shah. Okay? He did something for her that has been keeping many people awake for long, long times. What did Josh do for Palak Shah? And there's a lady out here answering from Trilegal. Yes, please stand up. And your name, please, first.
Namrata, and he made the game Wordle.
Namrata, and he made the game Wordle. Absolutely correct. The game Wordle that you play all over the place. There's a man called Josh Wardle, and his partner is named Palak Shah. Obviously, it has to be an Indian lady who inspires it. And he decided to sort of, say that, they used to both love the New York Times crossword, and he decided to invent a game that, would, now keeping many of us alive, and also it's giving many of us an opportunity to, put things on social media if you have nothing else to say. Just put up your Wordle there. Okay, do we have a prize for her? Please get a prize, because otherwise we'll be most disappointed. Okay, she's got her prize. Okay, let's go for a few more visuals. Could we have the next visual up, please? Okay, this is a visual of a brand. I thought it's one of the cleverest advertisements made. Which company would have made this advertisement? Look at it carefully, and I think it's guessable. Consumer product, obviously, something that all of us, fast-moving consumer product, as they say. Anyone? Yes? Somebody there? Yes, ma'am.
Sleeping and then waking up. Nespresso.
Absolutely. This is Nescafe. It's an espresso. Nescafe it is, of course. Lovely answer, ma'am. Obviously, that's absolutely spectacular. Nescafe, obviously, you're sleeping Z, 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 Z. The Z turns to N. That's Nescafe. What a fantastic answer, ma'am. Thank you so much. Okay, next one coming up, another visual. And, okay, I love this ad because it's such a clever ad. Bharat, India, something's missing. This is an advertisement for a company which is not a company, really, an organization which is really, really important organization. What is this an ad for? Or what is this an ad telling us? Nobody? Actually, I have to have some prizes come back to me. Okay, no, I'll give it to you. Let's take a look at the answer. It's a lovely ad, and I really like it. Can we have the next visual? Yes. WWF, the lions in India are disappearing to contribute call. I thought it was one of the best ads I've ever seen. It's an absolutely spectacular ad. Okay, one more coming up. This visual we didn't get. One more coming up. Okay, this should be easy. Which company is this? It's a fantastic ad, just all white. Who would make an ad like this? No, guesses allowed, please. Yeah, somebody out there has a guess. Yeah. Yep.
It's a guess. Surf or Ariel?
Surf or Ariel. Okay, you have a 50% chance of getting it right. What do you want to choose? Your time starts now.
I'll get a book.
You'll get a book anyway.
Okay, Ariel.
Well done. Ariel it is. Give him 2 books, please. Ariel it is. Of course, it's a kind of ad. The one company that believes that white should be everywhere. If the level of the mental listing of the quiz is going down, I apologize because it will drop slightly further before we raise it again. Next visual coming up. Okay, that was Ariel. Oh, I love this. Okay, this is a very interesting. I just had to put it in, though it's a tough question. If you see, this is an ad which says, pass the Heinz, pass the Heinz, pass the Heinz. You do not see a bottle of ketchup out there, okay? Now, the interesting thing is, this ad was supposed to be done in the 80s, but this was only done recently by Heinz. Heinz actually did this ad, okay? Now, the question is, why were they inspired to do this ad? And the hint I'll give you is a very famous series on OTT. Okay, if you can give me the name of the series on OTT, I'll give you the points. A very famous series on OTT inspired this. Yes, we're going to come back to you again. You're going to get yourself another prize, I think, I suspect. Your name?
Ankur, Mad Men.
Ankur, Mad Men. And I'll tell you why this is a lovely, lovely answer. Let's look at the next visual. Okay, so in the series Mad Men, season 6, Don Draper actually presents this ad and says, look, this is a fantastic ad. Think of it an ad where the product is never shown. You're just saying, pass the Heinz. And the Heinz people in the show turn around and say, no, won't work. Okay? 30 years later, obviously in real life, Heinz actually takes out this ad. So it's an absolutely fascinating place where a television series actually inspires, an ad in a television series actually inspires a real life ad. Okay, one more coming up, and this time really the level will. Okay, that is a Google Doodle, and we all know what Google Doodles are. That is a Google Doodle honoring somebody who is regarded as the mayor of Silicon Valley. Does anyone know who that was? This is honoring a man known as the mayor of Silicon Valley. Obviously, Silicon Valley is the place if you have ever been an investor. No? Nobody? Okay, I'll give it to you. This is Robert Noyce, the man who co-invented, who started Intel along with, obviously, his partner. Last one coming up, and yeah, just his name. The character or the name, very famous film. Which film, which character? Yeah, okay, lots of hands up at the back. Let me come straight back. I think we got one answer from here. We'll go to the other table. Gentlemen, now, your name and the answer, please.
This is Michael Douglas from the Wall Street.
Enough, I'll give it to you. Do you know his name? Gordon Gekko, okay. Part points there, part points here. Your name, sir? Sudeep, one prize for Sudeep, one prize for, sorry, who's that? Sorry? Jaideep. Sudeep and Jaideep get it. And the last one is probably the most important slide because it showed one of the best investing pitches I've ever seen in my life. Take a look at the picture. Okay, all I want to know is this is a film called Andaz Apna Apna. This is two brothers who are twins. If you haven't seen the film, please go and see the film because it's one of the greats. What pitch is he giving his brother? He plans to steal his brother's diamonds. What does he plan to do with it? Okay, what does he plan to do with it? Lots of people seem to know what he plans to do with it. Lovely to see. Yeah, your name first.
He will open a poultry farm, and then he will sell eggs, and then he'll grow chickens, and then he again sell eggs. Something like that.
Or bread bhi bhai banayega. If you remember, absolutely, this is the famous Andaz Apna Apna scene. And when he says that I'm going to finally get the diamonds, he turns around and says, "मैं poultry farm बनाऊंगा, लाखों अंडे, crore chicken, all sorts of things happen." But no, it was great fun. Okay, moving back, about 4 or 5 questions to end with. I love this question simply because it has nothing to do with any of this, but it's fun. Which capital city is the 25th most populated city in its nation? So normally capital cities are either the most populated or second most or third most. This capital city is the 25th most populated city in its country. Hint, not a small country. Sorry, did I hear something here? Yep, who's that? Your name first. Jairam, it is Washington, D.C. Fabulous answer because most people don't live in D.C. They live in Maryland, they live in Virginia. Lovely answer. Washington, D.C. is the 25th largest city in the U.S. in terms of population. Okay, 3, 4 more to go. Okay, what do we have? Okay, one of the most legendary firms of Silicon Valley, the name of this firm in 1938 was decided by the toss of a coin. Can you name which famous company's name was decided on the toss of a coin? Okay. Sorry, wait. Oh, okay, we'll go there first. Yeah. Your name, please.
Hi, this is Abhimanyu. You heard the answer, but if you had lost the toss, it would have been Packard Hewlett.
If Bob Hewlett and Packard had the toss, if he had lost the toss, it would have been Packard Hewitt, not Hewlett Packard. Lovely answer. You know, coin tosses decide a lot of things. It also decided a company's name for the next 70 years. Okay, 2 questions to go. One question I want to ask because I love this because even professors make mistakes. So, cricket, I work a lot in cricket. There's an Indian cricketer who's named after Sunil Gavaskar's son. He was his dad was a huge fan of Sunil Gavaskar, but he got Sunil Gavaskar's name wrong. Okay, so we all know that Sunil Gavaskar's name is Rohan Gavaskar. He heard it wrong for some reason, and he named his name, he thought he named his son after Gavaskar's son. He actually got it wrong. Yeah. Which cricketer? I'm coming to you. This is almost like a 22-year run. Yep.
Rohan Kanai.
Not Rohan Kanai. Okay, I've got my first wrong answer of the day. It's not Rohan Kanai. Rohan Kanai is actually the guy Rohan Gavaskar was named after. Rahul. Your name first. So his name is Santosh. The cricketer's name is Rahul. Cahill Rahul's dad is a professor of civil engineering, and he thought that Sunil Gavaskar's son's name is actually Rahul, not Rohan, and he named his son Rahul. So when Rahul goes to an interview and they say, he said, I'm actually named after Sunil Gavaskar's son. And they said, dude, isn't the name wrong? And he said, well, my dad, messed up a bit. Okay, brilliant. 2 questions to go. What can we ask you about? Okay. Okay, The Wolf of Wall Street is one of the most, well-known films on Wall Street. I'm sure you've seen it. If you haven't seen it, if you've seen it, don't do the things done in it. You're not supposed to, But if you have seen it, it for a long time had a record in the Guinness Book of World Records. What record did the film have in the Guinness Book of World Records, which has been broken recently? And there are 2 people in the same table. Trilegal seems to, their knowledge on, on debauched Hollywood seems to be very high. Sorry. Yeah.
The word which starts with F.
Fable. Fatal. Your name first.
Aditya.
Okay, so Aditya, what does it hold the world record for Guinness Book of?
For the word fuck has been repeated.
The word which rhymes with duck has been used the maximum number of times in the film. 535 uses. I mean, how in 2 hours can you do 535 uses is this thing. The last time it was held before that was by a film, which is also a good film called Casino. And that was that. That is the second last question of the day. The last question of the day is dedicated to the gentleman who spoke before me, who's been an inspiration for so many of us. Kamath sir has been, to hear him talk about India, to hear him talk about India's future, makes us all curiously so much happier and so much more positive about the future. Okay. Which logo is inspired by a carved stone lattice work in the 16th century mosque of Sidi Sayyad? Which logo is inspired by carved stone lattice work in the 16th century mosque of Sidi Sayyad? And we have an answer here as well. I think gentleman himself is not going to answer, sir, but I'll come to you. Your name, sir, and the answer, please.
Rajiv, I am Ahmedabad.
Rajiv, and of course, it is I am Ahmedabad. There are plenty here from I am Ahmedabad. Well done there. Fantastic answer, and we'll have a prize for you, sir. That's all from me today. Thank you very much. I hope you had a good time. There's lots of fun to follow. Thanks so much, Gitika. Bye-bye.
Wow, Joy! अंदाज है आपका बहुत ही मजेदार. Didn't you all have loads of fun there? Let's just put our hands together for him, please. What joy you brought us! तो इनके क्विज के अंदाज से बढ़ते हैं genuine appreciation के अंदाज की ओर. Ladies and gentlemen, here come the very prestigious awards at the Mint India Investment Summit and Awards 2022. The first award of the evening, Venture Capital Deal of the Year. To present the first award this evening, may I please invite on stage Praveen Someshwar, Group MD and CEO, HT Media Limited. May I also please request Nishant Parekh, Partner Trilegal, and Sridhar Gorthi, Partner Trilegal, to please join him in this felicitation. May I please request Mr. Praveen Someshwar to open the envelope and announce the winner.
Good evening. You all had fun listening to Joy and answering all the questions? Woke you up, I assume. So, Venture Capital Deal of the Year. Editors is the winner.
Such are their achievements that the AV went speechless.
Music is missing.
And we have with us on stage Jawahir Morarji, Managing Director for India, APAC and MEE, Eruditus to receive the award for the Venture Capital Deal of the Year. Congratulations. Ladies and gentlemen, we must applaud louder and harder. This is a big one. These are prestigious awards. Jawahir, may I please request you to share your thoughts with us on this occasion.
Thank you. Thank you to the Mint, the jury. We are very grateful and thankful for this recognition. Ashwin Damera, our founder, unfortunately couldn't be here. We actually have a board meeting running while this conference is going on. But on behalf of Eruditus and our entire team, we are quite grateful for this achievement and this recognition from Mint and the team. The 650 million is the fundraise we did is a testimony of the huge potential executive education has and higher education has. We're very grateful to all our partners, Excel, SoftBank, and the Canadian Pension Fund, and our existing partners with this fundraise. Thank you so much. Thank you, Mint.
Thank you very much for those words, and thank you very much for coming to receive this award. Ladies and gentlemen, I am going to urge you all, not too many awards this evening, I am going to urge you all to please clap with your hearts open for all our awardees this evening.
EdTech
And we're playing the AV
Eruditus
again.
raised $650 million in a funding round led by Accel Partners, SoftBank Vision Fund 2, and Canada Pension Plan Investment Board, which valued the firm at $3.2 billion. In a sector that has witnessed an investment frenzy, Eruditus stands out for its financially robust business model, unique positioning, and strong growth trajectory, which received a stamp of approval from marquee investors with a 4x jump in the company's valuation, putting the startup on the Indian edtech map. The founders of the company also stand out in their efforts to build a business with the right values and culture.
Many, many congratulations to them. Put your hands together, everybody. As we move into the second award this evening, Private Equity Deal of the Year. May I please invite on stage Shri Ajay Piramalji, Chairman Piramal Group, to please present this next award, Private Equity Deal of the Year. Good evening, sir. Very warm welcome. I request you, sir, to please open the envelope and tell us who the winner is, please.
The Private Equity Deal of the Year is TPG Rise for Tata Motors EV.
The $1 billion commitment by TPG and co-investor ADQ in Tata Motors' electric business marked the biggest such investment for any traditional automaker in the country. The deal puts Tata Motors ahead of other automakers in the EV space. Tata Motors has already bagged a majority market share in the Indian EV market for four-wheelers, and this deal shows the group's seriousness in transitioning from its internal combustion engine business to become a major EV car maker. TPG's ability and willingness to bet on the potential of the EV market in India, Tata Motors' ability to carve out a strong market share and price the deal accordingly makes the transaction stand out in a year of frenetic investment activity.
Sorry, I think we would be really remiss if we didn't invite Saurabh on the stage. This is as much as Saurabh's deal as ours. Saurabh, please, if we can have you on the stage. Please.
Ankur Thadani, partner TPG Group and Rise Fund, is here with us on stage to receive the award for the Private Equity Deal of the Year. I'm going to request Ankur Thadani to please share his thoughts with us on this occasion.
No, so firstly, we'd
Thank
like
you,
to
Ajay
thank the Mint team as well as the jury for selecting this deal as the Private Equity Deal of the Year. As I said, I would be remiss if we didn't thank the entire Tata team for, firstly their vision of spotlighting this very important goal, which is to decarbonize passenger mobility in this country. And we are very, very excited about partnering them towards this mission, as well as, all the team members who worked on this deal. So thank you so much for this.
Thank you and congratulations. Ladies and gentlemen, may I please request all the awardees to give me the pleasure to invite them on stage post the audio visual, please. The next award coming up, M&A Deal of the Year. May I please invite on stage Dr. Swati Piramal, Vice Chairperson, Piramal Group, and Shri Hemendra Kothari, Chairman, DSP Investment Managers. Good evening to both of you. A very warm welcome. Aye, please. I request Swati ji and Hemendra ji to please open the envelope and tell us who the winner is.
So the M&A deal of the year goes to, I think, everybody's favorite in India, the Tata Group for Air India.
Attention on the screen.
The Tata Group acquired the national carrier Air India, overcoming numerous odds at the end of a protracted and highly complex process, making it the M&A Deal of the Year. Acquiring Air India in an environment where the aviation sector is going through a turmoil and despite the complexities involved, signaled the Tata Group's determination to land the prized asset and also its tenacity to persist till the end. The deal also highlighted the strong intent of the Indian government to undertake difficult divestment transactions, ignoring the political risks, and will give global investors a lot of comfort in the government's future divestment plans. The fact that Air India was returning to its founders also added a strong emotional quotient to this transaction.
May I please request Saurabh Agarwal, Group CFO, Tata Sons, to please receive the award for the M&A Deal of the Year. Congratulations! I am going to request Saurabh Agarwal to please share his thoughts with us on this occasion. And thank you both for presenting. Thank you.
Yeah, good evening, everyone. It's truly a pleasure to receive this award on behalf of the Tata Group. I would like to thank the jury as well as the Mint team for choosing this transaction as the deal of the year. Generally, the deals of the year are given to investment bankers, so I'm a little surprised why a corporate has been chosen to do that, and we did have our own advisors. I must say this is truly a historic transaction. I think this is a change in the government intent on how it wants to run businesses going forward. I think Mr. Kamath truly talked about the platforms that have been put in place for the growth going forward. But I think divestment and letting the private sector take over and move forward with the assets which need a private sector intervention. This is truly an example of this. I think it's after 18 years that a strategic privatization has taken place. And I must congratulate, I have been a true bystander to this whole process over the past 3 years. It was a tremendous effort from all of government departments and the teams there to really make this happen. I have, under the leadership of Hemendra Bhai as well as Rajiv here, I have seen many transactions over the years, over the last 20, 25 years. But I must say this is the most complex transaction that I have come across in terms of the sheer enormity, the size and scale of what Air India represented. And I think at Tata Group, we have been very pleased with it coming back to us. And people have been highlighting to me in this room as well that hopefully this is going to transform for the better. I have no doubt in my mind, I think we have the commitment and we have the best wishes of the whole country behind us to make this truly a success. And I must say, I think there's never been a transaction which has received the kind of wide support and the joy which came about when this transaction was announced. So it's truly a historic transaction, and I hope we can do justice to the expectations of the people. And it has been a humbling experience for me to be part of this exercise and really make it happen. Thank you. Thank you, everyone.
Thank you, sir, for those words. Joy for the people of India. So complex, and that is why you received the award this evening. Congratulations once again. Next up, ladies and gentlemen, Deal Maker, Hall of Fame. May I please invite on stage Shri K.V. Kamath, Chairperson, National Bank for Financing Infrastructure Development, to kindly present this award, Deal Maker Hall of Fame. I request you, sir, to please tell us who the winner is.
Any guesses? There is a deal-making supremo amongst us, and I have great pleasure in calling out Ajay Piramal. Ajay?
Attention on the screen.
You make us proud.
Leading the Piramal Group, a global business conglomerate with diverse interests in pharmaceuticals, financial services and real estate with presence in more than 100 markets. Ajay Piramal has cemented a reputation for responsible entrepreneurship with a strong focus on doing well and doing good, a philosophy that has created long-term value for the group's stakeholders and the community as a whole. Starting at the age of 22 years in his family business, Mr. Piramal has throughout his career helmed many marquee transactions involving some of the biggest names in the domestic and international business market, maintaining a high bar for transparency and corporate governance. In the 3 decades of its existence, the Piramal Group has pursued a twin strategy of both organic and inorganic growth and currently employs over 10,000 people from 21 diverse nationalities, and in the process has created significant value for all its stakeholders. In 2010, he sold branded generic drugs business Piramal Healthcare to Abbott for $3.7 billion in one of the biggest pharma deals that India has seen. In 2021, Piramal Group acquired beleaguered housing finance company DHFL for 34,250 crore in one of the biggest M&A deals of the year. In 2020, he bought Carlyle into pharma arm Piramal Pharma Limited for a minority stake of 20% for 3,523 crore. He has partnered with marquee global investors such as CPPIB, Bain Capital Credit, APG and Ivanhoe Cambridge to set up various alternative investment platforms with billions of dollars in assets under management. The group sold its Decision Resources Group business to US-headquartered Clarivate Analytics for $950 million in 2020. A firm believer in the tenets of the Bhagavad Gita, Mr. Piramal is a passionate advocate of trusteeship and responsible business ethos. He is deeply invested in unlocking India's socio-economic potential through the Piramal Foundation and is an ardent promoter of social entrepreneurship. A true champion of corporate governance and ethics in business, Mr. Piramal holds key positions on the boards of several companies and prestigious institutions. He serves on the Harvard Business School's Board of Dean's Advisors, is the co-chair of the UK-India CEO Forum and a non-executive director of Tata Sons Limited. Passionate about contributing to education in India, Mr. Piramal also serves as president and chairman of Anant National University and chairman of Pratham Education Foundation. The Deal Maker Hall of Fame Award 2022 celebrates Mr. Piramal's ability to unlock value through the right investment and deals and his contribution to the investment and deal-making fraternity of India. He has helped boost confidence among investors about the India opportunity.
Wow. Ladies and gentlemen, please put your hands together as I invite on stage Ajay Piramal, Chairman Piramal Group, to receive this award for the Deal Maker Hall of Fame. I'd also like to invite on stage Hemendra Bhai and Swati Piramal ji. Many, many congratulations, sir. Hemendra Bhai would like to share his thoughts on Ajay Piramal ji being honored this year as the Deal Maker Hall of Fame awardee.
I'm so happy to be this occasion where Ajay got this award. And we have Mr. Kamath presenting him this particular award. success behind man is a woman. In this case, it's very true. I know Ajay since nearly 60 years. Can you imagine what age was he at that time? His brother and me were very close friends. I used to be 3-4 times at least a week in their house. Ate with him at dinner, lunches, played cricket. Next door there was a empty space, so we used to have literally a cricket pitch there, and net practice and cricket matches were going on. So I think that relationship had a lot of impact on my life. His father became, frankly, my advisor, guru. He told me to, before I do something else, I should go and spend some time with them. So I went as a training in Moraji Mill. In 1 year's time, suddenly I got the head of sales over there. I became a, and I learned how to people delegate power to their other people associated with them. And I became a local head of Moraji Mills at the age of 22. I there 1 year and I realized if I can be there and be successful, and they made a record profit, Moraji Mills, on that year. So I thought that experience gave me guts in a way to go where nobody was going in the stock market in 1969. So that was the turning point in my life. And Ajay, before him, his father, was the great deal maker. He bought that time Miranda, Philip Morris, VIP, and I was the merchant banker for him, or investment banker. There comes, unfortunate, his brother passing away, and suddenly at a young age, Ajay takes over charge of the Piramal Group, and what you have seen, it has been shown here. So I don't want to go into his business side of it, but what he has done, he has kept all his friends, his business associates, very close to him. His wife Swati has various cultural activities, fantastic food at home, which is, think of it that when she will invite me now. Even in COVID time, she kept everybody busy in the evening, online, on various cultural programs, historical or music, you name it. And his son also got involved with that, and his daughter. So the whole family is so close-knitted family, and no wonder why Ajay is so mentally free to think of business and new ideas. I'm very happy and very proud of my association with Piramal Group for so many years, 60 years plus. So that is the way the past is end, and just happened that way that I'm here today. I'm so happy. Thank you. All the best to you.
Ajay Piramalji, we must hear from you, sir. May I please request you to share your thoughts?
I'm going to go there.
Thank you, thank you.
First of all, a big thank you to Mint and the Hindustan Times for honoring me. And I know that this was a jury of Mint, so a special, even more greater thanks. Thank you, Mr. Kamath. You have always been an inspiration that we've looked up to. And Hemendra has been with us, as he said, for 60 years, and has been always has been and will always be a part of our family, advisor. He still told me some good advice, even in the few minutes. Hemendra speaks few words, but there is a lot of depth in that, so thank you very much. My wife Swati has been with me through all these times, so we are married now 46 years, so it's a long time. I want to thank her. My kids, Nandini and her husband Peter, and Anand and his wife Isha. Unfortunately, all of them are traveling, so they couldn't come, but I'm grateful to my whole family. They have been the support which has allowed me to do so many crazy things. Not always they work out, but they've always stood by me, which is a big thing. In addition, I think I have really had a very good team of people. So you talked about a delegation. I think I learned it from people like my father and Hemendra, so delegation is part of us. So thank you very much, all of you. You know, since this is like Hall of Fame or whatever, and it's been a while, so I thought I'll give you just a few lessons I've learned. First of all, I am actually very grateful to Hemendra, because when I was 22, he brought what he called a Miranda. He spoke about that. And my father did that deal. And I think my father just asked me to run it. So at 22 here was no experience, but still was running this business. And it was got by Hemendra. It was such a nice business that it gave me a lot of confidence. So I always remember that meeting. I still remember clearly where we were sitting, how we were sitting, and how actually the deal was closed in probably half an hour. Anyway, what are the lessons I've learned? I'm going to quickly talk a little bit through this. One is I've learned that if you have a value-based organization, it creates huge economic value. In the short term, you may feel that there is an expense, but in the long term, it does create economic value. And I can just give you the example of when we entered into pharmaceuticals, we acquired a multinational, Nicholas Laboratories. We believed that though the deal was done, even later, we must live in letter and spirit of the agreement that we had done. And to cut a long story short, every deal after that, which any multinational wanted to, in pharmaceuticals, wanted to sell, and there were many who wanted to exit out of India, all of them came to us for the first call. And I think you will remember Hemendra and Rajiv were there when Ron Poulenc was being sold. In fact, we paid a lower price than what another competitor was willing to pay, only because of our reputation for being value-based. So that's one example I've learned. Second example I want to talk about is that if you have to make an investment decision, particularly in a deal, one must look beyond the headlines. What I mean is that headlines actually only talk about the past, that the growth has been so much, and they just interpret the past into the future. But actually, rather than looking at the past, one needs to look at the future, and that's when, in our experience, value has been created. So when we entered pharmaceuticals with this multinational, we acquired it at 0.3 times of sales as the acquisition price, because everybody, every paper, every consultant said that pharmaceuticals, particularly MNCs, it was not a market for India. This I'm talking in the 80s. And that's what happened. We went beyond that and therefore acquired it at 0.3 times sales. In 2010, when people thought the whole world and all the consultants, I'm not offending anybody, but they all say the same thing. Or the big four or the big 10 or whatever say the same thing. So they all said India market is going to boom and it's going to be this and it's the day of patents and multinationals. So we realized the future didn't look as bright, and therefore we sold to Abbott and we got 9 times sales as this thing. So it's and this has happened again and again. In DHFL, this is the same story. Everybody thought it's bad, but I think it'll turn out better. So anyway, that's the second learn I've heard. Third thing I've learned is that if you have to create extraordinary value, there are two things. You have to buy something which is imperfect, and you have to sell something which is perfect. So imperfect, I mean, is that if there are some chinks in the armor, if there are issues, if there are problems, but if you know that you can get to solve them, then there are few people who will actually bid for such assets. And particularly now in this world where there is so much of, there's private equity on one hand, so much of governance, people are not willing to take that risk. But if you can take that risk, then I think, and if you can identify that there is value there, then value can be created. That's what we have applied to DHFL, and we think that we will create value. We can see that happening. On the other side, I think when you have to sell, which we've also done, you should sell when your asset is perfect. Because then you get the perfect price. And you get real value, that's when you get value. We've also done that in our experience. I just talked about Abbott. There are some other examples as well. The next learning I have had is that we need to focus on the process, which means not really worry about the result. But if you are doing the process right, then the result will follow. It's really the following of the Gita that I'm talking about. There's nothing new, that you do what is the process, leave the result. I've seen this through, as you know, sometimes M&A processes are very torturous. They are long. You go through their ups and downs. And I can tell you that that time you need to be steady, because otherwise one may take a rash decision. And that's what I've learned, that if you are steady, it happened, I know, in the last minute when we were signing the deal with Abbott, the guys just made some new excuse that we can't go through with the deal, hoping to get some value. I said, let it be, go home. Nothing happened. Everybody advised me. All my advisors, lawyers said, no, 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 let's agree. I said, we will not agree. And actually it happened. So in DHFL, I know some of my colleagues are here. They'll know we've gone through many ups and downs in the process. But if you stick to that, ultimately you will get what you have to. Next thing I feel is that this is 75% of acquisitions actually are not successful. That's some research. I think the main reason for that is ego. It's the ego of the CEO. It's the ego of the chairman who wants his photo in the next newspaper or article and all that. I think we have to leave aside ego and just go on the facts, whether it makes sense or not. And I think it's so important. All of us fall prey to it, and it looks obvious, but I thought I would just speak about that. In the same thing, recently, when we sold actually our pharma domestic business, some people asked me that how come you're selling it? That is your identity. How come you're giving up your identity? I believe that all of us, our identity is not defined by the work we do. It's much more. I think we are more important. We as individuals have an identity. If we realize that, we'll take the right decision, and therefore won't depend on deals or business to have our identity. That's important. If we recognize that, I feel it's better. Finally, one more thing is that when we acquire to invest and grow. We've done that in every business of ours, including DHFL now. When we acquired it, we've already now added 3,000 people in the first 6 months. We have plans to add another 2,000. We're increasing our branches. We've put in more capital, and we put in more technology. But importantly also is this concept which I call as the Sangam concept. When you acquire a business, the way we look at it is that how it's a Sangam where two rivers are meeting. When the Ganga and the Jamuna meet in a Sangam, at the end of the river, the merged river, it's not the Ganga, it's not the Jamuna, it's a new river. It has all the qualities of both the rivers, which is what means that when you acquire something, you respect the other acquirer and the acquired respect each other. what I find many often, especially in multinational large corporations, it's like when the water flows into the ocean. The ocean doesn't change. The largest river in the world flows into the ocean. The ocean's salinity will not change. The depth of the ocean doesn't change. But that's why they fail. If you have equality, they succeed. And I'll just give you one stat. We just did an anonymous feedback session from the people of DHFL that we acquired. And the data just came out today, which I'm going to share with you, that 97% of the people felt that the integration in the first 6 months has gone well. And 96% said that they understand the vision and strategy and that they've been treated fairly. I think that is the strength of a success. Finally, I want to say that all this has happened only because I think I'm really blessed. There is some higher power which guides me through this. Otherwise, you can keep saying this. But honestly, I do believe in it. There is some invisible hand which is helping. I want to make one last point. I think Mr. Kamath spoke about the future of India, and I really believe in it. You know, 5 trillion economy. But there's one thing that I want to talk about, which we also need to look at in India. And that is that how do we take the underprivileged, how do we raise their levels of their living? In India, there are many parts of the country where our standard of living is far, far below that. The Prime Minister has identified the aspirational districts, 112 of them, where 16% of India's population lives, which has only 1.5% of any CSR money going there. And most of the resources of the government also don't reach. You look at the tribals, there are 100 million tribals in India, and some of them you won't even believe they still live in modern India. We talk about digital India, there are tribes which are still living in, I mean, like 200-300 years before. So I think that's what it is, a responsibility of all of us here. I think we are all so privileged here that we should do something. And that is what we as a group also try to do through our foundation. How do we get this seva bhav in people across our company and across the country? So with that, I just want to thank you once again for coming this evening, for the award that you all have given me, and the love that everybody shows. Thank you.
Stay with us on stage, sir. Ajay ji, please stay with me on stage. I'm going to invite you all for a group photograph. May I please invite on stage Jawahar Morarji, Ankur Thadani, Saurabh Agrawal, Ajay Pirimal ji is here with us, Shri K.V. Kamath, Hemendra Kothari ji, and Dr. Swati Pirimal. Please. Ladies and gentlemen, we are at the Mint India Investment Summit and Awards 2022. Let's all put our hands together loud and clear for these awardees that are making the difference that needs to be made and are building the India of our dreams. May I say at the end of this award ceremony that may our country be जहां डाल डाल पर सोने की चिड़िया करेगी बसेरा, वो भारत देश होगा मेरा, वो भारत देश होगा मेरा. And alongside, can we also say, जहां सत्य अहिंसा और धर्म का पग पग लगेगा डेरा, वो भारत देश होगा मेरा, वो भारत देश होगा मेरा. Once again, congratulations to all the awardees. Thank you to the honorable presenters. Thank you very much to the chief guest, to the guest of honor. Thank you very much to the audience seated here. And thank you very much to all of you watching us online. This is Geetika Ganjudhar signing off and saying, join us for cocktails and dinner. Have a great evening ahead. Namaste and Jai Hind.